at Invesco.
Good morning, everyone. As Tim said, my name is Paul Schroeder, and I'm a Director of Factor and QQQ Equity Product Strategy with Invesco. And I wanted to welcome you all to the innovation stage at Bloomberg Invest 2026. We're proud to sponsor with an industry leader like Bloomberg to discuss the topics that are transforming the way we all invest today. I've had the opportunity to attend many of these Bloomberg events over the past few years, and they've always been filled with relevant topics, with a lot of timely and relevant information that today won't be any different. And I really think that this first discussion checks all those boxes as we hear from industry leaders that are going to be discussing different ways AI could be implemented in the near future. Lastly, what I would like to say is that this is the exact type of content that we really feel that QQQ should be sponsoring, whether people will be discussing AI or one of the many other topics that will be discussed here today. QQQ has really provided a way to gain exposure to disruptive technologies through the years. Now, for the past 26 years, QQQ has provided access to industry leaders, not only in the tech field, but across many industries. So I hope you all join myself and Eric Balchunas as we dive a little bit deeper into QQQ later today here on this stage. But for now, please enjoy the program.
Please welcome to the stage Marjorie Janowicz, Chief Revenue Officer at Mistral AI, and Shobit Varshney, Global Head of AI at Citi, for a conversation with Bloomberg's Tim Stenovec.
Welcome, welcome. I can think of no better way to kick things off here at Bloomberg Invest by bringing together one of the biggest banks in the world and can I call you a startup still?
I think we are no longer a startup.
You're no longer a startup.
You can say scale up, I guess.
Okay, scale up. Mistral AI's Marjorie Janowicz and Shobit's here as well from Citi. It's a great pairing, and I think the biggest thing that I've been thinking about in preparing for this is the different conversation that we're going to have this year versus what we had last year. I was told to be ready for how quickly AI is going to improve, how quickly things will get better. I mean, we talk weeks, we talk months, and it has absolutely blown my mind. So I just want to start out with you, Shobit. You're relatively new to the position at Citi as Global Head of AI. How does the bank use AI right now?
Thanks so much for having me here. It's a great pleasure. For us at Citi, AI is the very core of how we serve our customers, how we empower our colleagues, how we run our business. So it's just across the fabric of what we do. And we always have to do that with making sure we have safety, compliance, and responsible innovation always at the forefront of what we do. We have a two-pronged approach to how we apply AI across the firm, bottoms up, top down. So bottoms up is about making sure we empower all of our colleagues. We have a central AI platform that gives you access to all kinds of large language models, contextualized to the backend systems that we need to connect to, presets that help you do the workflows.
So how does that work? Like, you have the more than 180,000 employees who have access to this at Citi, have this sort of central hub where they can just go and access AI tools.
So 180,000 colleagues use these very, very actively. And we've rolled this out to 84 countries. Like, Citi is a very large company. We are physically in 94 countries. We operate in 180 countries. So it's a very, very large landscape. And all of our colleagues have built out a lot of day-to-day workflows in our Citi Stylus tools. So this is empowering them to do day-to-day job much, much faster, better, improves our safety, improves the way we look at different workflows. So that empowerment helps us go bottoms up and address all kinds of workflows. Then there are certain workflows that are very top-down. So we've taken a very robust approach of looking at top-down processes that cut across the organization. So we recently went through with 50 of such high-impact workflows across the firm. So things like KYC, AML, it could be client onboarding, it could be loan processing, things of that nature that are cutting across the firm. Those need to be radically reimagined. It's not just layering AI on top. It is looking at that process, simplifying, eliminating some workflows. There are policies in place that impact them. So we're doing a lot to reimagine how Citi operates in the core processes, right? Top down, all of that is built on a central platform, common capabilities. So now we're empowering our colleagues from both day-to-day as well as for the more end-to-end processes.
Okay, so big picture overview. We're going to dig into sort of a few use case examples a little later. Marjorie, I want to bring you in here because if Mistral's already working with many big banks around the world, including some here in the United States, but in Europe, HSBC, BNP Paribas, when you are speaking to the folks who are actually buying your product, you're working with them to essentially build it from the ground up for them. What are the problems that you are able to solve for them?
Yeah, actually it ties very nicely to what you just described. I think when Mistral started the business 2 years ago, we were an open source model only company.
Not a startup, even though 2 years old.
So we were a model only company, and we started to talk to a lot of banks and financial services companies globally, and we realized that this bottom-up adoption was absolutely great, but it wasn't necessarily sufficient to drive deep transformation across a bank. So some of the problems were when you start talking about a very complex KYC process or claim management in insurance, you start realizing that you need to tap into the full enterprise context, to the full enterprise data in order for that process to work well. So we started to work with a lot of customers that were trying to combine their cloud data with their on-prem data to make those workflows be fully transformed. And then we also realized that creating such a complex or transforming such a complex workflow requires quite a bit of an advanced set of tools that are going to help you inject governance at every step of those workflows. So the main problem we realized was that the ROI across those banks were limited by the access to the full context of the enterprise, on-prem data, cloud data, the ability and the need to customize the workflows to be really specific to the regulatory requirements that were needed.
Was that challenge, and has that challenge been just about the fact that as these banks have existed for many years, as these financial institutions have existed for many years, they've adopted new technology. That technology has been layered on top of each other. So you have, some data that's housed here, some data that's housed here. Is that what it's about? Is it about taking a lot of old data or old systems and modernizing them? Is that what I'm hearing?
It's a little bit that, but there's also not all data can be necessarily exposed to the cloud. Many institutions need that data, some of that data to remain really on-prem for data privacy and data control perspective. And then you start also having a network of software, newer software, but also older software that all need to be connected back into those AI systems for those workflows to be truly transformed. And at times we go all the way to requiring the models themselves to be fully customized to the data itself for the ROI of those systems to be fully realized. So we spend quite a bit of time helping companies customize and fine-tune their models for the ROI to be realized, really. Yeah.
Shobit, one thing I'm really interested to hear from you about is how you scale technology like this, because again, I'll go back to that number, 180,000. It's not like you gather everybody in a room and you take them through, hey, this is how you're going to use this technology. And the technology also changes very quickly. You approve things at a certain rate in certain countries based on what regulators there allow. How do you scale this across an organization?
See, it has to come from within. Right? It has to be something that people want because it is transforming the way they do work. So just in the last year, we had over 21 million interactions with our Citi AI tools. That tells us how people are using it. We can constantly look at feedback loops and get better.
Are those productive interactions? Because I have a lot of unproductive interactions with AI tools.
A variety of things. I generally get surprised, and the interactions that we're having are not single one-time chats. Our Citi Stylus tools are fairly sophisticated in the kind of workflows we allow people to do. As an example, I have about 5,000 users who have access to agents inside of our Stylus. So I can give an overall ask. It creates a plan. The human approves the plan. It's like, yes, makes sense. It can go into all kinds of backend systems that are city's proprietary, bring all of that back and go through the whole process. And these are fairly long interactions that go through the agentic loops, right? So you're getting a lot of work done in a few minutes, right? One level up from there, it's not just a one-on-one interaction with AI, it's a community. So we have something called stylus spaces where I can have my colleagues and AI as part of the conversation, and all of this is happening simultaneously. So while we're having interaction with AI, I can tag with a colleague, I can tag another colleague, another AI, they're also participating, right? So this is generally changing the way work gets done. Now, in order to infuse this across the firm, you don't learn by going to town halls or looking at online courses and stuff like that, right? What we have been very successful doing is our AI accelerators and champions program. So we went out and we have people across the firm in every line of business. There's legal, there's marketing, there's developers, and the whole spectrum. These 4,000 people are the ones who are creating day-to-day presets. They're showing their colleagues. So you learn from the person who is next to you on the desk. And when they show you how they're leveraging AI to accomplish a lot more, you learn a lot faster. So you can share a preset. You have all these. This week we're doing a city AI days. We've done more than 100 AI days across. We've covered the entire globe. So when you get the community together, when you're learning from each other, and the tools are advanced enough that they are embedded in the way we do work. It's not a generic third-party tool that we're leveraging. We know exactly what kind of workflows are needed, and there's a continuous feedback mechanism. That bottoms up, making sure that the skills are there. We mandated generative AI training. We want to make sure that everybody's empowered. They know how to use these tools, and they're seeing how their peers are using these tools, right? That has had a compounding interest on how well we've had diffusion of this technology across our...
Yeah, the peers element I think is really interesting, like hearing from colleagues that, okay, this is what I was able to do. That helps me, at least with the adoption, is like hearing people who are doing my job but a little differently using AI. Marjorie, when you're working with the banks and you deploy Mistral's tools for them, what do you hear back from them about what they were able to accomplish, what they were able to do that they weren't able to do before, how much money they're saving, if they're saving money, that ROI? Talk to us about that.
Yeah, and I think maybe to also quickly supplement on what my colleague said, I think there's the bottom-up adoption side of things, but there's also, when we start speaking about horizontal use cases, those use cases that are really across the bank, those use cases that are going to be very much workflow oriented. I think this is where the top-down approach is necessary. And what has changed, I think, over the past 2 or 3 years is that you used to be able to solely rely on IT to roll out those end-to-end cross-functional processes into the bank. Today, the same way you need to expose your end users to AI, you also need to expose the business into participating, into defining what those processes are going to look like in the future. So my point is the role of the business together with IT is absolutely essential in driving those horizontal projects. And then going straight into responding to your question, I think within banks we see really 3 types of major use cases. One is customer 360, so onboarding the customers, improving the customer experience. And here you start being able to measure ROI with attach rate or customer acquisitions. That's an example of a ROI metric that you can tie directly back into AI systems. The second part is all around risk and control. So your KYC process, your anti-money laundering process, there you're going to be able to measure ROI in efficiency quite a bit because you are, of course, making your employees more productive. And then the third type of use cases are usually linked to financial intelligence. And here, financial intelligence is getting access to the right data faster to make the better decisions. And here you can measure the return in efficiency, but also cost savings or risk reductions. So when we start working on those horizontal projects with the business and with IT, it is absolutely essential from the beginning to identify what those measurements of success are going to be so that you avoid the proof of concept graveyard that we've all been speaking about.
How do you avoid that at Citi? What do you make sure to measure when you deploy something or when you're using a new tool or thinking about using a new tool?
So for us, applying AI as a technology, In order to get business value out of it, you have to genuinely look at the operating model and AI together. You need to look at the process itself. So I'll give you some very quick examples of how we think about this. If you ask a process owner, can you do this a bit better? Everybody can squeeze out 10% on their own, right? They don't need external help to come explain how this is done, and then you tell them how to do it better and stuff, right? They have a handle on that because they have control over the process itself. If you need to automate a document, they can handle it themselves. Technology is available today to do that. If you change the exam question and you say, why does this document exist in the first place? That is upstream, downstream workflows. There are policies across the firm that are impacting that particular process. The process owner, our job as leaders, is to empower that process owner to radically reimagine things that are out of their control, right? That's what we're doing at Citi. Every Friday, we have the entire leadership team getting together as joint accountability for AI across the firm. This is leaders of every business, every functional area.
You're saying, so what you're saying is adopting AI makes you think differently about the entire process flow of an individual's job. Like, you know, if we think about this in a historical context, maybe it's like, you know, people used to come in the morning and the mail cart would come around and bring you documents in the morning and drop newspapers off. And then nobody had computers on their desks. Now they have computers on their desks. They are already reading their email on their way into work. Are you talking about a transformation such as that?
So I'm talking about fundamentally reimagining the process end to end. It's not about automating an existing process, right? So you don't want to have AI layered on top, right? So to give you an example, if you are looking at, say, the process owner, if you're doing onboarding of a client, it is not a reading a document with AI problem. It's not a problem of optical character reader, can I read this with higher accuracy? It's a cross-border data sharing problem. To enable that process owner, every Friday when we meet as a leadership, we are unlocking some of these hurdles that come in the way of systemically being able to transform things, right? So you look at a process, you simplify it, you eliminate some steps, right? And then you start to automate what's remaining. So it's a new way of doing things. And I'll give you a very simple human analogy. When we got dishwashers in our houses, we don't expect the dishwasher to stand up and rinse dishes the way humans do, right? Instead, we have added a step of loading the dishwasher, taken out the next 5-10 steps. The way dishwasher washes dishes is radically different than what humans do. The output is a lot better, and without dishwashers, we couldn't have massive restaurants, right? So that mind shift is needed. So you need to empower the process owner. It's not a technology problem alone. It is understanding the process, re-engineering the process, enabling those people to see what the future state looks like, and then committing to an outcome for that.
Marjorie, come on in. I wasn't expecting the conversation to be so cultural as far as as far as work goes in the workplace and understanding the way people work, but I saw you nodding your head.
I totally agree. As a matter of fact, 2 years ago, when we started to work on some initial use cases, we would take a process that had already been documented, and we started to work on basically deploying AI on that process. Big mistake. The first step is to think about how does the process need to be completely transformed in the world of AI. And it's not only a technology problem, it's also an understanding of a domain problem, which is why we even deploy forward deployment engineers that have both AI expertise and also domain expertise in order to be able to completely revamp what the process is.
So Marjorie, what's the right way to think about that? Do you only think about the outcome, what you want to achieve, and then you completely rethink how to get there using new tools?
You start with the outcome in mind.
Okay.
Of course, you need to understand the ecosystem, the tools, the data sets that's available, but you start with the outcome in mind, and you start rethinking. Of course, you need AI knowledge to do that, but you start rethinking in an ideal world to achieve that end an outcome. How do I need to completely rethink the way I've been doing my work in order to be more efficient?
So we got a lot of people watching right now. We have a lot of people in the audience here in New York City who work in the finance industry, who've been doing a job a certain way for many years. What's your advice to them?
I mean, the big advice to me, depending on where you are in your journey, is to start with the most impactful problems that you need to solve as the first set of use cases. So a lot of companies have tried to make some quick wins along the way or attaching to some exciting projects, but those projects were not tied to a very big customer outcome. So what's an example of that? You know, if you're trying to basically decrease, I don't know, failure rate of your KYC process, and it's going to result in X million dollars of saving, that's an iconic use case. That's a use case that's going to have a big impact. Start there and really have IT and the business work together. One without the other, I think, is just not going to work.
I agree, 100%. It has to be a joint accountability across the firm. There's certain use cases where AI has done an amazing job for a lot of our banks. Software development, right? We have about 30,000 software developers across Citi. We have rolled out agentic coding tools. There's a software development lifecycle that is very mature for us, and we're infusing AI agents to help us with that whole process end to end. Just between, just with the coding tools itself, we have unlocked about 100,000 hours a week of incremental productivity for our developers. So imagine how much more we can build out in terms of features for our customers, delighting them with experiences, making the bank safer, better guardrails, things of that nature, right? So we're using that 100,000 hours a week towards those.
I was just thinking working less, but...
No, there's so much to be done, right?
It doesn't sound like that's the idea.
There's about, we've done about 1.5 million code reviews fully automated. Right? So this is helping us make sure that the code that we're producing is a higher quality, it is safer, we're able to get to our backlogs much faster. You start to see that roll out over time, right? Similarly, every area that we have gone out and done this at, you look at KYC, AML, you look at KYC, for example, we've mentioned that a few times, know your customer. For a bank like us who operates in 180 countries, we move about $2,000 trillion a year. So you can imagine the kind of checks and balances we need when we're onboarding a customer, looking at the entire end-to-end. When somebody's coming for loan from us, we need to look at the entire company, the book of work, the transactions, right? So step by step, there's a lot of unstructured content. If you're looking at anti-money laundering, an investigation comes to you, there's a lot of, you look at these breadcrumbs and start connecting the dots, right? So you start to channel your inner Sherlock Holmes and say, hey, I see something here, let me double click. Oh, this is a shell company who was on the particular board. Do they do transactions here and stuff? You start to put together a picture. So we're automating a lot of that workflow. It's unstructured in nature, and we're able to go after a lot more. So by the time it comes to a subject matter expert, they have a very clear view of what the case is. And the same exact we can then apply to supervising the conversations we're having with end customers, or looking at fraud detection and stuff like that. So all these different use cases, we're seeing good 30 to 50% of the workflows are very quickly automated, as long as there's a human in the loop to validate this going the right way.
Shobit mentioned software engineering, and I think that's a good way to segue in the last few minutes that we have to really understanding from you, Marjorie. I think a lot of people in this room have a good understanding of ChatGPT, of Anthropic's Claude, but maybe not where Mistral Mistral's and what it does for finance falls in there. Can you talk a little bit about that?
I can definitely do that, and I'm going to piggyback on what you said also a moment ago. I think when you start speaking about banks that are 100 years old, that have acquired a lot of data for many years, suddenly the data that the bank has becomes a competitive advantage if you can customize your models to that data. So we're speaking about customer 360 and creating unique customer experiences. What if you were able to inject that proprietary data into your AI systems? Suddenly the AI you've built for your end customers is very differentiated to other banks globally. So we've been speaking about cost reduction for the past 20 minutes or so, but there's also a revenue generating aspects to that for the banks. So to answer your question, really what Mistral has been focused on over the past couple of years is really three things. We believe first in open weight models. So the large language models that Mistral has launched over the past couple of years are open weights. It means you can completely adapt those models, you can look under the hood, and if you can adapt them, you can customize them to your business. So really openness is the first point. The second point is we specialize in really helping banks deploy those systems on-prem. As well as in the cloud, so that you're not only, I would say, narrowed down to use cases where your data is in the cloud, but you can really take your entire data set and build those AI systems safely and with full control. And the third aspect is customization, making the AI your own, not only by customizing the models, but also a technology platform that you can plug and play into those model gardens or those platforms you've built internally. So Mistral has basically built an entire business over the past couple of years, working with companies like HSBC and BNP, as you mentioned, really working on enterprise-wide transformations. We start by laying out a horizontal strategy for what that transformation looks like. We define 30, 50 critical use cases that are going to either drive new revenue opportunities or drive significant efficiency gains, and we achieve that with 25 different open models, a technology stack that sits on top, and the very important component of forward deployment engineers that I was talking about, that are the glue between technology and AI expertise, but also domain expertise. So folks that understand KYC, folks that understand anti-money laundering processes, people that understand deeply customer 360 in the context of a bank, and we roll out those end-to-end solutions to really drive return on investments.
Shobit, is that when you adopt a frontier model, is that the way it goes?
Yeah, so the way we've done this in Citi, we have a Citi AI platform. That's the only way you get to any LLM.
Like built on an LLM?
No, so the platform itself exposes all sorts of partner LLMs for us. We have to have a very, very scalable, the scale at which we are is very large. We need to make sure it's multi-model. We need to make sure it's multi-cloud. We need to make sure it's super simple to tap into. And all the governance has to be baked into the platform from design, right? So for us, we have our own benchmarks of figuring out what models are suited for what kind of use cases, and we can keep running them. Models change every few weeks, every few days, months. We need to make sure that we can run all of our tests and come up with our own scoring against one of them. So we have intentionally made sure that we can swap models in and out. Our moat comes from the context of the business, like context engineering and ensuring it understands how we need it to be done in a particular way. When AI is making some content, we need to make sure the checking of the content is also automated. There should be human in the loop looking at all of that end to end. So we've looked at this end to end, ensuring that we can pick and choose from the best partners that we partner with. The models are just so competitive. The pace of intelligence is so rapid. We want to make sure that we're able to partner and bring that intelligence to the fingertips of all of our colleagues, as well as all the big use cases. We're doing a lot to make sure we have common capabilities that are built out. We should not have each group across the company go partner with different vendors to go do document comparison. One central place on where we do this, that capability gets better and better as new models come in, as our partners innovate more. But you have one central place. So then I can have one place to make better, one place to govern, one place to approve. So from a risk standpoint, it makes a lot more sense to do it centrally and have a multi-model strategy around it.
We unfortunately have to wrap it there. I got through like 2 of my note cards, unfortunately, but there's a lot more we could talk about. I want to thank everybody for listening and watching here and getting in touch with us, and then everybody also who's watching at Bloomberg.com and on the Bloomberg terminal. A big thank you, Marjorie and Shobit.
Both.
Thanks so much, Tim.
Have a good morning, everyone.
Please welcome to the stage Rudina Cesari, founder and managing partner at Glasswing Ventures, for a conversation with Bloomberg's Carol Masser.
Good morning, everybody. How's everybody doing? Rudina, Thank you so much for doing this with us.
Thank you for having me.
We're going to try and cover a lot of ground in the next 10, 12 minutes. But I want to start with the macro because I feel like it's kind of remiss if we ignore the elephant in the room. And obviously, we continue to see policies that impact the investment world, our world at large. How does any of this stuff factor in as you think about investments? You've been investing for a long time, seen different cycles, different White Houses. Does any of this impact kind of your investment decisioning or decision making right now?
Thank you, Carol, and good morning, everyone. So I'm an early stage investor at the very edge of artificial intelligence and frontier tech for enterprise and cybersecurity. And it's an environment of change. And change can be good and change can be disruptive. As far as AI adoption, we're only in the beginning innings of its adoption. Regulatory environment is as loose as it has been in a lot of years. So that in many ways opens up the door for investments. QSBS, for example, qualified small business stock, being an opportunity to it's loosened its definition and made it easier to obtain that with the goal of spurring more innovation. And then, of course, there is overall uncertainty in the political environment. So it's a lot of change in both directions.
A lot coming at us. Regina, when it comes to AI, you've been a long-time investor. In terms of AI-related opportunities, how much stuff is coming across your desk? And how much of it is it, can I say crap, or how much of it is actually you think, okay, these are opportunities?
So a lot, because effectively everything that we do going forward will be at a minimum AI enabled. I caught a glimpse of the prior panel when they were talking about building on top of the LLMs or the foundation models or frontier models, I think I refer to them as such. If you think about it, any type of tool we use, whether it's in our personal lives or in our business lives, will have a layer, will have a wrapper that's human-like interaction, human-like experience. That right there and there has been impacted by AI. That's actually not an AI company, that's an AI wrapper, that's an AI enablement, and every interaction from shopping to your personal finances will be impacted by that. What's coming to my desk is more qualified opportunities, I hope.
Yeah.
Particularly around vertical AI, so vertical industries where deep domain expertise is needed, where you can have unique moats and defensibility around the data and around the proprietary potentially models or unique models to the vertical or the problem at hand, so that the large incumbents can't respond easily.
So I want to get into more of what you mean in terms of vertical AI, but in terms of the horizontal players, the large language model players, whether it's your OpenAI, ChatGPT, whether it's Gemini, whether it's Anthropic.
Mistral, let's nod to them.
Right, the companies that we are talking about day in and day out, lots of money going into them. Is that the opportunity going forward, or is that just providing for the opportunities going forward?
That is providing for the opportunities going forward. And again, I'm going to try to balance not to be too techy, but what we are seeing is a rebuilding of the technology stack. So, these models are the very foundation. They just sit right above the hardware layer of infrastructure. They're really the software or the AI infrastructure for this stack. Above it, we will have, and we do have already, the middle layer, which is tools that help get you from, okay, I have access to a model, what do I do now, to that application layer. But the real opportunity set is at the application layer, very analogous to what we saw with the cloud, where we have AWS and Azure and others, GCP with Google, but it opened up the opportunity set for a whole new class of SaaS companies, which they are challenged. That's the nature of disruption. But it created an entire ecosystem from NetSuite to Workday to you name it.
You did say on our planning call that there's a war around AI,
yes.
And you talked specifically about these horizontal players. And your point was they're going to take us so far, but not far enough.
Correct, because it's both a business reason and a performance reason. The horizontal players, the foundation model players, have actually ingested all of the web data. So horizontally, it's extremely difficult to compete with them, and they seemingly have access to capital that feels like unlimited. Anytime they want to raise, they've been raising, and we can have a whole different discussion on how many players can this market support. But fundamentally, that's been done. If I am going to disrupt the freight shipment industry. I have a portfolio company called Ship Angel that's doing just that here in New York. And, take us from the 1980s, where literally if a brand is shipping any good from any part of the world, what they are doing is looking at a piece of paper with rates, who knows if they're accurate or not, calling somebody to book, and then they receive, the invoice, and they don't know how to audit it. There is no way. That industry is vertical, it's narrow. I don't see OpenAI or Anthropic going after it.
So the mass aggregators of data, the large language models, that's not the value going forward, is basically the point.
At least for investors, that's my point.
All right, so what about then the software companies? As the AI scare has made its way through the market, through different sectors, it's been a little crazy. What about the software space? But are they the ones who can be opportunistic because of their vertical data sets or their unique data sets? Or do they have unique data sets?
AI is software, just saying. So I think this notion of old software and new AI, there's a little bit of misnomer going on there, but fundamentally it will depend on whether incumbents can disrupt themselves. It comes down to that. If you are Salesforce and you coined the term AI agents, and yet, you are challenged in all different directions, can you disrupt / innovate / acquire faster than the two guys in a garage, vibe coding from scratch, getting to revenue overnight, and who's going to win? So it becomes some about performance and a lot about execution.
What about something like Anthropic? They've just recently announced, it was just this week, updates to Claude Cowork. And it is extending abilities into things like human resources, investment banking. This is all through plugins. Yes. And what's interesting is they worked with companies like FactSet Research, S&P Global to make these capabilities possible. So what's to stop them from using that knowledge and kind of running with it and kind of taking over and making those companies obsolete? And these companies feel like they would rather be inside the machine than outside. Right. So they're saying, let me work with you.
We're asking the same question we should have and would have asked when the internet and the web was invented. So yes, it's a disruption, therefore it will give a rise to new companies and new opportunities. But the Bloomberg terminal didn't go away when the web, I remember I was an investment banker in a past life, we would go to the terminal, it didn't go away, right? It became
because we're really good.
Truly. But it became web enabled. So I come back to the notion of, yes, there will be new players. By the same token, there is an opportunity for the existing players to disrupt themselves with their unique data and automate your workflows. Right now, if you want to win in AI, it's about automating workflows.
What's a recent investment? So explain this vertical AI. So you have to be thinking, you're early stage, so you're thinking 5 to 10 years, this is a company that's going to be around and maybe disrupt the disruptors. Yeah. So give me an idea of a recent investment.
Happy to. So, and I'm going to pick one that's hopefully relatable to all of us as humans. Pharmacy prescription fulfillment. How much fun do you have when you have to deal with that and prior authorizations? I mean, it's a very antiquated process or workflow whereby the doctors, 20% is handwritten, 80% is digital faxes. They literally get faxed. Then it gets into the pharmacy. Depending on which pharmacy it is, they have many different systems. They have to input it from scratch. Then if it's a prior authorization, it has to go through a whole process. It's messy as messy can be. Well, with AI, you can actually automate a lot of the workflows from needing to call. You can now have an AI engine calling to, or, an agent, all the way to how you replenish 30% of the drugs that actually do not get picked up by the patients. So it's a multi-billion-dollar workflow filled with waste and difficult experiences for the patients and for the providers. Go for that.
What about the financial industry? What should they be thinking? I mean, they are obviously super familiar with data, with algorithms, with AI for a long time. But what does it mean for this space specifically?
That our roles changed and changed dramatically. So Claude Cowork came out about a month ago. I sat down over the weekend last Sunday and played with it, as I like to say, for a couple of hours and literally updated the entire mapping of the entire AI techniques, architectures out there. My job is changing. Our jobs are changing. We're no longer going to be number crunchers. The number crunching is going to practically happen on its own, whether it's a Claude or something else. We are going to be interpreters. We're going to be more empowered decision makers. So what I will say is, there's a big fear around jobs. I'm not worried about jobs going away. In fact, any research you see indicates that there will be more jobs, especially financial services. Our jobs, though, will change. And where will we be in that restructuring of our roles? An analyst will be a lot more about interpretation, will be a lot about this collaboration between human and machine or human and AI to deliver different outputs. So we need to be retrained.
Just last question in terms of your advice, a takeaway, because I do think about anyone who's here. I keep hearing about dislocation. Older folks might have some problems kind of making the transition. I hate to put an age thing on it. But you had a great piece of advice, and I know I've done this with my 22-year-old. What do you suggest?
I suggest hanging out with the 25-year-olds. They're mature enough to kind of have some level of sense of what's right and wrong, I hope, but very young enough to actually adopt new tools and think differently and not be bound by it has been done this way, therefore it should continue to be done that way. Their naivete is an advantage in these types of disruption and transformation.
Covered a lot of ground. Hope you guys enjoyed it. Regina, thank you so much. Really appreciate it. Regina Cesari, everybody. Thank you so much. A glass of reinvention. AI impact. I want to bring out another guest. Rich Bowman is with us. He's AI operations specialist of emerging platforms over at NASCAR. Please welcome Rich to the platform. Good to see you.
See you as well.
So I'm going to do the same thing I did, starting with just the macro. And then I want to get into what you guys are doing with AI. Because I do think there's so much coming at leaders, investors every day. Markets react sometimes, and sometimes they don't. But when you think about the constant things that are coming at us, how does it impact any of your decisions that you're thinking, whether it's investing in technology, doing things with your workforce, whether it's AI? What do you do? Anything changing?
Yeah, so there's certainly a lot happening right now. There's a lot in the headlines for sure. At NASCAR, we are laser focused. We are committed to growing our sport. That's our goal for this year for sure. And everything we're doing is pushing that down the field. And so whether it's what we're doing on the track, off the track, everything is going towards how can we grow our sport? How can we get in front of more people? How can we make it more exciting? And our AI initiatives are a big part of that. And so I'm excited to get into what we're doing and how we're using AI to really help transform our company.
How big a part is it? Tell me about a little bit the conversation about how you guys are approaching it.
Yeah.
Is it all in, everybody, top to bottom, bottom to top?
I think we want to make decisions that make the most sense. You know, I think in 2024, it was kind of the year of the wow. We were just exposed to what AI could be, and there was a lot of excitement around that. 2025 was kind of the how, and so we were like, okay, how do we integrate this? What do we have to have in place to make sure that there's kind of this front door to a lot of our AI tools? And then 2026 is really the now year for us, where scaling up is our goal. And so how can we get this tool, this artificial intelligence, into the hands of our people who are already doing great work, help them to do greater work in fractions of the time? That's the goal for this year.
And it's really easy, right?
Absolutely, super simple. You know, one of the
No, I was being sarcastic.
Oh, well, you know,
or is it easy?
Well, I think you realize, and one of the things that we realized at the company was this, that there were people already jumping into these technologies before we even stood them up as an enterprise. And so a lot of that moved our decision. Like, where are our people right now? What do they actually want? Where do they feel comfortable? And how can we come alongside of them and empower them to do better work?
So, Rich, give us an idea of what you guys are playing with, what programs, what LLMs. Give us an idea of the process and who's doing what right now, who's kind of playing, who's maybe getting more serious in terms of workflow.
Yeah, so we've partnered with OpenAI, so ChatGPT, and we are setting up our organization to be able to have each and every employee at some point in the future where it makes sense to be able to utilize that with their work. As a matter of fact, I think when you start your day one at the job and you get that laptop, you should also receive a contextual way of using AI for your role. And that's where our goal is. How can we equip you from day one being AI enabled?
So where are you in that process? And tell me, like, give me an idea of people, what they're doing, and if anything has already had an impact.
Yeah, so we have, I would say, around 500 users who are playing around with AI.
Out of how many at NASCAR?
I would say we're looking at maybe around 1,400. And
Okay.
so we want to do things that make sense. We want to do things that scale well. We want to build good foundations. As AI tools come out, we want to make sure that governance is in place and that people feel empowered, but also competent when it comes to using these tools, that we're not just giving everybody a race car, we're also giving them a license and giving them training to get that license. And we're seeing reductions in the most repeatable tasks, which represent the majority of the work that most of our people are doing. And so it's been great just to see and experience how much people are enjoying and seeing how much more work they're getting done.
How do you think about individuals who might be like, I'm not so into this?
Yeah, I think, you know, NASCAR is a sport, been around for over 80 years. You don't get to that place without having the ability to pivot and adapt when the technological landscape changes.
Yeah.
The current wave right now is AI, and we are already adapting to that. And so we are making sure that this is, the two engines that are driving everything we're doing in AI is this proven to be effective, and is it inspected to be safe? Those two engines are driving everything behind our AI tools.
I want to talk to you about governance issues, because there's governance for the company. There's governance, for the customer. There's governance for the workers. If you're a publicly held company, you think about governance for investors. So how do you kind of get around that? And I think we're talking a lot about that, considering the spat that we've seen between Anthropic and the Pentagon. And what's interesting, even this morning, OpenAI came out and said, yeah, we want, now that they've kind of come in to say, we'll work with the government, but saying we too want some guardrails, especially when it comes to mass surveillance of U.S. citizens. So how do you think about that?
Well, I think these stories should cause everyone at every company to think about AI governance in a way that speeds up our attention to that idea way faster than we've been doing in the past. And I think for the most part, you get a sense that governance is the brake pedal when you front load all the tooling. So you want to make the headlines, you want to get that sense of speed, and so you might push tools that have not gone through that governance, and then it'll seem like this is going to slow us down to have to circle back and check to see. But if you front load that governance, if you say, hey, we're going to inspect this tool, we're going to understand how we're going to deploy this, who we're going to deploy it to, who's going to manage that, it really gives the freedom at the end for people to be able to utilize that tool in a way that they know is safe.
You said something that was really cool to me on our planning call, and this whole idea that basically every employee, certainly with agentic AI, becomes a manager.
Yeah.
And so not everybody is we've all worked with people who weren't meant to be managers. But having said that, like, there are skills with managing people or processes or workflows, correct?
Yeah.
Or an agent, an AI agent.
Yeah, yeah. And I think the faster we realize that that is what's happening when we offer these tools to our employees, I think the more robust we create on-ramps to things like managerial roles, because there's a lot of experience you're getting in how you deploy your AI alongside your work. How are you positioning it? How are you setting it up to be in your workflow will really speak to how you might bring in a human being to do the same.
You know, what's interesting, too, that you said to me, you know, you mentioned you're working with OpenAI, ChatGPT, but you talked about bringing in a partner to develop department-level champions.
Yeah. And so one of the things that we
I think of a race team, right?
Yeah,
and to some extent,
absolutely.
you've got folks who are kind of championing everybody.
Absolutely. And one of the things that we all have to realize is that there are people in your companies right now who have amazing ideas when it comes to whether it's just using the chatbot or even some agentic stuff, some custom GPTs. What's beautiful about our partnership is that when we bring in a partner to help us do that, we're saying, go in, look at our people, research, find the people who are not at the intermediate level, the people who are at the advanced level, really pushing the envelope, really coming up with some really interesting use cases. We take that, turn it into a playbook that we can then distribute to other employees. So now we have repeatable workflows that continue to increase the ROI we're already spending.
You already see that.
Yeah, absolutely.
How long does this process take? And I'm curious about expectations and having realistic expectations about putting this into effect, having all workers, it sounds like, or most of your workers at NASCAR doing it. What's the expectations around that, and what's the timeline? Because the world is moving really fast.
For sure.
And I just think about the AI discussion that we're having, that we've gone very quickly, you know, from building out the infrastructure, spending on chips, it's still happening, to inference and agentic AI. It's moving rather quickly, and so I'm just curious how fast you guys want to do this, and what's your timeline?
Yeah, you know, at NASCAR.
At the same time, people will say, forgive me, that we still don't know a lot.
Correct.
And we don't know about kind of what's the smart impact of all of this.
Yeah, and I think the best thing that we can do right now is we need to investigate, find what works, deploy that, be skeptical about the things that we're not so sure about, and to have the courage to delay things that won't stand up to the enablement governance plans that we have as a company. Obviously, we want to move quickly, but at the same time, we're not willing to sacrifice safety for that speed. And so the industry speed is something to definitely observe, but not necessarily one to copy if it compromises us on the governance end.
Any advice to the folks that are here as they think, I mean, it's an investment audience, you think about this process, the things you need, any kind of final thoughts?
Yeah, I would encourage you all to really think about AI cross-functionally. And so it's not just for your IT departments, it's really for everyone. And so I would encourage you all to talk to your leaders, get them together, figure out what use cases can be.
When you say leaders, is it your C-suite involved in this?
Absolutely.
So go ahead, yeah.
Yeah,
Okay.
C-suite, your departmental managers, how are we coming together to look at use cases and ways in which AI can really take us to the next level?
All right, we're going to leave it on that note. Rich, thank you so much.
Thank you.
Really appreciate it. Rich Bowman of NASCAR.
All right.
Thank you so much, Rich.
Thank you.
And thank you, everybody. That is, I think, our innovation stage. So I want to thank Invesco QQQ for sponsoring the innovation stage. And right now I want to just I suggest everybody go up to hall number 2, and that's where the rest of the program of the day will continue. Mark Rowan of Apollo, of course, the CEO, and a lot of other great names. We'll take it from here. Thank you, everybody.
Please take your seats. The program will begin in 10 minutes.
stock shortage on the modern ways. You always found a peak on a flat bank. My song is yours.
I hear the bells, I hear the wind, I hear a song in my heart again, and the tenderness moves all things like a poltergeist in the streets. It's a silly rush that I used to get, singing Billy or reading Vonnegut. I could teleport to the stars, kinda strange that I'm all alone, 'cause you really hold me down like that, 'cause you really know it's down like that, like the universe is singing a song. Ooh, ooh, ooh. Do you feel it when you write like that? Do you feel it 'cause you're down like that, like the universe is singing a song? Ooh.
You can take the throne, body flows like gold, beating hearts like clothes. Without you
Please take your seats. The program will begin in 5 minutes.
Cause I don't wanna be much. I love the way that we touch. Do you like all of my friends? I want your attention. Before you never mention that you got time instead. Is that too much for your brain? But if you have to go away again, I just don't see you enough. I wish I saw you enough. It's something in the way I need your skin. I just don't see you enough. I wish I saw you enough. But if you have to go away again, I just don't see you enough. I wish I saw you enough. But if you have to go away again, I just don't see you enough. I wish I saw you enough. It's something in the way I need your skin. I just don't see you enough. I wish I saw you enough.
I broke my back 'cause I thought you would too. I'd run in circles, I thought you would too. Maybe in another life everything worked out alright, and things that made this harder passed us by. But there's no bad dream to wake up from. No, I got it bad when it's the morning and you're all that's on my mind. If I don't have you, at least I still have.
Please take your seats. The program is about to begin.
And if I don't have you, at least I still hurt me. I never thought twice, 'cause you were my number one. I put you first 'cause you were my only thought. No more riding on the train, no more smoking in the alley. Now my secrets only stay with me. Everybody knows I'm upset, they don't even have to ask it. They know I believed in us last week. And if I don't have you, at least I still have me. And if I don't have you, at least I still have me. There's no reason to speak bad name. We just reached our end. I will see you in parts of me, in who I was back then. If I don't.
markets have become a defining feature of global finance.
I see a couple of people doing some dumb things.
AI is going to be so disruptive that it renders countless businesses obsolete. I sincerely believe there is no bubble in the AI space. We are in the midst of a rupture, not a transition.
We call him too late. He's too late. Jerome, too late, pal. He's too late.
Please welcome to the stage Bloomberg's John Micklethwaite.
Thank you very much, and welcome to music's still going, and welcome to Bloomberg Invest New York. This is the 9th edition. We always like journalistic metaphors of Bloomberg Invest, which is our marquee gathering for leaders across investment and finance. Each year, we convene the allocators of capital, the builders of companies, and the managers of risk to make sense of a world that never stands still. And if you want any more evidence of that, you only have to look at the past weekend and the US-Israel conflict with Iran. And that's a stark reminder of how assumptions can be rapidly turned upside down. Just look at what's happening to Brent crude this morning. And if it's not Iran, it's the trade tariffs, it's the broader reordering of geopolitics around the world, all the worries to do with debt. There's persistent uncertainty. So our questions are, where will the growth come from? How do you price risk? And where are the opportunities amid all this disruption? At Bloomberg, trying to answer those questions is, in a sense, our day job. That's what our 3,000 or more than that, journalists and analysts in more than 100 countries try to do on a daily basis. Our mission is to deliver accurate, fast information that you can make decisions on with confidence, we hope. And Bloomberg Invest is the sort of live extension of that mission. Today is about insight, candor, analysis. Thank you all for joining us. Let's begin.
Please welcome to the stage Bloomberg's Lisa Abramowitz.
Good morning. Welcome. It's so good to see you all. I am going to hand it back to John. He has an incredible guest lined up, as we have many incredible guests. Next one will be Apollo's Mark Rowan. After that, I'll be speaking with Dawn Fitzpatrick. She's the CEO and Chief Investment Officer at Soros. We'll also be hearing from the Ares CEO, Michael Arrighetti. Many more, including Minneapolis Fed President Neil Kashkari. From those of you in New York today and tuning into the live stream around the world, we are so glad that you're with us. Before we get started, I want to take a moment to acknowledge our sponsors. Title sponsor, Invesco, QQQ. Our knowledge sponsor, Marsh. Our supporting sponsors, Allspring Global Investments, Deutsche Bank Wealth Management, Harborview Equity Partners, Moody's, and Salesforce. For those of you in person today, please scan this QR code. This code will take you to a landing page where you can find our Wi-Fi information toward the top, plan your agenda, and join the community. If you want to know who is in the room today, to connect our scheduled meetings, you will click on that icon. It will prompt you to download our event app. This app will also allow you to receive the agenda and subscribe to any sessions relevant to you and receive push notifications. If you have any questions about the Attendee Hub, of course, we have the help desk, help. We want to hear from you today. There's also a tab you can click submit questions, and you can potentially get your answers heard on the stage. You can find more information on our sponsors here. If you don't already subscribe to Bloomberg.com and all our global finance coverage, today is your lucky day because you can get a discounted subscription. If you are active on social media, use hashtag Bloomberg Invest in your posts, and you can follow along with our coverage at Bloomberg Live on all major platforms. Lastly, please silence your phones. Now, let's get to the real stuff, the program. And I'd love to first have a little bit of what our next guest has been up to over the past year. Take a watch.
The reward for good origination is people want to invest with us. We miss secular change. Technology change is going to cause massive dislocation in the credit market.
Please welcome to the stage Mark Rowan, CEO at Apollo Global Management, for a conversation with Bloomberg's John Micklethwaite.
Mark, thank you for doing this.
Always a pleasure.
I was just saying outside that when I just looked back in 2010, you had around 70 billion in assets. Now, as we said, closing in on $1 trillion. Should we start with kind of current affairs? You've got the conflict in Iran. I suppose we can talk about the geopolitics, but on the basic question about what it's doing to the markets and the economy, how do you look at that?
It's disruptive. I mean, we've had this, you know, our refrain on this has been, if you look at the numbers, things are great.
Yeah.
Everyone has a job, the capital spending is off the charts and very conducive to future employment. Government policy is very accommodative. Capital markets are wide open. That's normally 95% of what you need to worry about. But now, as we've been saying, it's only 70% of what you need to worry about. The other 30% is geopolitics, it's government borrowing, it's excesses in capital markets, and it's technological change. None of this is unexpected. It's just here.
How do you rate those? I mean, do you worry about the Iran thing, say, more than all the trade disruption?
Personally, not really.
Yeah.
I mean, we always have an overreaction to the confrontation of problems. But this is a problem that needed to be dealt with, and if it were dealt with in other years, it would have been more difficult. And so the notion that it's being dealt with today, in some ways, is reassuring, notwithstanding the current instability.
Just going through that list of things you had government borrowing. Is that something that worries you particularly at the moment?
It's not something to worry about, but it is something to watch. We have seen points in time when investors have called countries to account for their fiscal picture. We saw it most recently in the UK.
Liz Truss.
The departure of Liz Truss. And we have pretty much every government in the West spending more money than they are bringing in, with no sign that they are letting up. And so there is nothing that says this will end soon. Japan did it for nearly 3 decades. And so it's just something to watch. Normally, that kind of borrowing is inflationary. Normally, the restriction of the free flow of goods is inflationary. Normally, the restriction of the free flow of labor is inflationary. But we just haven't seen it. Having said that, if you're a credit investor wearing your credit hat, you don't get paid other than your coupon and your principal.
Yeah.
You look at the surrounding facts and you say, this has been a good time for risk off.
Yesterday, Jamie Dimon talked about inflation being the skunk at the party. Is that the way that you look at it?
Not so much the skunk at the party, but let's face it, we've had very accommodative capital markets. Notwithstanding the backdrop that I've mentioned of things that can be inflationary, we've seen rates go down. We've actually seen curve steepening. To the extent we saw a tick up in inflation, that would probably handicap the Fed's ability to further push rates down.
We just go into credit, these big arguments. And it strikes me there's kind of two levels of it. The first question is, do we think that there is more kind of laxness in the overall credit markets? That's what people, Dimon talked about, Lloyd Blankfein talking. And then there's the particular question of private credit. But just to look at those two, first look at credit as a whole. How worried are you about that? I've seen you say that actually the numbers aren't too bad, but how do you look at it?
So I don't spend a lot of time worrying about it. Companies are in pretty good shape. Consumers are in pretty good shape. This is not just in U.S. This is pretty much around the world. Ironically, right now, it's governments that are not in good shape.
Yes.
Having said that, we're at the end, potentially, of a very long accommodative cycle in credit. And in every cycle, you have people who move out on the risk curve, who ignore things that are obvious. And it all feels good while it's happening, and then it doesn't feel so good once it arrives. Well, some of those changes have arrived. I mean, lo and behold, we think that AI might impact software. Is that news? Did we just discover that 2 weeks ago? But apparently 2 weeks ago, we discovered that AI is going to impact software, and we've been in a massive risk-off mode. And so software stocks are down almost 70%. I remind people that software first lien is senior to high yield bonds and is senior to equity. So if you're going to have a problem in software lending, you're going to have a problem in equity, you're going to have a problem in high yield, you're going to have a problem in bank lending and broadly syndicated and everywhere else. Because to your second point, credit is just credit. There are good underwriters of credit and there are bad underwriters of credit.
Just on that point about tech, is that as I read it from what you've said, you were nervous about software before 2 weeks ago. But on the other hand, in terms when it comes to kind of digital infrastructure, there you're still fairly, you're less cautious.
So I'd say I'm going to give you a more specific answer because it requires a more specific answer. In our private equity portfolio, which is not the subject of this, we have zero software.
Interesting.
In our credit book, across the totality of the firm, it's a fraction of assets. We run a broadly diversified credit book that is not concentrated in software. The problem with software is that it was 30% of the levered buyout market, therefore it was 30% of the levered lending market, and therefore it is just overrepresented and subject to attack. But we should not deny that change is coming. And change is not coming just in data centers and AI. As a world, we are building infrastructure, we're building energy, we're doing energy transmission, we're building next-gen manufacturing, we're ramping defense, and we're doing this thing called AI and data. We're essentially spending every dollar since the creation of fire, and we're doing it all at once.
Yes.
And whatever we're doing in the US, they want to do in Europe, and they're not as well prepared to it, and they're doing it in the Middle East, and they're doing it elsewhere around the world. We will see the largest need for capital ever. And that's what we've seen so far this year. And so now to your specific question, it's about underwriting. There are a number of very strong US tech companies who run diversified businesses, Amazon, Google, Microsoft, who are interested in seeing these centers built and are interested in not consolidating the debt on their balance sheet. And to the extent they are prepared to lend their credit, one can lend against those types of things and make sensible underwriting decisions. There are those who are more equity story oriented, where it's maybe not as sensible an underwrite, and good underwriters pick good credits and bad underwriters pick everyone.
You and I, though, have lived between us through a lot, I think we're almost identical ages, Rob, strangely. But we've lived through many iterations of kind of credit coming and credit going. So when you talk about these individual decisions, like, is it good to be in digital infrastructure at the moment or not, that matters, but so does the overall picture. And the one you just explained, where you said there's all this money going into energy, going into AI, going into all these different bits. Does the bill for that either end up with taxpayers or does it end up with banks and credit institutions?
So again, a longer answer than you probably want here, but the banking system is incredibly delevered and very diversified. I think it's in the best shape I've ever seen it in my 42 years of professional career. And then we get to the so-called public and private markets.
Yeah, that's
private and public are just variations of the theme. The vast majority of the private market is investment grade. There's a $40 trillion market, and 99% of the headlines are focused on a little slice of $1.5 trillion called levered lending. Levered lending is a below investment grade activity. If you trace the history of this, in 2008, levered lending was on bank balance sheets. Post GFC, banks distributed this credit. On the one hand, you had the CLO market, which took credit off bank balance sheets, particularly less than investment grade credit, and distributed the risk to investment grade buyers on a senior basis and to below investment grade buyers, high yield buyers on a junior basis. Then credit was also distributed to private market BDCs. Banks again supported them, but at a very safe tranche, and investors, private investors, retail investors, institutional investors, came in to support private BDCs. And now we look at it and we say, well, credit is going through a cycle. Is that good or bad? And the answer is relative to what? And this is the point that people often miss. Credit is the formation of credit, particularly in these private BDCs, is a de-risking activity for the economy and for individuals. It's de-risking because it moved it off bank balance sheets and essentially democratized it throughout our economy. And it's de-risking for individuals because people are not funding their investments in these BDCs with their treasury portfolio. They're selling their equities. Last I looked, first lien debt is senior to equity. They are making an intelligent decision that they can earn equity-like returns without equity-like risk and take money off the table. That does not guarantee success. You can have, if you own software stocks, you're really unhappy. If you own mostly software first lien, you're really unhappy. You're just less unhappy than if you own the equity. We can't legislate out of existence stupidity.
But the underlying system you're arguing is safer because it's allocated to individual companies and it's not leaking back into the fully leveraged part of banks.
And that's what, in some ways, we can say the post-regulatory reform of the GFC worked. It's doing exactly what it was supposed to have do. It has socialized this risk. It has given investors another thing to invest in, which is actually de-risking for them. And it has moved it out of the levered, government-guaranteed portion of our economy because we made a choice, and we've made a choice going back to the formation of Drexel. Below investment-grade companies have been a massive source of growth. Private companies have been a massive source of growth, 80% of jobs. How are they financed? Well, they weren't really financed. They were cast out from the marketplace. If we want them to be financed, there's only two places they can get financed. One is the banking system. The second is the investment marketplace. If you're concerned about what's happening, you don't want it in your banking system. You prefer it in your investment marketplace where people can price the risk.
So to the extent there are problems in private credit, you would argue it's a little bit more like the dot-com problems of years ago, where it's really an equity play rather than a debt one, so there isn't that gelignite of leverage going through things.
Almost every investor is not a levered investor in the private credit ecosystem, but we've also, we have this habit of throwing the baby out with the bathwater. All the press is focused on this levered lending portion of the market. As I sometimes remind my partners, as a deal shop, we don't get to be that big. Because although we're doing something from an efficiency point of view, we use up a lot of social capital. On the other hand, the vast majority of the market is private investment grade, which is also called private credit and has almost nothing to do with what we're talking about today. So I think I try to be careful in using my language to make sure that we understand most of the capital going into private companies is actually going to finance this global industrial renaissance which is taking place around the world. A lesser amount of capital is going into the deal business, which is primarily being funded by investors or by institutions who are making a decision to sell their equity portfolio to invest in credit because they offer about the same rates of return. And by the way, we have 10 companies that are 40% of the S&P. We're not even a, quote, qualified market at this point. We're too concentrated.
there is this issue, there isn't there, that private people, consumers are trying to get involved in this, and you've pushed into kind of retail 401ks, things like that, which they're investment grade. That's what they're looking at. Some people say that Apollo was a buccaneering shop. It was all about being at the forefront. The more you get pushed back into these investment grade debt and stuff like that, or you might say expanding into it, do you worry that limits the kind of risk appetite of the kind of people you want to bring in?
I don't think so. I think what happened in our market, if you go back again to the history, going the 80s and the formation of Drexel created the high yield bond market. It basically provided capital to these companies. The banks responded with levered lending. All of the brain power in the financial marketplace left the investment grade market, and everyone wanted to do levered lending and high yield bonds because that's where the money was, that's where the excitement was. And it didn't come back into the market. The investment grade market is a drive-by market with very low compensation, with very low creativity. What we've done starting 17 years ago with the need to create investment grade for our captive insurance carrier, Athene, and for others in the insurance market, was to put creativity and intelligence back in the investment grade market. No one is bored. I can tell you that this is not now a question of they're no longer buccaneering, so they don't enjoy being there. The ability to be creative in the investment grade market is at a scale that's almost hard to imagine. So if you think last year we originated a little over $300 billion of new investments, mostly credit. 80% of that was investment grade. I assure you, no one is complaining about the lack of buccaneering.
But there's one good thing about what's happening out there, is you could argue that finance has moved into private markets, moved into non-bank. What's happening is consumers are now getting a chance to participate. But there is a kind of trade-off, isn't there? That the more this is giving them a chance to participate in these higher yielding areas, which you've pioneered. But some people will say there is a degree of risk in that, and at some point that could cause problems.
There's always a degree of risk. Yeah. So I come back, and no investment offers you a free lunch. There is no free lunch. You can take equity risk, you can take credit risk, you can take duration risk, you can take all sorts of risks. The question is what's appropriate. But if you look around the world, every place that private assets have been added to public portfolios, you've gotten better outcomes. And if you go to the extreme and you take retirees, for instance, in 401k, an extra % compounded over the duration of how long you're going to be in there is a 50 to 100% better outcome by having better investments. And what are they invested in today? Well, they're invested in daily liquid index funds for 50 years. Is that risk-free? No. We have 10 companies that dominate the S&P. We've essentially, as I sometimes joke, we've levered the entirety of the retirement system of the US to NVIDIA. So far, that's been good. It's not always going to be good. Public is not safe or risky. Private is not safe or risky. They're both safe or risky. They're just differing degrees of liquidity.
I suppose it's this, is that traditionally this kind of slightly riskier on the face of it lending has been outsourced to professionals like you and to people who know what they're doing. The worry is that suddenly you're now getting, in Britain we call Aunt Agatha, coming into these markets. That's more worrying.
Look, we're going to have a correction, but it's no different than the correction that's happening in banking. If you look in banking, the dominant banking institutions of today were not as dominant pre-crisis. Those that sat out the subprime lending have arisen and become magnified in terms of their fortress balance sheet and market share because they were good managers of risk and good managers of underwriting. I believe the same thing is going to happen in investment markets. Investment markets, people made choices. If you wanted a higher dividend, you could take more risk, you could lend to smaller companies, you could do more PIK, you could invest in equity and preferred, not just first lien, and you could run with a lot of leverage. That felt really good on the way up. That's not going to feel so good on the way down. And there are companies, of which we are one, but not the only one, who went all first lien, who went almost all cash pay, who went large companies, who work with low leverage. I like where we sit, and Jamie Dimon said it, there's always going to be fraud, there's always going to be underwriting mistakes, but the question is who's a good risk manager and who's not a good risk manager. If 30% of your portfolio is in one industry, and that one industry is being impacted by technology, you have not been a good risk manager.
I think that I just looked at Blue Owl, I think it was 70% in different versions of tech. There is a parallel, though, isn't there? The way you described the banking industry, it has consolidated, particularly at the top. That would imply the industry you're in is going to consolidate as well, that you will end up with fewer people because, as you said, there is a reckoning coming. Some of those people will have to.
We have fewer people. I mean, you started. I mean, we were the entirety of the companies that you see that are public today. Everyone was 40 billion in 2008.
Yeah.
We're now close to $1 trillion. Blackstone more, KKR a little less. This is not good management, or not solely good management. This is a function of structural change in our marketplace, and that structural change is continuing, and the reward for good work is actually more work. In our case, it's managing more money. And I think that is where we're heading. I think this will be a shakeout. I don't think it is going to be short term. I think the 30% overhang of geopolitics, inflation, technological change is now here. It was foreseeable, not maybe exactly how it occurred, but it was foreseeable, it was predictable. And all you can do is have been a good underwriter, a good risk manager, have done a small number of stupid things. And by the way, we've lived in an environment of tight spread. If you were a good risk manager, you are going to make more money this year and next year if it continues than you ever have before because you've been risk off. And so that's always the bifurcation of minds. First, you want to play defense and make sure, in fact, you've done what you think you have done, which is manage good risk. And then you want to play offense.
Do you think, though, you're going to end up with mega mergers in this bit? I mean, that's what happened in banks at some point.
I don't think so, because I think that we are limited by two other factors. I think our business is will not in the long term be limited by capital raising. It will be limited by our capacity to find good investments and by culture. So unlike a public asset manager who can buy anything any day, we can only grow as fast as we can originate good risk. We actually create. And therefore, if we grow too fast, we start commoditizing our business because we're forced to take things we don't want. And so judging our industry should be judged by our capacity to originate good investments, not by our capacity to raise money. But the second piece of this, and they're directly related, is culture. We are, at the end of the day, an origination-driven organization. Whether our peers say this or not, they are origination-driven organizations. Often we're doing the first of everything. It's very hard to feed the first of everything into a model and get the right answer. We will be more efficient because it will not ignore us, technological change. But the ability to attract the best people, have them want to come to work, have them spend their whole careers at Apollo, is the primary job that I have.
On that, it strikes me, if you look at all the things we've talked about, you're lending money, you're trading private credit assets, we just saw the headline up there, you're building a kind of retail business. At some point, you begin to look very like a bank, with the one exception that you're not taking deposits. Is that really what it's coming down to in the end?
Not really. I mean, what you look at is a bank works with a government guarantee. They take deposits. Yes, they do maturity transformation, and they primarily make money from the capacity of their own balance sheet. We do 2 or 3 different things. One is we don't take deposits. We don't have a government guarantee, but we originate investments and we distribute them. And for a small portion of the investments, generally, as I say sometimes, 25% of everything and 100% of nothing, we keep on our balance sheet to match with our retirement obligations.
Banks do a lot of those sort of things. They will originate loans and then distribute them. It's not that different.
I'll make the comparison slightly differently for you. If you're a public asset manager, you come in every day and you make a decision to buy something, and then you distribute it amongst the accounts that you manage, and then you go home. We kind of do the same thing, except we don't get to buy something in the public market. We have to go find it in the private market. We structure it, we originate it, we distribute it amongst the accounts that we manage, and then we go home. And so everyone in the financial market, if you're not solely a trader, you're an investor. That's what we are at the end of the day. And in the broadest sense, if you think about the drivers of our business today, there are 2 drivers of our business. One, global retirement crisis. everywhere in the world, we are short retirement income. Guaranteed lifetime income, retirement income, is a fixed income obligation. On the one hand, we need to produce retirement income. On the other hand, we have this global industrial renaissance primarily taking place amongst investment grade companies, and we find ourselves in the middle. We originate risk, we put some of it on our insurance company balance sheet, and we distribute the rest to investors and source it for them without maturity transformation, without government guarantees. And I believe we are playing a more important and a different role than most people perceive. And it's not just Apollo. This is the private market firms who have gotten to be sized. You don't get to be sizable in the deal business. The deal business can only get so big. You have to serve some fundamental public good, otherwise you don't get to be big.
You talked about culture, and as you know, Apollo's been drawn into the Epstein thing because your fellow founder, Leon Black, who left in 2021, was part of it. Apollo's done an investigation, said everything was to do with him. And I'm sure this eats up a lot of your time, but just as a sort of general question for you, well, a strange one. If you look back at that whole period, regardless of individual meetings and things, when you look back, now looking at it, what would you have done differently, other than perhaps not having had Leon as a partner?
Look, Leon made his own decisions, and I will not do that. But the answer is nothing. This is whether through good judgment or good fortune. This is not someone I built a personal or business relationship with. It's not someone that Apollo did business with. If a relationship is one meeting over 20 years and a couple of unreturned emails, then that's a relationship. But other than he was Leon's tax advisor, we ran a partnership, not a company back then. Leon's tax position was relevant to my tax position. Other than that, I'm very sorry, and I didn't see what Jeff was doing. Me, I didn't like him for my own reasons. He wasted my time.
But now it does occupy time and questions as well.
Even from the grave, he's wasting my time.
Mark Rowan, thank you very, very much for talking to us.
Thank you. Thank you for having me.
Thank you.
Please welcome to the stage Dawn Fitzpatrick, CEO and Chief Investment Officer at Soros Fund Management, for a conversation with Bloomberg's Lisa Abramowitz.
Well, following that wonderful conversation, you get another one of my favorite people, one of the best investors I can imagine, Dawn Fitzpatrick. She is CEO and CIO of Soros Fund Management, formerly 25 years at UBS. Very curious, before we start, we were planning to talk about all sorts of things that had nothing to do with oil. Yet here we are. I wanted to start with that. How much the past 3 days have upended things or been revealing in terms of how markets have responded to this latest shock?
Yeah, so I mean, you can see the price action today where markets are definitely under stress. And when you think about coming into kind of this week, at a high level, markets looked kind of benign. If you looked at index returns, they were flat to up. But below the surface, we were seeing a pretty violent rotation. Part of what you just heard Mark talk about. So markets definitely felt a little fragile. Then we come into yesterday, and I was surprised that the market rallied back to flat. But I think the realization that investors are coming to now is this is not going to be a couple-day event. This is going to be really, really hard. And I just think market participants are dealing with an enormous amount of uncertainty. You have, obviously, the AI disruption. You have, geopolitical risks. And I just think that, under the surface, there's a lot of fatigue from all of that.
We're going to get into the under the surface in terms of AI disruptions and things of that nature, but I want to start with what has been priced in so far and what hasn't in terms of how resilient the U.S. and, frankly, the global economy are to some sort of, call it stagflationary shock, a big increase in energy prices.
Yeah, well, you see, by the way, around the globe, you're starting to see rate cuts priced out of the market. So Friday, through December, there was roughly in the U.S. about 60 basis points. That's down now to about 40 basis points. And you obviously have seen kind of the 10-year U.S. Treasuries move 15 basis points higher. And from an economic perspective, you're basically seeing a fairly dramatic tightening of capital conditions, and I think that really is kind of worrisome on a lot of different levels.
Does it make sense to you, though, that actually that would be the response for monetary policymakers to raise rates or not to cut rates in the face of higher oil prices?
Yeah, so I think, and you've heard the U.S. Federal Reserve talk about this a little. They like to look through temporary increases in oil. And again, when you look at the impact of oil on the U.S. consumer, it's only about 5% of their spend, but I do think there's knock-on impacts. So I still think, actually, I would bet the Fed cuts 2 times, and I think they will look through this as long as it's contained to under, say, 3 months. But we'll see. I actually think they should also look through, in part, some of the AI boom, because whether rates are 50 basis points higher or 50 basis points lower, it's not going to impact the amount of CapEx that's going on there. And then under the surface, as I mentioned, financial conditions are tightening. I think the lower end consumer is struggling a bit, while overall consumer feels okay. And I think it's a hard dynamic to deal with.
What's fascinating is normally when people think, oh, there are going to be rate cuts, that's yay for risk assets, risk on. The scenario you're pointing is cutting rates for the wrong reason, which is actual weakness, true stress that you're seeing get into the market, whether it's low-income consumer or whether it's these pockets of financial stress. Is that correct? Do you think that the rate cuts won't help add to risk appetite or could potentially be indicative of something more of a problem?
So a couple things on that. First of all, at a high level, I actually think the U.S. economy and the global economy is going to the recent headlines notwithstanding, is going to grow higher than expectations. I do think inflation is moderating. And again, I think rates where they are modestly restrictive. So I don't think it's necessarily like a rate cut into a disaster. I think the Fed has room to lower rates, and in the context of everything going on, I think it would be smart of them to do.
So you don't think inflation is the skunk at the party?
Pardon?
You don't think that inflation is the skunk at the party, as Jamie Dimon would say?
Yeah, I think it's going to continue to trend lower. And I think things like AI, while right now I don't think it's having any effect on inflation, I think ultimately it will.
Meanwhile, the market has been tumultuous under the surface for a while, and we've talked about, and you heard Mark talk extensively about the software concerns and how much that's really impacting private credit in particular. Where are we in that washout? Do you have a sense of how far along in terms of recognizing who the winners and losers are going to be in the software shakeout?
Yeah, and I think Mark spoke to it. When it comes to private credit, we saw the Blackstone headlines overnight. I think that's going to take a while to work its way through the system. I think we're going to continue to see elevated redemptions. I think some of these structures are going to come under pressure. So in publicly traded BDCs, they're trading right now on average at about 23% discount. The private BDCs and the interval funds have to return capital at NAV. And the rotation is going to be redeem those private BDCs and interval funds and transition to the public BDCs. You'll get a higher yield even if the NAV discount doesn't close. So I think you're going to see that. And I think ultimately what happens there is it's going to put pressure for there to actually be secondary sales in private credit. And the other thing with private credit is, not all funds are created equal. Some funds have disproportionate amount of exposure to the software sector. And again, I think within the software sector, this is a structural re-rating that is deserved. So I think really doing your homework on where kind of what kind of exposures the underlying has is going to be really important. I also think investors, big endowments, high net worth are over allocated to private assets. Their private equity isn't cash flowing, and now they're going to have a similar issue in private credit. So I think it's going to be a painful 18 to 24 months.
Let's get to private equity in just a second and how it's not cash flowing and what that means in terms of just investor appetite for the asset class. How much pain is there going to be? I mean, where is it going to be expressed in the software shakeout? You were talking about BDCs and the shares. People have pointed to retail funds, and you said Blackstone, the idea of lifting redemptions to, I believe, 7.5% of the fund, saying, look, we can meet these redemptions. I mean, what's the model for how you view this proceeding?
Yeah, so first of all, I think what Blackstone did was broadly smart. I think when you look at these alternative asset managers, I think returning capital in a way that they promise to investors is going to be long-term. Short-term, it will hurt their fees. Long-term, I think it will massively aid their businesses. And I think there's going to be a differentiation between alternative asset managers who do that well and ones who don't. So I think that's going to be really, really important, keeping your promises to end investors. And I don't think memories are going to be short for managers who don't do that. By the way, if you're a BDC trading at a 23% discount, you should be selling loans and buying back shares. And the only reason you wouldn't be doing that is to maximize your fees, which is really hard to justify. So I think it's going to be really interesting to see how much people stick to kind of fiduciary responsibilities. And I do think it's going to be a culling of the alternative asset managers.
As an institutional investor, do you want to stay away from private asset managers or private credit funds in particular that try to cater to retail funds?
No, so to be clear, we're kind of dipping our toe and buying some of these public BDCs, the ones where we like the underlying loan portfolios. So we're not. It's kind of the opposite. We like to provide liquidity when liquidity premiums are blowing out, and I would argue that this is going to be one of those moments in time. Same thing on the secondary sales. There's going to be great opportunities there. And we're definitely going to be a buyer. We are in a good liquidity position, and kind of looking forward to a little bit of carnage in private markets.
So I hear this all the time. When things start selling off or dislocating, people say, oh, I can't wait for the dislocation. I'm looking forward to buy. And then when things start getting pretty heady, people start saying this time might be different. There's going to be contagion, and I don't know who's going to be potentially exposed. What are the nodes of contagion where you could see this become a bit more systemic and cause concern that goes beyond just the knowable risk?
So there's $300 billion of back leverage on private credit funds through banks. And generally, that leverage, while loan to value is modest, it is mostly mark to market. And those loans generally have not had a lot of mark-to-market volatility. And I think there's going to be regulatory pressure to start remarking those loans. And once they do that, those private credit funds are going to have to come up with cash to meet those margin calls. In most cases, they have some excess cash, but I think those cash reserves are going to run low quickly. So if you start seeing pain or scrutiny on the banks on that lending side, I think that could be a harbinger of worse things to come.
To what extent does it have a risk for the financial sector more broadly?
So, software employment as a percent of the U.S. economy is less than 1%. I think where it plays into the broader economy is where I started. It's general financial conditions. And the cost of borrowing is going to go higher. I do think the offset to that is bank regulation is easing, so banks have more ability to loan into this. And I think Treasury Secretary Bessent made this comment the other day. I don't think Washington really minds that shift from private credit lending incrementally to the banks. So I think that's a partial outlet valve.
One aspect of this is the pain. What about the gain? I mean, how are you seeing potential opportunities, not only as we see the shakeout in BDC shares, for example, but in the AI transition where it's not just going to be losers, but also will be winners?
Yeah, I mean, so even in the public software sector, there's some names that we think ultimately will be winners. The other thing on AI is you see companies who are using operating leverage to spend a lot of money on technology right now. And by the way, JP Morgan initially got criticized for this. I think ultimately what you're going to see is, JP, the Goldmans of the world, the Walmarts of the world are creating a moat relative to their competitors. They're going to press an advantage that will become very, very apparent in a year or two. And I think AI is going to play to the people who are bigger and can make those investments structurally.
How do you want to get exposed to that, right? I mean, this is sort of a question the audience just asked, which is just can you talk a little bit about your asset allocation, but in terms of public, in terms of private, in terms of illiquid, in terms of macro, I mean, how are you sort of arranging this?
So relative to other endowments, we leaned incrementally out of private equity back in like 21, 22 to give and replace that beta with public markets. Again, we might use this moment in time if things get sloppy enough to change that mix. I think in public markets, you're seeing a lot of dispersion. The rotation we talked about from kind of old world real economy that's done really well this year and away from asset light. Under the surface, there are great ways to pick winners and losers at the company level, and you're getting paid for that. So we think being in public markets, having kind of an alpha-oriented portfolio is really important. I think diversification at kind of the asset level also, even though treasuries are going the wrong way now, I do ultimately think that treasuries, will be a safe haven, and having, a reasonable allocation to government bonds is important. On the credit side, we've leaned out of a lot of credit recently, but it's really just to create dry powder for the opportunities that we think is coming.
You use the word diversification, and a lot of people have used that to mean a lot of different things over the past couple of years. In particular, whether it's not diversifying in asset classes, but diversifying in regions. And people are saying they've been going away from the U.S. and going into more underpriced markets. I'm just wondering if you think that trade's done, and we're seeing sort of the shakeout of it right now when it's tested by the potential for an oil shock.
I don't think it's done. I think what happened is asset allocators kind of got lazy over time, and coming into last year ended up way over allocated to the U.S. dollar and U.S. assets, and they're just trying to right those allocations. I think the initial move was pretty aggressive because they realized how offsides they were. I think you're going to see a continuation of that, but I think it's going to be more moderated and modest in terms of the impact. But again, I invariably think people got overexposed to the dollar and are just trying to get back on sides. But I don't think it's necessarily repudiation of the U.S.
Well, and I want to finish up on something that you kept saying, which is that private equity just isn't cash flowing. I love that concept, but it's not giving people the capital to reinvest and redeploy in the same kind of way and to reallocate to private equity. Where is PE in just sort of its cycle, given the fact that we haven't seen exits, we haven't seen IPOs, we haven't seen the kind of monetization of a lot of these investments?
Yeah, so I think there was a lot of hope coming into 2026 that it would be the year when PE starts to cash flow in a really meaningful way. What you're seeing is the IPO market is open, but it's only open for really high quality companies. We had $14 billion in secondary and primary sales last night, but they were utilities and insurance companies. And the other interesting thing about private equity is historically, when private equity monetized an asset, you'd get like a 20% bump. Last quarter, monetizations were flat to down and I think that's a little bit giving up the ghost. On the plus side, 2026, you are going to see some mega IPOs. Unfortunately, these aren't necessarily companies held by private equity. But, rumor is you'll see OpenAI, Anthropic, SpaceX all go public. By the way, to put that in context, any one of them alone would be the largest IPO ever. In aggregate, if you get 10% float, it's about $250 billion of IPO proceeds, which is more than the U.S. had in aggregate since 2022. I think that's good in a lot of ways in that it will clean up those cap structures. It gives them access to capital markets in terms of heavy spend. But that money is going to have to come from somewhere, and that's why you see like a really hard fought to get included in the indexes, which again will create natural buyers for those companies. But there's another side to that. It will mean people have to sell the other names currently in the index. And if you look at historical data, when you get a really big pop in IPOs, generally 6 months forward, the market re-rates on a multiple basis lower.
So we could expect that possibly going forward. Unfortunately, we're out of time. I could talk to you all day. That's Dawn Fitzpatrick of Soros Fund Management. Thank you so much. That was wonderful. That was awesome.
Please welcome to the stage Peter Fung, Managing Director and Chief Operating Officer at Harborview Equity Partners.
So good morning, everyone. Just a quick introduction on Harborview. We are a multi-strategy asset manager focused on entertainment, IP, and global cultural assets at scale. Our portfolio consists of iconic IP that defines generations, including songs from Fleetwood Mac to Bruno Mars and other timeless hits. I'm going to spend a couple minutes talking about what it means to redefine, or at Harborview, what it means for us in terms of redefining what it means to invest in culture. But to do so, just to give some context, historically investing in cultural assets like music has predominantly relied on gut, instinct, intuition. As a result, many people believe that investing in cultural assets is driven more by art than science. And frankly, that was historically true in an era historically driven by CD and vinyl sales, episodic revenue with no tail, limited reporting, and limited visibility. But streaming fundamentally changed the asset class. All of a sudden, you had all these continuous signals where you didn't have to wait for durability. You can measure it. And no different than any other asset, you can structure asset safety through traditional risk management principles, not just based off of good ears and nostalgia. And that's what we at Harborview are doing. We're bridging the gap between analog philosophies and modern asset-based finance. One thing that is worth highlighting here is that unlike other traditional credit products, music is a little bit different. Where your upside may be capped at a fixed spread, music operates a bit differently in that you have equity-like exposure to global streaming adoption, as well as the improvement in monetization mediums such as Roblox, TikTok, and other forms. But similarly, with the right asset selection and the right risk management principles, you have the same defensive yield and characteristics as other credit products. And the other thing that's worth understanding is that with music royalties, what comes with that is truly uncorrelated yield to the economy. Because when you actually acquire music IP, what you're effectively getting is not just what you're getting is a perpetual stream of cash flow, but also the underlying copyright. And that is a massive moat. Why? Because people don't stop listening to their favorite songs in times of economic uncertainty. And venues don't stop playing it as a result. So for us, what we've done is effectively, once again, bridge the analog philosophies of the past to the current. And how we did that was we built our own operating system that we refer to as HITS. It's effectively our tool to apply credit style underwriting to culture. It allows us to measure rather than guess what will be relevant in the future. So the one thing I'd like to reinforce for the crowd is what we're trying to do at Harborview is effectively, in terms of analogy, think of it as Moneyball for IP. We're measuring what others disregard, and we're moving at the own pace of our questions. Think of it as the following. The following is what we truly believe that we own is the information advantage. The information advantage that allows us to see from cash flow to creative spark to enduring IP. And what we're ultimately doing is building a portfolio of enduring IP that stands the test of time. Thank you.
Hedged a lot of these private markets companies are to this, AI revolution that we're doing.
Please welcome to the stage Michael Arroghetti, co-founder and CEO at Ares Management Corporation, for conversation with Bloomberg's Danny Berger.
Thank you, everyone, for joining this conversation. I'm very thrilled to have it. Mike, thank you for sitting down with me today. What a time to be having this conversation. I mean, private credit is dominating the headlines, and if it's not that, it's other forms of volatility, be it concern about disruption of AI. And now the latest one we have to grapple with is the prospect of war and geopolitical uncertainty. Has that changed any of your assumptions for how 2026 plays out?
As surprising as this may sound, not really. And the reason being, as a private markets manager, we're thinking in 5, 10, 15-year increments. And you and I have had this conversation before. It's actually an interesting place to live as a publicly traded company that can experience the day-to-day volatility in markets and has to react, at least emotionally, to the daily headlines. But when we're making investments behind secular themes like realigned supply chains globally, the reindustrialization of the U.S. economy, digital infrastructure, and digitization, these are not things that get knocked off track by the things that we tend to talk about day to day. So inevitably, the world that we're living in may change geopolitically. We may see realignment of alliances. Energy prices has a big impact. We may see inflation come back in. So that's going to have an impact on certain things that we own, and we will react. But one of the nice things about being a long-term investor in the private markets is we don't really have to say, okay, the playbook that we had put in place for ourselves is now fundamentally
Have you started to think at all, again, early days, but of resurgence of inflation? If the Fed isn't able to cut as much as we assumed, how would that change things for you?
Well, it's interesting because part of this private credit story, as an example, and I saw it on the walk-up, the way that most large private credit managers are set up is that we're kind of hedged against outcomes. So if software disrupts a sector of our portfolio, then our digital infrastructure and data center development business benefits. If software disrupts the portfolio, then our renewable energy business benefits. So when we think about inflation, what's interesting, the private credit narrative is also around base rates coming down. So there was this anxiety that crept into the market that as base rates were coming down, the return available in private credit would somehow become less attractive. If we find ourselves in an environment where we still have inflation and rates are elevated, that's actually theoretically good for total returns in private credit. So I think you have to start thinking about both sides of every coin, and most of the things that we tend to talk about on a day-to-day basis have a risk and an opportunity associated with them. And when you look at a broad-based manager like Ares, we tend to be on either side, and so we tend not to get that worked up about any.
Just hearing you talk about that, though, let's take the software AI example. Not every platform has the size and scale to balance out a software exposure with AI infrastructure. So these pains we're seeing, if you can benefit by being diversified, what happens if you aren't? Is there a shakeout to come in this industry?
I think investing 101, and Mark Rowan just talked about it too, diversification is a big way to mitigate risk. It's also a way to dampen return if you focus too much on diversification. So we're constantly trying to find that right balance of making sure that we can capitalize on volatility. And one of the ways you do that is you understand deeply what you own so that when the markets get dislocated or disrupted, you can push in and play offense. Inevitably, if you are concentrated, whether it's AI or we saw it in the energy shakeout 5-6 years ago, there are going to be winners and losers. Generally speaking, those that are more diversified will survive, consolidate, and probably grow disproportionately.
We've already started to see some consolidation. I have to say, I feel like you and I have been talking about consolidation for years. Does it feel at all that it's reaching ahead at this moment, that you really are starting to see some funds that are limping along and their only odds of survival are to become bigger and join a larger platform?
So we've been talking about consolidation for over a decade, and back to secular themes driving the growth in private markets and capital formation is consolidation. So unlike investing in the public markets, size is not the enemy of performance in the private markets. It's quite the opposite, because the larger you get, the more resources you have, the more you can invest in local origination, product development, large balance sheet. The more relevant you are to customers, the more relevant you are to global investors. So size is not something that we necessarily pursue as an end goal. But what we're all experiencing is that the larger we get, the better our performance is. Consolidation is not about limping along and getting subsumed. There's been some of that, right? We acquired ACAS and Allied and other public companies coming out of the GFC, but it's more the high quality monolines. So to your earlier question about lack of concentration, if you're infra-only equity manager, or you're a single geography private equity manager, but you have a 25-year institutional track record and a legacy that you want to sustain, you will try to get consolidated from a position of strength, not a position of weakness. That being said, if we continue to see the type of volatility that we're seeing now, I do think that you'll see some of these weaker players get consolidated out.
What does that look like if you are not specialized, but you're still one of these kind of middle-sized players? Are they going to see a real squeeze right now?
I think so. The global LPs are looking to allocate more dollars with fewer managers. And they want to do that because they want better economics, they want better access, they want better information and analytics. And I think they're also seeing that scale drives performance. And so as this consolidation happens, you're going to see the large get larger. You're going to see niche, real alpha generative managers continue to thrive. And then I think everyone in the middle is going to have to really prove that they can generate alpha, or they're going to get squeezed.
By the way, just to point out, because I don't think you can do it, or perhaps you're too humble to do it, Last year, you raised two of the largest ever funds, $30 billion and $35 billion in direct lending. And that feels like evidence of its very self, of the big getting bigger. So in a winner-take-all environment, or winner-take-most, 5 years from now, what is going to be the size of this industry in terms of number of platforms? Are we talking there's just 5 to 10 players? Is there more than that?
Yeah, I don't know. If you look, you have to look for an analog, and generally speaking, in financial services, players can max out at a 25% market share, and then you get diversification below that. So you can look at the banking industry where you have 6 or 7 large platforms. You can look at the insurance industry, and you can see that consolidation too. So I don't know if it's 5 or 10, but it's going to be a handful. To your point, though, on the capital formation, last year we raised about $115 billion, which sounds like a big number in the grand scheme of the markets and where we were 5 or 10 years ago. We actually put $145 billion to work. So as you're consolidating capital, you're also consolidating the ability to deploy that capital. And so that's part of what compounds this market leadership.
So how are you thinking about the Ares platform specifically as this trend unfolds, as it makes sense to have scale? Are you looking at growing not just organically, but inorganically as well?
Yeah, our history of growth has been a healthy combination of organic and inorganic. About 75 to 80% of our growth historically has been organic, 20 to 25 inorganic. We tend to lean into an acquisition when we see a market that is going through some kind of transformational change or secular shift, where we think we have a right to participate and win, but we just don't have enough scale, or we're missing a key piece of information edge, or we don't have the right distribution. And so when you look at where we're acquiring, other than small tuck-ins that we'll do, it's going to be in big transforming markets like data center development or wealth distribution. Most of those boxes, frankly, are checked for us right now. And so most of the growth, I think, for the foreseeable future will be organic, leveraging the competitive advantages that we have on the distribution and investment side to grow within the business. But there are still a couple of things that I think would make sense for us.
Well, part of the thing, and actually let me get to that first. What would be those couple of things that make sense for you?
Yeah, we've been public about this. I think getting larger in private equity could make sense for us. We've been in the private equity business for as long as we've been in existence, but it just hasn't kept pace with the rest of the business in terms of real estate, infra, and credit. I think there's an argument that someone of our size and global reach should be larger generally in private equity.
I mean, there's a lot of players out there, and probably a lot of smaller players who would love to be part of the Ares platform. How do you evaluate that when you look for potential managers to buy? What are the characteristics of a good private equity bolt-on to Ares?
I just realized now my phone is going to be ringing all day from every investment
Everyone's going to be pitching you, for sure.
Look, it's all about track record, and this is something that people don't talk about enough, and so I'm going to answer your question a little bit differently, because when you get into a world that we're living in now where you're seeing outflows and volatility in stock prices, it all comes down to fundamental performance, and top quartile, top decile performers that can demonstrate that they can deliver outsized return in any environment grow. So we have a simple saying at Ares that assets follow performance. If you perform, you grow, and if you do well for your investors, they do well by you. So particularly in markets like private equity, and frankly, when you get into the equity part of the capital structure, even in real assets, performance is kind of the top criteria. And then I think it's about, can you really generate alpha? And this is going to be the big shakeout in PE. We're coming off of a decade where you had a lot of beta players who, because of the rate environment that we were in and because of the nature of supply demand in the market, were generating what looked to be best-in-class returns. And now that arbitrage is gone, and you really have to, you're going to get an opportunity to see which private equity managers can really make companies better and transform them. And I think those are the ones that you would want to own.
Do you think they're far and few between?
I think there are. I think if you were to actually look at the math, and this is something that we do in our secondaries business, when you look at the number of managers globally who can really generate alpha consistently, there just aren't that many. It's actually a very unique skill set. So I think people are going to be paying a lot more attention to that over time.
Can I ask, because a lot of times people use the corollary of hedge funds a medallion fund that can only grow so big because if you're too big, you eat away at alpha, that scale matters in this. And people love to point to the private capital industry, be it credit or equity, and say they're growing really rapidly. They're going into retail. That means that deal quality is being sacrificed in order to put assets to work. Is there a type of environment evolving right now where alpha is being eaten away at because the industry is growing too rapidly?
I don't think so. I mean, I'm sure that there are players who haven't built the origination or portfolio management capacity to drive alpha through this type of market. But I just look at our track record over 25 years in the private credit business, and it's been a 12 to 13% plus asset level return through everything that's been thrown at us, with loss rates near zero. And so I think that's something that people will continue to have appetite for. But this is the thing that's tough. When you're investing for the long term, we're not going to know. And what we always try to say to our investors, both in the private market and public, is focus on performance. I know that historical track record is never a predictor of future return, but there are good investors and bad investors. And it's very hard to take a bad investor and suddenly make them a good investor just because they can raise money in multiple channels. So there's going to be a little bit of a dispersion in return, but that's okay. There's dispersion of return in the mutual fund business, right?
It also, though, feels that, yes, track record, but when it comes to more of the retail type funds, it feels like some of the selling, or at least redemptions, has been indiscriminate. And you can talk about what you're seeing on your platform as well. I know you've seen net inflows, not net redemptions. But you're seeing redemptions on platforms like Blue Owl or BCred when it comes to Blackstone that don't necessarily have bad performance. You can see where they're marking. So what is going on that you are seeing some retail pulling back from some platforms, despite performance which hasn't been as bad as the headlines would suggest?
It's a confluence of things. Number one, and it goes back to diversification. So if you are going to have a playbook to win consistently through cycles, you have to be diversified in your asset mix. You have to be diversified in the markets that you participate in from an investment standpoint, geography and other. And you have to be diversified in your distribution. And I think one of the challenges, and we experienced this, when we first started our private credit business, it was dominated by our traded BDC, ARCC. And we managed that, we think, fairly well through the GFC, acquired a number of troubled managers, and then realized that as wonderful of a structure the publicly traded BDC was, it was inherently pro-cyclical because we just couldn't raise the capital that we needed when the markets were dislocated, and we were getting capital that was coming into the platform when the markets were healthy. By the way, banks are pro-cyclical. There's a lot of pro-cyclical structures. So the light bulb moment for us was we needed to diversify our capital base, and so we moved quickly to build the institutional fund complex, those $30, $35 billion funds that you were talking about, so that we would always have the dry powder and the investment capacity to navigate changing market. And then once we felt that we had that well in hand, we said, let's go into the wealth business. But if you are over-indexed to wealth, you're going to be inherently pro-cyclical, and that's part of what's happening now. Now, the challenge is, I think these products are still in their infancy, even though the market is large, and I think they're misunderstood, right? These were not meant to be liquid funds. They were meant to be illiquid funds with an option for structured liquidity, and that liquidity is supposed to come orderly so that the folks that want their capital back and the folks that are putting money to work are not disrupting the fundamentals. So as of now, that's how the market's working, right? So you are going to see inflows, at least in our case, exceeding outflows. You're going to see in certain cases, that not happening, but the structure's working and that liquidity needs are being met. The other thing I would highlight, this is not a case of 100% of investors in a given fund wanting 5% of their money back. And I always just try to get people to focus on kind of the facts and not the noise.
Right.
When there's a 5% redemption queue, that could mean there are 3% of the investors representing 5% of the capital that want their money back. For some reason, maybe they're getting hit in another part of their portfolio and they need liquidity, right? It may not be a reflection of their view of that specific fund, But what that tells you is there's 97% of the investors in that vehicle that want to be in that product, and then there are new investors coming in. So this is something you and I talk about when we're thinking about how we tell the story of what's happening in the market. This is not an unwind or a lack of appetite for private credit. We are still seeing significant appetite across the spectrum of our 8 wealth products. There are corners of the market that are looking for liquidity, but there are still people that are allocating aggressively into it. And I think that's just, we're going to have to find where that equilibrium is. Different managers will have different experience, right, based on track record and size and brand and all of those things, but that's not necessarily a bad thing.
Do you think the industry will shrink as a result of all of this?
I don't. No, I don't. I look at our own experience as an analog. We have 8 semi-liquid products. They kind of ebb and flow in terms of investor demand. You can have significant retail demand for real estate. That gives way to demand for private credit and infra. But when you look at the opportunity for individual investors to get access to these assets, if you were to talk to the large wealth platforms, they're still seeing, a significant amount of demand for these products, and they will tell you from a model portfolio standpoint, they're massively underallocated.
Right. So if performance is healthy, I wonder what you make of this. This got a lot of attention last week. UBS saying that there could be 15% default rates in private credit. Does that sound right to you?
It sounds absolutely wrong, and when I saw it, I thought it was actually irresponsible.
Talk more about that.
And this is part of the problem when you have someone who's actually never been in a segment of the market making commentaries about what default experience can be. That's actually irresponsible. If you were to look at private credit, default rates have always lagged default rates in loans and bonds. So that's just something that people should take a look at. Default rates and loss rates have always lagged loss performance in bank C&I portfolios. So people should take a look at that. And if you look at the GFC, you would see that private credit portfolios as an industry were probably down somewhere 8 to 10% for 1 year default rate, and then rehabilitated. So if you're talking about 15% default rates in private credit, which again I think is just not possible, but if you're there, everything else in your portfolio, I assure you, is going to be completely torched. So we could talk about private credit specifically, but again, to decontextualize it from what that would be telling you about what's happening in the broader investment markets, I think is problematic.
What do you think the world is getting wrong then? Because you can't just blame the media in this case, which I know, I'm not saying you do, some of your peers love to, but if an institution like UBS is getting this wrong, what do you make of that?
Well, like UBS, as an example, just lost a significant amount of money in a loan called MFS, and that particular analyst didn't actually write a story about that. So I thought that was interesting. I don't think they're getting anything wrong, to be honest with you, and this is part of the signal through the noise, is the markets right now are so conditioned to react to any headline. And the reason they are, structurally, the public markets are fundamentally different than they were. You've got massive concentration of market share. You've got a significant amount of algorithmic trading that happens in the market. And most public equity investors are now focused more on momentum and positioning than they are in their ability to actually carry out a fundamental investment thesis. So I don't know that they're getting anything wrong. I think it's more of a commentary on just how investing in public markets works now, because you have to be out ahead of whatever that headline is, because that headline is going to drive momentum, and if you're not positioned appropriately, it hurts. So I think based on the velocity of the news cycle and the structure of the market, all you're seeing is investment behaviors changing, where we're not actually able to talk about long-term fundamental business plans, and we're focused on short-term noise. And that's okay, but it's also one of the reasons why I sit here so confidently being in the private markets, because we know we have a business plan for every asset that we own. We're going to execute on it, and ultimately we get judged over 5, 10, 15-year increments as to whether or not we improve the value of those assets over time. And there's going to be volatility, to your first question. That's going to change the way that the business plan gets executed, but the outcome should hopefully still be the same given all the flexibilities we have to drive value. And it's unfortunate because I think the public markets have moved away from that. Active investing in public equities is really difficult.
Yeah.
And it's difficult because of some of this, just, you know, the way that information is getting consumed.
By the way, as you know, we've talked about how you've expanded the Ares platform. One area that you've also very expanded into, and I know we only have about a minute left, but I'd be remiss if I didn't ask about your sports platform and the growth there, be it you know, investing in itself or offering to wealth investors. Why go all in on sports?
Well, we went all in on sports, first of all, because it's fun.
As good as reason as any.
It is a fascinating opportunity for us to participate in the development of a market that up until 5 years ago wasn't available to institutional or individual investors. So we want to be at the front end of innovation in financial markets, and we identified sports as an opportunity for us, given everything that we did, the nature of our capital, the nature of our relationships, to really change the way that business was getting done in the sports ecosystem. And two, from an investment outcome standpoint, it's almost completely uncorrelated to anything else that you can own in your portfolio. So when we talk to our investors about a broad portfolio of sports exposure, and we show them what it looks like against the S&P, against credit, and so on and so forth, what stands out most is just how unique it is in terms of what it delivers to the investor in terms of the outcome, the inflation protection, the compounding of value, the store of value. So it's actually a really unique asset class, and I think as more people have a look at it and more institutions participate in it, it'll become, you know, much more developed.
Well, Mike, I'm just going to leave it here because I think this is the only reason everybody's here. I'm saying in jest. The question everybody wants to know: how are the Baltimore Orioles going to be doing this year?
They're looking really good. Looking really good.
Tough season last season, though.
It was a tough season, which is, you know, part of maybe to bring it back to the markets. You don't know, returns aren't always positive, but you hope over a long period of time they are. And so we had a drawdown last year, but we're actually really optimistic about the season ahead.
A perfect way to put it. Mike, thank you so much for joining me this morning. Everyone, please join me in thanking Michael Arougheti.
Please welcome to the stage Paul Schroeder, Director of Factor and QQQ Equity Product Strategy at Invesco, for a conversation with Bloomberg's Eric Balchunas.
All right. Thank you very much for coming to the event here. We're about to talk about an ETF. I'm an ETF analyst. I'm a true ETF nerd. Every ETF has really interesting stories and facts. I think we're going to learn something here today. That was my goal. So we have 10 minutes to talk about arguably one of the, you know, I call it a stud ETF, the Qs. First question, anybody here own the Qs? Okay, a couple people. Anybody here compete against the Qs? Yeah, okay, a little more. Yeah, no, it's tough. It's one of the best performing ETFs since it came out in 1999. It's up 537% in the past 10 years. It's very difficult to beat. Only a couple active managers have managed to beat it. And this is part of the challenge for our industry is how to beat some of these indexes. So I thought, let's go into like, what exactly is this thing? Our team sometimes calls the Qs the eighth wonder of the world because it just keeps delivering these incredible returns. It's like, what is going on here? Generally, it's tracking the US stock market, but it's not really beta. It's not, you know, like the S&P, and it's not tech either. Only half of it's tech. So, you know, we have some theories. I want to get your theory. This is Mr. QQQ right here himself. How do you define the Qs? What exactly is it?
Yeah, so QQQ, in my mind, what really defines it is its simplistic methodology. You know, as you alluded to, it's not beta. It's not exactly a tech fund. It's not. It is a large cap growth fund, though. Right, so it's grabbing the 100 largest non-financial companies listed on the NASDAQ stock exchange. And what we've seen through the years is just using that simple methodology, which is simpler than the S&P 500, simpler than most large cap growth funds out there, is that it's been able to be really the place to go for companies that are highly innovative. Now, you may ask, Eric, you know, how do you really know that they are innovative? Right, because over the past 5 years, that really has become, everyone became innovative, right, the second half of 2020, because they had to survive. But really, at the end of the day, you have to quantify it. And we quantify that through research and development and patent activity. So looking more specifically at research and development, your average QQQ company is spending about $17 to $18 billion on R&D per year. Your average S&P 500 company is spending about 11 to 12 billion. Now, you may also say, well, Paul, there's decent overlap between the two funds now. The Qs is only 100 companies. You're right, there's about 86 different companies from NASDAQ 100 and the Qs that are within the S&P 500. It's interesting, though, if you take those 86 companies out of the S&P 500, that R&D spend drops from about 12 billion down to about 1.7 billion. So you're looking at a multiple of about 11x there. That really is the proof in the pudding of how are these NASDAQ 100 companies innovative.
Yeah, I think it is kind of innovative beta, if you will. Now, why is that? So I've thought deeply about this, as I do about ETFs. As I said, that's my job. And I call it the Steve Jobs effect. If you pull the thread on the Qs, it's like, okay, what is it? It's just companies that listed on NASDAQ. What's the big deal? Well, I think the inception moment here is in 1980 when Steve Jobs, 27 years old, decided to list Apple on NASDAQ. Now, NASDAQ was not the biggest exchange. The obvious place would go to NYSE. And I think he, as he did it in a somewhat of a rebellious move. It was trying to get known as the tech exchange. And I think it attracted a lot of other people who over the years have really become to worship Steve Jobs. If you're a visionary type tech founder, I mean, he's kind of like, one of the real inspirations probably for your career. So I think a lot of people came over. The metaphor I use is when Michael Jordan picked Nike as his shoe brand in 1984. That was also a shocker. Nike was third, not even known as a basketball shoe, and everybody followed him there because he made Nike cool. What do you think of my theory?
Well, being a Chicago guy, I appreciate the Michael Jordan analogy. And I own a closet full of Jordans, so it really was a revolution, right? So, but I think you're 100% right. If you think about QQQ, it really is grabbing just 100 companies that list on the exchange. That through the conversations that I've had with NASDAQ, though, is that's part of their pitch, is that they have a pedigree of having technologically focused companies list on their exchange. Right? If you walk through their office off of 43rd in Times Square, you'll see this big pictures of all these large tech giants going public. You have Steve Jobs up there, you have Jeff Bezos, and the many others that have. And if you're a young CEO who thinks that they're going to change the world within their industry, why wouldn't you want to list on the same exchange as those?
Yeah, so if any quants are out here, can we work on the Steve Jobs factor? When we get out of here, I'll meet you later. We'll write a paper on it. Anyway, okay. Speaking of Apple, Apple is one of the Mag 7. Now, the big thing in my industry and research is, should you go away from the Mag 7, right? The Mag 7 make up 33% of the S&P and 40% of the Qs. Some say, this is too concentrated. We did a little digging into this. And the Mag 7, by the way, has acquired 850 companies. I mean, these are gigantic companies. The guy who covers them in Bloomberg Intelligence refers to them as small countries. They are massive. I mean, YouTube and Google is probably the best example. If you spun out YouTube, it'd be like a top 20 stock in the US. So we call them the Mag 70. And that makes us just be a little less worried about the concentration. But we do see this year people going to equal weighted indexes. RSP is taking in a ton of flows. What's your response when someone comes and says, yeah, I like the stocks, but I don't like the weightings?
Yeah, it's a common question that we get. It's not uncommon for the Qs to have 48, 50% within the top 10 holdings, as you alluded to. Mag 7 makes up over 30% of the S&P 500. It makes up around 40% within QQQ. And with everything that's been going on basically since October, within questions around software, et cetera, we have gotten a lot of those questions. We've seen broadening out within the market. We've seen value taking money. We've seen small size taking money, as you alluded to, RSP taking in nearly $10 billion this year. But I think at the end of the day, it brings up two different things. The first thing would be is that these companies within QQQ are the conglomerates of the 21st century. You mentioned YouTube. It doesn't stop with them. There's Amazon. as well. There's Microsoft that has many other subsidiaries underneath a Meta. And it doesn't stop within tech. You have a company like PepsiCo that has a bunch of different brands that are part of the portfolio as well. So you have diversification underneath the hood, underneath that one company's ticker that a lot of people don't realize. The second thing is that you have to remember where QQQ typically falls within a portfolio. As much as I would love for it to replace the S&P 500, and I'd be more than happy to have an individual conversation why that should be, realistically, it's used as a bolt-on to your core holding, which is usually the S&P 500. Right? I can understand if I hold SPY, VOO, and the top 10 holdings or Mag 7 are 30 to 40%. But if you're looking at the portion of your portfolio that is supposed to be the growth engine of your portfolio, and then you think about the global economy where you have several major companies, right now it's around 7, right? That could be expanded out to 8 or 9 if you think about it, that have been the driver of fundamental growth over the past 10 years. Why wouldn't you want to market cap weight that portfolio? We've seen fundamental growth within the QQQ outpace that of the S&P 500. You have revenue growth outpacing along with earnings outpacing. So really it has been the growth engine of the portfolio. And I think you need to keep that in mind when thinking about concentration.
All right, just real quick, we got about a minute and a half. Sticking with the basketball metaphor, if the Mag 7 are the starters, give me some bench players. You look at the Qs, there's 100 stocks. I looked through it last night in preparation. What are some names in there that are exciting to you that people don't really think about?
Yeah, so I think if you think about QQQ, a lot of the companies that get the headlines are tech. It's 50% tech. But we like to take a look underneath the hood at some of these other companies that really have been making an impact within their own fields. Intuitive Surgical, which isn't necessarily a household name, but a very large, well-known company within healthcare. You also have a name that moved in more recently that a lot of people don't realize is in there is Walmart, right, from its recent change of venues, right? So that's not exactly on the bench within there. It's a top 10 holding. But you get a lot of different exposures within there. They're outside of the Mag 7, outside of tech, that really have an impact on the portfolio.
Yeah, I mean, if Walmart's on your bench, that's like dream team status right there, I think. So anyway, we're out of time. Thank you very much for your attention, and thank you very much for talking about the
Thanks,
news.
Eric.
All right.
Please welcome to the stage Kelly Granat, Co-Chief Investment Officer and Managing Director at Lone Pine Capital, and Divya Netimi, Founder and Chief Investment Officer at Avila Global, for a conversation with Bloomberg's Hema Parmar.
Hi, everyone. Thank you for being here. And I'm thrilled to be here to moderate this stellar panel with our excellent CIOs of impressive hedge funds. So we have Kelly and we have Divya. We're going to jump right into it. This has been a pretty fascinating and volatile week when you look at the news that's flown out, when you look at how markets are trending. You both also trade public stocks and do private investments and have themes around AI. So we're going to talk a little bit about the AI space. But first, how have you navigated this week when you look at your portfolio? What are you doing? How are you assessing the kind of risks that we're seeing right now?
Sure. So I'm happy to start. I would say in moments like this, we tend to debate a lot and do very little. Typically, unless we feel something very big on the margin is changing, which would then change how we're thinking about the backdrop and how we want to underwrite against what we are under, the economic backdrop and the risk backdrop. And so, it's really a time to zoom out, reassess, be much more tactical, I would say, in terms of how we're thinking about things, readdress downside scenarios and securities that we own to make sure that we're comfortable with sort of the new set of facts that we're learning and be willing to change our minds. So it's a time to be, I would say, bringing in duration in terms of let's be thoughtful about the short term, mindful of where we're going to get prices and things that get very dislocated in environments like this to take advantage of.
Volatility is inevitable in markets. We're always going to see volatility. And it's a question of, hopefully, at the end of the day, taking advantage of it. But in the meantime, we run scenarios whenever we see macro or geopolitical situations that could create a different scenario for our stocks. We're actually very bottoms up. We run a couple different scenarios. And when that risk reward between the different scenarios looks asymmetric, that's when we'll step in. And volatility is inevitable, but I actually think that's what creates some of the best opportunities over time, and it creates some of the most interesting entry points for us.
So when you look at those entry points, is this a week where maybe you're adding to positions or are you pulling back?
It's actually very stock specific right now. If you look at the markets year to date, the index level hasn't actually moved very much, but underneath it all, stocks have had very big moves. So it just depends on the specific sector in terms of whether we're adding short exposure, whether we're adding long exposure, or whether we're actually taking profits. There's plenty of stocks that are up quite a bit for the year too.
And Kelly, we've seen this kind of volatility in spurts recently. So does this feel like a new trading environment? And then how do you think about that when you plan your portfolio for the rest of this year?
Well, the flavor changes. I think, volatility is right there. It's pervasive in the market. This is more geopolitically oriented, obviously, and the implications, given the region that we're talking about around oil prices, inflation, those are big topics in the market broadly and impact interest rate policy, certainly in this country. And so there's swirling effects, and it permeates the conversation, I think, differently. And that's the nature of each of these, is they're all a little bit different. For us, I would say, just to the earlier question, we've probably done fewer trades in the last 48 hours, actually, than more. And so we've done very little in terms of adding to longs or covering shorts, and we're just trying to reassess the risk case.
Mm-hmm. You both look at AI. Mm-hmm. And as you look through the rest of this year, can you point out, Divya, we can start with you, one key conviction, bet, or theme that you're really looking at, as specifically as you can speak about it?
Absolutely. We think there's been a monumental shift in AI adoption in just the past 2 to 3 months. We've seen from the latest generation of models a pretty big inflection in agentic coding. In fact, one of the big AI research labs they released this publicly, they added 5 times the amount of revenue in January than they did in an average month in Q4. So we think this just has a lot of impact on enterprise adoption in 2026. So we see that across a variety of sectors. For a while, AI was just a bit of a tech story, and now we're going to see it impacting enterprises across different sectors. We're pretty excited about it. I think in the next couple quarters, we're going to see companies come onto earnings calls and talk about real, tangible financial impact. That doesn't mean there isn't opportunity in the tech space as well. In fact, within the tech space, what we're looking for are subsectors that can still grow, maybe even an order of magnitude from where they are today. One example is the data center optical networking space, which we think grows at a much structurally higher pace than just GPU growth. And some of those stocks could grow earnings 10 to 20x in terms of the earnings power in the next couple of years relative to what they earned in 2025.
I would agree. I mean, we've been very focused on the infrastructure part of AI with the view that the lead pole position of who's got the best LLM and is delivering the highest capability is probably going to change multiple times as we figure out as sort of this market consolidates around a few winners over time. And we've been more interested in owning the build-out part of that because that feels like the certainty around this, is that it's all going to get built. The data center build-out is going to happen. And we've been focused on mapping the pockets of constraint as that happens, and where there are resources that are, or inputs to that build out that are in moments of supply constraint where we feel like there are healthy duopoly, triopoly type industry structures, healthy margin structures where there's not the ability to bring on tremendous capacity quickly to change the economic profile for that subsector. So to your specific question, one of the areas that we remain very excited about are the IPPs, the independent power producers, in a world that is increasingly questioning the durability of the AI spend and what the return's going to be. These are physical assets that are in the ground that own the interconnect, and that is what you need to turn basically power on to realize a lot of the inference opportunity and a lot of the scaling laws that we're seeing in terms of what the models can deliver. You need the hookup to the power grid to turn those megawatts into dollars ultimately. And so we think these are businesses that are incredibly well positioned and have the opportunity to extend duration at a moment when we can debate whether memory or optical or certain other parts of the build out are moments in time. This is an opportunity to actually extend cash flows by signing long-term contracts that leverage a lot of that market position.
And you also have a theme at Lone Pine, Revenge of the Dinosaurs. Can you tell us what that means?
Sure.
How did that look?
So this is sort of a big picture idea we have that a lot of the capabilities that we're increasingly learning about, on a daily, weekly, monthly basis now will allow a lot of businesses that are not in the tech space to deploy capability to both improve their unit economics, probably change their cost structure and the shape of that cost structure over time, lean into a lot of revenue opportunities around doing things smarter, more personalized, more customized to their customer base, in a way that probably changes industry structure. And there are a lot of companies who are old world companies that, simple things like routing densities for logistics companies or customer personalization in a way that allows you to know just your customer that much closer and that much more intimately to service them in ways that are just harder with off-the-shelf solutions in the world just means that there's a lot of businesses that we think that are highly motivated businesses that can really capitalize on a lot of these technologies.
Can you give us some sorts of examples as to the dinosaur resurgence, if I'm explaining that correctly?
Yeah, I mean, dinosaurs is maybe a bit of an insulting term now that I'm thinking about it on stage in front of a bunch of people. But these are very high quality companies that have the opportunity to use, I think, this moment in the world to take a look at their cost structure and take a look at how they allocate resources and how they invest in technology and think about it differently, right? Because there's things that are on wish lists for companies in terms of capability that are just either too expensive or require a certain scale to make sense for them in terms of allocating investment. And when you have coding costs going to kind of zero over time, and you don't need to rely on off-the-shelf solutions in the same way that you have that can be cost prohibitive, you can actually build software to address business need that is specific to you. And the companies we think that are thinking about that in the most thoughtful ways are going to be able to leverage this technology differently and play offense around it.
And do those span software to infra to everything?
Totally. There are distribution businesses. There's it's a lot of things in the services part of the economy that are super interesting around this. And a lot of them are physical asset businesses as well. So it just depends.
We've talked about the opportunity ahead within AI, but what are you most concerned about? Where are we going to see, it could be a pullback, concerns, or where you might be either looking at more skeptically or avoiding? Divya?
It's interesting. A lot of people are worried about a pullback or hiccups. And of course, when you're early in a technological transformation, you're going to have that. But one of the other risks that isn't talked about as much is what happens if everything moves really quickly, and what are the ripple effects of that? In fact, with what we've seen in just the last 2 to 3 months of the agentic coding, I wonder if 2026 will be a year where the rest of the ecosystem around some of these AI transformations isn't going to be able to keep up. Will all parts of the supply chain be able to keep up? Will shifts in the labor market that need to happen be able to happen as quickly as they would need to be? Will regulatory frameworks be put in place in time? So it's interesting when you're moving at lightning speed and a trend is growing exponentially, sometimes the ripple effects or hiccups come from other parts of the ecosystem that just can't keep up in the near term.
Yeah, I would agree. I mean, I think this is very real when I think about the big technology shifts over the last, my investing career. This is very, very real. The question is just time and distance, really, right, in terms of how does this all get absorbed. The market, I think, myopically focuses on specific questions and moments in time. Right now, it's about the return on all this CapEx, and the numbers are eye-popping, right? I mean, I think if we were sitting here 2 years ago and you said, we're going to be talking about $1 trillion of CapEx across a handful of companies, I think both of us would have said, you're crazy, that's never going to happen. But here we are, and the reason it's interesting now is because for a lot of these companies who are spending that capital, The threat is existential. If they don't win or stake out their place in this evolving ecosystem, there's risk to their core business in a very fundamental way, which is hard to imagine for companies of this scale. So I think right now, I think that's sort of the overhang question on the market is a bubble, right? We get the B word, which makes its way into this conversation very quickly. And I think there will be a bubble at some point. It's hard to identify where exactly it's going to manifest, but it's something that I think we're all tracking really closely. And it goes back to sort of the supply constraint conversation we had before about where there's just tremendous shortage in components that are needed to build out, this data center build, and what happens? What's the capacity response? What's the investment response? Are people rational, right, in terms of staking out their claims? So it's an interesting time for sure.
So we're not in a bubble right now, but we could be. Do you have a sense?
From everything that we know, I don't think we're in a bubble right now in terms of the spend seems very justified. And, when you think about return on invested capital for the big companies and the direction it's heading, until very recently, the big companies that are funding the lion's share of this CapEx were using their free cash flow from their existing businesses to fund. Now that's changing, right? Because that is no longer sufficient to fund the toll of what the CapEx requirements look like. But our estimation today is that it's not a bubble because we're very much believers in the technology and the capabilities it will bring. But for sure, there will be an overbuild in certain parts of this ecosystem over time, and our job is to track that.
I agree.
Does this environment allow for more shorting as we look at long short equity funds?
It's an interesting question. I mean, we've had this conversation. The market has been much more bucket oriented, I would say, meaning there's, it's been very holistic in painting the paintbrush of software is a loser, infrastructure is a winner. The Mag 7 went from being a winner and now they're a loser. And it can change really dynamically. And so that makes it harder for shorting in the short term, I would say, because you want more dispersion within sectors to say there are going to be inevitably and invariably winners and losers, right? And we want to do our fundamental research to inform that view and the expression of that view. Right now, it's a little bit more top-down in terms of what the market is rushing to conclusions, I would say, very quickly. And we've seen software, internet platforms, payments companies, all in the last, really, since the start of this year, just get eviscerated with regard to valuation. And really nothing in terms of their reporting has meaningfully changed. It's just that the market's increasingly concerned about what this all means for their businesses and the moats that define their business. And so that's a little bit tricky, I would say, in the short term in terms of making holistic bets.
Yeah, I think it's an incredible environment for dispersion, but the way you're seeing dispersion, like Kelly said, is between subsectors. And I think if we're sitting here a year or two from now, what's going to happen is that within each subsector, you're going to see a lot more dispersion. The way AI is going to play out in the economy is that there's going to be winners and losers within every subsector. The company that's forward-thinking, adopting AI, creating a real strategy today, they will probably find a way to leverage AI to create a competitive moat or a competitive differentiation or advantage over other people in their sectors. And if they can do that, they will win. Regardless of whether they're in a tech sector or non-tech sector, they're labeled an AI winner or loser right now. So I think it's actually an incredible environment for dispersion and stock picking. And, and I think that's how it's going to evolve in the coming year or two.
So hedge funds also use AI internally. We've seen funds have their own GPTs. We've seen funds use AI to help absorb large swaths of data. But in the next 3 years, 5 years, we're talking about how the pace of change is so quick right now. Divya, how do you see hedge funds using AI to make investment decisions in a 3 or 5 year horizon?
I think the productivity increase is not going to be marginal. I think it's going to be an order of magnitude. It's going to be significant. We're working on it internally, and we're really excited about it. I think that it's not just that people will be a little bit more efficient at what they do. I think there's going to be entirely new workflows that come of this. I could see things like developing an agent per stock that tracks that monitors all the data around a stock, relays back to you what is signal versus noise. I could see a world where an analyst who previously covered 20 stocks could cover 200 because they are maybe managing a fleet of agents that looks at all these stocks and tracks them. I could see a world where we're able to tackle a far greater number of top-of-funnel ideas and do a bit of work on them and more accurately pick what the best 15 to 20 best long ideas in a given year are. So I actually think it's going to reshape how we do things in the long term.
I totally agree, and we're working on a lot of the same things. You know, it's interesting. I think it will elevate judgment in a pretty meaningful way because it's going to commoditize the base layer of what we do, which is obviously super important because it's the building block of how we analyze companies and industries. And what I mean by that is obviously all the financial building blocks of businesses and unit economics and understanding all the tracking around different metrics that are important inputs of how we think about a company or a sector. But what it will do, I think, so the coverage point is exactly right. You'll be able to, the breadth of what you can look at will be much, much broader, which is fantastic. And also, I think the standardization of a lot of information and tools within our organizations will be super helpful for collaboration, right? One of the things we struggle with is it's very easy to get siloed as an analyst, and these are the sectors I look at, these are the tools I rely on, these are the models I've built, and for us, we are spending more and more time as a research team collaborating around ideas with multiple people looking at sectors or trying to solve key questions or you know, things in the market. And so the ability to have standard tools that we're all using to track lots of different things, to inform how the models are trained, will be super helpful, I think, in people being able to pick up someone else's work and say, I totally get this because it's in the same vocabulary that I do it myself.
I see. Is there a universe where the bots make investment choices, discover new opportunities?
I don't want to put myself out of a job on stage.
I see a world where there's lots of bots running around, looking at stocks. I do think that there's an art and a science to investing, and there are parts of the quote-unquote science that these agents or bots can do, and do it more efficiently than humans can. But then there's also reading a management team the right way, knowing what questions to ask when, how you put the mosaic together of all of your quantitative and qualitative data points, the investment judgment and the pattern recognition you've gained from decades of experience on when matters more in a mosaic. And I think that's all harder to replace.
Yeah, I totally agree with that. I think, you know, so much of, we say to our team all the time, go see companies at their headquarters, right? Because you get a sense of how a company operates. I love to get there early for a meeting when I go visit a company and sit in the lobby for a while and just observe who's coming in, what time are they coming in, what's the mindset of people who are walking in the door? Are they happy? Are they excited to be coming to work? Are they chatting on their way to the elevator, right? Is it a collegial environment? And then we go upstairs and we sit with the C-suite. Are they in some ivory tower, or are they sitting amongst their team? When you sit in a meeting with them, when you've got a whole management team in front of you, do you have the CEO talking over the other executives in the room? It says a lot about the culture and how decisions are made within a company. All this stuff, to Divya's point, is super important in terms of informing who is running the business, right? How are decisions being made? What is the culture of a company, right? And I think it's really hard for a machine to do that equally well. And the last thing I'll say, just similar to what Divya was saying, is pattern recognition is backward looking, right? And a lot of things, we invest behind change. And so the patterns that informed how we invested over the last 5 or 10 years won't be the same, right? History rhymes, it doesn't repeat. And so part of the judgment piece of this is understanding what the patterns look like historically, and then having the open-mindedness and the inputs that change also in terms of what matters, knowing what matters, what are the key questions that might be different than the questions that mattered 5 years ago, to marry those two things together, which is where the judgment comes in, right? There's the patterns that a machine could help you assess and track, and then there's sort of the human element of who are the individuals running these businesses, how are they constructing the cultures and organizations that they're running.
And we saw that with the pandemic, right? With the quant funds, we were struggling with this situation that has never really happened before.
Right.
But when we look also at hedge fund hiring, what are the ripple effects with having more bots, having more AI involved in the investment processes? How does that impact the way a fund will hire? Will they hire less or different types, or especially for the younger generation?
Sure. I actually think it depends what kind of fund you are and what your goal is. I suspect that the shape of the team actually changes more so than the size. I think the productivity increase per person can be leveraged to drive higher investment returns, hopefully. And then what each analyst or PM is doing could just be different. It could be managing workflows in a very different way, rather than a situation where I just think you massively change the workforce over time.
I agree. I don't think it results necessarily in fewer people. I think the skills that we look for will probably evolve a bit. We have always really valued collaboration and team players because our culture is the opposite of a siloed culture, and we do a lot of work across different ideas with multiple people. That will be even more important, I think, in an AI-driven world where the tools are that are driving the analysis are from that nature. I would say also people who have more of just the curiosity is always the thing people ask me all the time. What do you look for when you hire somebody? Someone who's incredibly intellectually curious. I think that curiosity is going to need to also entail some component of AI, right? How do I evolve my process, right? People who are humble enough and self-aware enough to recognize that things are changing really, really quickly, and what worked yesterday won't work tomorrow. So for us, I would say people who are humble, curious, collaborative on sort of the human attributes, and then I would say people who were really good jugglers, because I think things are going to continue to evolve very, very quickly, and past paradigms won't be relevant in the future in the same way.
I want to talk a little bit about the private side of things. We've sort of touched on it with AI, but when you look at private equity exposure or late-stage growth, venture capital exposure, how do you see the secondary market playing out? How do you look at whether to add to some of these positions, which sometimes it's hard to get into, but how do you think about that exposure and balancing your privates with your publics? Divya?
We see a big synergy between doing work on privates and investing privates as well as publics. In fact, we've never seen companies stay private at this scale and growing at this rate. So assembling a mosaic of information from everything you're seeing in the private world and what you're seeing in the public world is actually incredibly helpful on both fronts. And it's interesting. We did an analysis where we realized that the leading AI research labs may actually add more in revenue dollars in 2026 than the entire kind of public software revenue dollars added in 26. And it depends on what your growth rate assumptions are. But we're in a world where it's incredibly impactful. So I actually have never seen synergies this great between looking at both.
Mm-hmm. I would agree. The evolution of the capital markets is such that many of these businesses don't need to come public at the same point in their life cycle as they have historically. That's changing a little bit now with the LLMs because of the capital intensity of the businesses. But I would say we are very focused on the later stage of the private market where there are public-like companies where we can do public-like research in terms of looking at unit economics and what the historical execution has been and have a real file in terms of how the business has evolved and grown. So we're super interested in the private market in terms of the learning and the synergies, as well as building relationships with the private companies such that when they come public, we already have a relationship. We already have done a lot of work on the businesses. They know us, and we're well positioned to be their partners in the public markets.
And Lone Pine has traditionally capped your privates at, I think, 15%
right.
or something. Is there a world where you increase that to allow for more exposure?
I don't envision that. I mean, we are really much more focused on public markets. The bar to do privates is extremely high, yes. And we're very interested in that market and have a lot of relationships in that market and spend a lot of time in that market. Mm-hmm. But we think of ourselves as public markets investors first.
Mm-hmm. As you look through the rest of this year, what is the biggest risk that weighs on you?
It's a good one.
I think we spent a lot of time talking about AI today. I think it's one of the most complex and nuanced themes I've ever come across in my career. This isn't desktop going to mobile or on-prem software going to the cloud. And as a result, there's a lot of cross currents within that theme itself. So there are areas that are completely bottlenecked, and so they're going to be over-earning, and you have to really think about that and think about when you might see normalized earnings. There are going to be other areas that can still grow an order of magnitude, like we discussed earlier, and you need to separate that out from what the bottlenecks are. And there are very technical parts of this infrastructure stack, that are easier for specialists to get into than generalists, and you have to be incredibly thoughtful. So I actually think it's a time where you want to dig into fundamentals, do really, really deep work, and that'll be kind of what the best thing you can do when it comes to risk. And I think, going back to what we said earlier, one of the biggest risks, in my opinion, is just the unknowable ripple effects from such a complex theme.
Mm-hmm. I think balance has probably never been more important. I think it's very easy, per the earlier conversation, to get very caught up and draw conclusions very quickly about this subsector is in trouble, they're winners, they're losers. AI is the whole market. There's a lot of amazing businesses in the world that are sort of away from this conversation that probably benefit from some of the capabilities, but in the near term are just continuing to compound intrinsic value, and we own a lot of those businesses. And so I think to the balance point, it's around not extrapolating what we know today into the future indefinitely, because as we said, things are super dynamic and changing really, really quickly, and having a balance, you know, in terms of how we think about what's happening in the world geopolitically, that things don't, you know, just keeping ourselves honest around a balanced portfolio, a balanced perspective, and not getting caught up and swayed by these market narratives, which seem to be so definitive for very short moments of time and then abate quickly, and just kind of riding it out. And we rely back to, you know, what Divya said, we're very similar in our orientations toward just fundamentals.
Thank you, ladies. This was a great conversation. We could
Thank
keep
you.
going, but we are out of time.
All right.
But thank you very much,
Thank you.
Kelly and Divya.
Uncertainty is top of mind for businesses large and small.
Most officials see additional interest rate cuts as likely appropriate if inflation declines over time.
I think we all believe very strongly that the U.S. economy is best served by having an independent Federal Reserve.
President and CEO at the Federal Reserve Bank of Minneapolis, for conversation with Bloomberg's Michael McKee.
Well, thank you all very much. I think you know who Neil Kashkari is. He obviously is a well-known central banker, but I did want to point out that you started your career as an aerospace engineer.
I did.
And maybe that's why you got the superhero entrance stuff there. Then you went into finance, worked at Goldman, worked at PIMCO, and ended up in this lousy job. So I was checking my phone just a minute ago, and we always have to do that with Fed officials now because there's always a tweet, you know, something that's going to come up. Neil and I talked about what we were going to talk about on Friday, and since then there's been a little news. The president's war has obviously disrupted oil prices, and they're way up over the last couple of days. That means gasoline prices go up, so that means inflation goes up. But the Fed has some experience dealing with this, right?
So I think the question is, obviously when Russia invaded Ukraine, it sent a commodity shock wave all around the world. And I was on, go back a few years, I was on Team Transitory, which said, hey, I think that this inflation that's coming out of the pandemic won't be that bad and will be short-lived. Obviously, we adjusted that view. That was not the right call, and we adjusted, we raised rates aggressively, in part because of that commodity shock wave. That was one of the contributing factors for why inflation got so high. But now if you fast forward a few years, when Hamas attacked Israel, I was ready for a commodity shock wave that didn't come. And so now the question I think that we are wrestling with and markets are wrestling with is, how long is this going to last? How bad is it going to get? Is it going to look more like Russia, Ukraine, or is it going to look more like Hamas attacking Israel? And that's going to have effects on monetary policy. I don't think anybody thinks when Russia invaded Ukraine and the inflation that resulted that the Fed should have just ignored that. I mean, that would have been the true transitory call. It's a one-time effect. Just look through it. I think right now it's just too soon to know what imprint this has on inflation and for how long.
Well, there's a follow-on question to that in that we've seen a sort of hockey stick action in gasoline prices since gasoline futures went up and oil prices went up over the last 24 hours. It's also used oil in many other manufactured products, in pharmaceuticals, in plastics, etc. How long do we need to see elevated prices before this becomes not just a headline spike, but it gets into core inflation?
Yeah, I mean, that's something we think about all the time. We obviously, you know, Mike, we focus on core. Our target is headline inflation, but we focus on core because core is a better indicator of where headline is going. But even when you strip out food and energy, though they do eventually affect core, because just as you said, energy goes into producing core goods and services as well. So I think that process takes a while. For me, though, the bigger issue is just if headline inflation is going to be elevated for an extended period of time, coming off of 5 years of elevated inflation, boy, that's a scenario that we need to pay a close attention to, and we have to pay attention to what happens to long-run inflation expectations as well. And so there's a lot to pay attention to right now. Coming into this moment, I was feeling pretty good. Inflation is still too high, but I feel like it's been slowly heading in the right direction. The labor market is pretty good, a little bit getting softer, but generally speaking, we're around the bands of our dual mandate. And so I felt like policy was in a pretty good place, and we have the luxury of just letting it gradually glide back to neutral. Now we need to see with this new shock, potentially a new shock hitting the global economy, how long is the effect and how big is the effect?
Well, as Roseanne Dana used to say, it's always something. And years ago, before we started the war, we were worried about tariffs. Remember tariffs. The consensus of the Open Market Committee seems to be, in listening to people speaking, that we're kind of in peak tariffs now. And you've basically said the same thing. Inflation should begin to come down in the second half of the year. But since the Supreme Court ruling, has that changed in your view in terms of we're not going to know what tariffs are for a while now, and we're not going to know when they're going to put them on or how they're going to affect the economy, so you can't really have confidence that inflation's going to come down?
Well, I think there's no question that the Supreme Court ruling and now the uncertainty about what is the new tariff regime, which authorities are they going to use, how close can they get back to replicating what they had originally imposed, that's introduced uncertainty, and uncertainty is a drag on the economy broadly. I haven't seen any evidence that the new tariff regime, whatever it is going to lead to a new round of elevated inflation. It seems like, based on their commentary from the administration, they mostly want to try to recreate what they had before. And the question is, how close can they come to that? So I would expect that inflation, just on that one factor, is likely going to be on the same trajectory or maybe a somewhat lower trajectory if they're not able to fully replicate the tariffs that they had before. I haven't seen a lot of evidence that tariffs are going to go much higher from here, but we need to see.
Well, does this push out the time frame for you to be able to have confidence that we're not seeing a tariff impact?
Just on the tariff effect, setting aside geopolitics in Iran, just on the tariff effects, it isn't obvious to me that it's going to delay the expected deceleration of inflation, because I don't see a lot of scenarios where they're going to substantially increase tariffs from here.
So where do you put yourself now? Obviously, you have to put a new dot plot together for the next meeting on March 18th. What do you think? Do you think, first of all, there's going to be any move in March? I would assume you would say no. But after that, when do you think it's more likely that you might consider it as a live issue?
Well, in December, if you look at my December SEP, I had preferred us not cutting in December, but the committee did. If you just do the math, I effectively had one dot now for 2026. I basically had 2 and 2, and because they did 3, then I brought one dot forward. So that leaves me with one dot coming into recent events, so one expected cut later on this year. Now with the geopolitical events that we talked about, I just need to see. We need to get a lot more data in. The inflation data before Iran, I think, has suggested that inflation is running somewhere between 2.5% and 3%. I think housing inflation is trending down. I've got a lot of confidence in that. Core goods inflation has been trending up because of tariffs. Services inflation, I think, is slowly trending down, tied to the labor market. And the labor market is in a decent place, but showing some signs of softness. And so that's what gave me confidence that, hey, one cut later this year might make sense.
Now, the neutral rate, I don't know. Well, tell us where you think we are compared to neutral, because the question I have is every SEP says that the Fed will hit its target 2 years from now.
I know.
And the next SEP says 2 years from now. Are you ever going to really hit it?
Well, we have to hit it, and I think my colleagues and I are committed, for the credibility of the institution and for anchored inflation expectations, that we absolutely have to hit it. But where the neutral rate has been a big question mark. Over the last several years, we kept forecasting that the U.S. economy is going to slow down, and then it just powered through. I thought when we raised rates as aggressively as we did, that we'd be slamming the brakes on the economy. We weren't. The economy proved to be much more resilient. In the face of tariffs, it created a lot of uncertainty, created a lot of noise, raised goods inflation went up, but the U.S. economy proved more resilient. And so the fact that the U.S. economy has been this resilient, given the stance of our monetary policy, tells me the neutral rate must be higher, at least in the near term. And the thing about the dot plot, which is it's a very imperfect communication device, that long-run dot is meant to represent where is the long-run neutral after all of the shocks in the economy have passed and everything is settled back down to normal. That doesn't necessarily tell us that much about where is neutral today.
We don't know when the shocks will ever stop under
Correct.
this administration. At the last meeting, and you touched on this just a second ago, the focus of the committee's concerns seemed to shift away from the labor market back to inflation. Are the risks now balanced?
They feel more balanced. Again, before setting aside the recent geopolitical events, which we need to understand, the inflation and labor market do feel more balanced. I'll give you a quick anecdote. I go out and I travel around my district, which is Minnesota, North and South Dakota, Montana, part of Michigan, and northwestern Wisconsin. North Dakota is always structurally short of workers. So for 10 years I've been going to North Dakota, and the number one issue I hear from businesses large and small is we can't find enough workers. I was in North Dakota a couple weeks ago, a roundtable of small businesses, and roughly half the businesses said we're fully staffed. That is the first time in 10 years I've heard that from businesses in North Dakota. Part of the story of why there's been no job creation is because there's been very little immigration into this country. But anecdotes like the North Dakota anecdote suggest to me there's also not a lot of underlying organic demand for labor right now. So I do see signs, yes, 4.3% unemployment rate is still a good unemployment rate, but I do see evidence that the labor market is not demanding a lot of more workers right now. So I take that and I try to balance that against the fact that inflation is still too high, but I do believe it's gently trending down.
Now, you said you travel around talking to businesses around the district, of course, and I'm wondering what they're telling you about this low hire, low fire environment. Is it because they can't find workers that they're not hiring, or is it because of all the uncertainty that they're not hiring? Are they finding that they can get the job done with the staff that they have, and therefore we have a new dynamic?
I think it's the latter too. I think there's remains a lot of domestic uncertainty and global uncertainty, the topics you all are well aware of, and they are finding they can get by with what they have. And every business, large business that I talk to, I ask them specifically when I talk to the CEO or one of the senior leaders, are you using AI for real? Not just some little pilot, are you actually using it? And virtually every business says yes. Even businesses that 2 years ago said that they were skeptical, that consultants were pitching them AI and they aren't even sure how they could use it. They give me real specific examples. Now, it's not transforming their whole business, but there are pockets of their business where they've been able to put it to work and do things that they couldn't do before, or do things much more efficiently. And I do think that that is affecting their decisions on, okay, how many people do we want to hire given we are early in this adoption phase?
Staying with AI, because you brought it up, there's an argument that's being made by some people that you would be able to have lower interest rates because AI will increase productivity. There's also an argument that AI will lead to a higher neutral rate because of investment and or demand rising. Where do you come down?
I mean, I think if you have a massive new, AI is not a low capital technology. This is massively capital intensive with hundreds of billions of dollars or maybe trillions of dollars going to build data centers and compute, things you all understand. If the economy, how does that happen? All right, the economy reallocates capital to its most productive use through higher rates. And that means apartment buildings that would have been built absent AI, that capital is now going to shift over and build data centers because mortgage rates are going to be higher than they otherwise would have been. That's how capital gets reallocated in the market economy. And so my first long term, could it have an effect on the neutral rate and bring things down? It's possible. In the near term, do I think it's probably pushing up the neutral rate? Yes, I think so, likely. And you know, people make comparisons to the 90s and Greenspan famously saying, hey, there's a productivity boom. It wasn't a debate about cutting rates. It was a debate about whether they should be raising rates and Greenspan used the productivity insight to say, let's just hold them where they are. By the way, that was about a 5% federal funds rate. And so when people look to the 90s, I think that there are lessons to be learned from the 90s, but I don't look at that and say, oh, that means we should be cutting rates right now when the policy rate is well below where it was in the 90s.
What are these CEOs telling you about pricing? Are they sitting on the need to raise prices? Are they going to be raising prices because of tariffs? Where are they?
The most common comment that I've heard in recent months is you would expect to see some repricing at the start of the year. That they were reluctant to pass on, they passed on some cost to their customers last year. They wanted to try to adjust their supply chains or adjust their product mix to avoid having to pass that pain on. But the longer it goes, eventually they will have to pass it on, and that the start of the year would be a natural inflection point. So I think we are starting to see some evidence of continued pass-through in this early inflation data. But I'm not hearing a lot of anecdotes that they see major inflation waves yet to come. It's more that things are slowly adjusting to the effect of tariffs from last year.
So this is still a look-through-it situation.
It's a pay attention to it situation. I mean, yes, we're trying to get a sense of where we think inflation is headed, but we can't be completely dismissive of the fact that consumers are feeling the prices. I mean, you look at the goods inflation, core goods inflation is real. It should be negative in a normal American economy in recent years. It was negative briefly, and then it has climbed linearly since then. And so that's real, and that's having an effect on the economy.
What's your forecast for inflation this year then? The progression, I assume you end the year lower than we are now.
Yeah, somewhat lower than we are now. And I'm more focused on the trajectory than I am, are we going to print 2.5? Are we going to print 2.2? But generally lowering. Again, I go through the fundamental components, the big components. Housing inflation, I have a lot of confidence, is trending down because we understand the mechanism from new rents and new leases. After a year or two, it translates into the official housing statistics. New rents and new leases have come way down. So we've got a lot of confidence that housing inflation is coming down. That's a big piece of the basket. Then you've got core goods, I talked about, had already returned to slight disinflation, which is normal in the U.S. economy, climbed because of tariffs. That ought to be a short-lived event, unless there's new tariff effects brewing. And then you have core services outside of housing, and that ought to be tied to wages. And if the labor market is slowing, and I think it is, that ought to be coming down. So that's the reason I've got some confidence that inflation is heading in the right direction, but for recent events, which now has introduced a new shock that we need to pay attention to.
Or as I've said, and yet here we are. So how much confidence do you have in the forecasts that you're going to be putting out in March?
I mean, I had a lot of confidence up until a couple of days ago that just like the dynamic that I described of where inflation is heading, I had more confidence. And so now back to where we started. Does this look more like Russia invading Ukraine, or does this end up looking more like Hamas attacking Israel? I don't know yet, and so we need to wait and see.
So let's shift gears a little bit here and talk about the new boss. For you Who fans out there, not the same as the old boss. It might surprise the president, but the Fed chair just can't walk in and lower interest rates on their own. The main power the chair has is persuasion. So how do you think Kevin Warsh will do with that?
I think he'll do well. I mean, he's obviously spent 5 or 6 years as a governor at the Federal Reserve Board, so he knows the institution well. I think he's been focused on and studying these issues for a long time, and I think he will come forward with, he's talked about a wide range of things in between when he was at the board and now. Everything from monetary policy to how we implement monetary policy to how we're organized. I think those are all great topics, and I look forward to hearing what his priorities are and then engaging in the discussion.
He hasn't been exactly complimentary about the Fed in the last couple of years. How's that going to go over? How does that go through the system?
I think it'll be fine. I mean, I think, look, we've made mistakes. We're not perfect. I think we're all doing our very best in a highly uncertain environment. I've said I was on team transitory. I thought that inflation coming out of COVID would be shorter lived and not that bad. I was wrong about that. And so I think we should be forced to step back and look at what have we done well, what did we miss, why did we miss it, and how do we do better going forward.
Now, assuming he is confirmed and in place on time, How long will it be before people like me are referring to it as the Warsh Fed, in the same way that people ask, when did it become the Trump economy? When do you think people will look at it as him as the centerpiece driving the Fed?
Boy, I haven't thought about that. I mean, that'll be for you. That'll be your call, because you're going to be writing the headlines, or your editors will be writing the headlines on top of your stories. I don't know, but people are going to take his views seriously the moment he shows up, the moment he engages in debate and makes. The chair has a lot of influence. The chair can say, "Hey, here are the range of options I want the committee to consider," and then we have deliberations around those options. And so I think the day he shows up and starts setting the agenda for the FOMC, in a way, it becomes his Fed.
Well, one of the things he wants to do is have a smaller balance sheet. Now, whether that means you go back to scarce reserves or just a smaller balance sheet, where would you come down on that idea?
I think it's timely to have that debate. When I first got to the Fed 10 years ago, I asked the question, why did the Fed switch from a scarce reserves regime to an ample regime? And one of the explanations I was given is that, well, an ample regime is much simpler. Instead of the New York desk having to trade in and out of markets to keep the federal funds rate in the range, you just set a rate, you dial it in, and you forget it. Sounds great in theory. In reality, we do that. We also have a ceiling facility called the discount window. We have a separate ceiling facility called the supplemental facility. We also have a floor facility called the ONRRP. Once in a while, we have to make technical adjustments on the rates to keep things in the range. And then once in a while, the New York desk still has to intervene and inject reserves into the market. So this very simple regime that we've created is not nearly as simple as it was originally explained. And so for us to step back and look at that and say, is this optimal for the U.S. economy? I think that that would be a debate that would be well worth having.
He also thinks that y'all talk too much. And he has suggested he'd like to see fewer, more coordinated speeches and essays. You've been at the kind of forefront of communicating through all kinds of means. So should he clip your wings?
Well, I don't know what you're going to do all day if he does that. Here's the challenge.
Bias.
Yeah, exactly. Here's the challenge. So this is my approach to communicating. When I go out across my district, we get lots of invitations from chambers of commerce and universities and Rotary clubs. I turn down the vast majority of those, but I do want to visit every state in my district at least once a year and just communicate what is it that we're looking at the Fed. Most of the time, I'm not seeking to make news. I'm just explaining, hey, this is what's going on in the economy. This is what we looked at. This is why the committee made the decision that they made at the last meeting. Now, I also live stream these events in the spirit of transparency, so I'm not shedding secrets. And yet, me doing that can lead to some headlines. And now, when you have 12 presidents doing that across their districts, it's good for democracy because we're communicating to our constituents, but I can also see how people say, well, it generates a lot of headlines on certain news outlets. And so I don't know how to change that if you want to be transparent to the American public and transparent to the communities that we are charged to represent. That's the part that makes it hard.
As far as we know, Kevin Warsh hasn't been formally nominated yet, and then he has to go through the nomination hearings, and we have one senator at least who says he's going to block everything until the investigation into Jay Powell is finished. In your understanding, what happens if Warsh is not confirmed by the time the chair loses his chairmanship, not his seat on the board?
Well, this happened between Jay Powell's first and second terms, and it happened sometime in the Greenspan era too, where there were delays, not through any big problem, but there was just a delay in the White House acting and the Senate acting. And my understanding is the Board of Governors votes at that moment to then re-extend the current chair to serve as chair pro tem. So it's just an extension, so to speak, of the role at the Board of Governors, and that'll be up for the governors to sort out. But that's the precedent.
Well, the interesting thing is you vote every year who's going to be the chair of the Open Market Committee, and this year you voted Jay Powell to be the chair until next year. But in that past episode, they just voted to have him be the chair until a successor is in place. Was the board trying to send a message?
I'm unaware. I mean, that was every year. I'm used to every year we have a vote on who the chair of the FOMC is going to be for that year, and this just seemed like the routine process that we followed every year. So I'm unaware if there was some implied message intended to be sent.
Would you like to see Jay Powell stay on as a governor?
I think Jay Powell's done a terrific job as a governor and as chair, and I'd love it if he chose to continue because I think he's a great colleague.
We'll finish up with an audience question here. If employment continues to soften and inflation doesn't come down, which is worse for America?
It's hard. You know, this is a pickle. I'll give you a quick example. Conventional economic analysis says that recessions, so high unemployment, are devastating and worse than inflation. But when I actually talk to workers, like I've talked about this publicly before. I've talked to a local head of a labor union in Minnesota, one who represents low-income service workers. And she made the opposite comment. She said for her members, inflation is worse than a recession. And I said, I don't understand that. In a recession, you lose your job. In inflation, you just pay more. She said, because my members are used to recessions. They rely on a brother, a sister, a mom or dad, a friend who still has a job to help them get through it. But inflation affects everybody. So there's nobody in your network you can lean on for help because they're all suffering like you are. That was a profound insight that I was not ready for, and it made me step back and reassess my judgments about these things. So I'm going to give you an I don't know answer. We got to get inflation back down to 2%, and we need to keep the labor market strong.
So all these people can rush out at lunch and trade no move in March?
I'll let you speculate about that.
All right. Neil Kashkari, thank you very much for coming in and joining us today.
Really appreciate it. Thank you.
Losing my microphone. I'm your sort of last guest here in the sense that I get to send you all off to lunch. It is lunchtime. Before you head off, please, these are the brief instructions you need to know so you know where to go. Our staff also is going to be outside to guide you. If you're attending the general networking lunch, you are going to go out this set of doors, make a right, proceed down the stairs. And be sure to check out the Investco QQQ Resource Center while you enjoy your meal down there. If you are registered to attend the Technology Empowering Growth Lunch Breakout, sponsored by Investco QQQ, please exit out the doors and go straight down the hall to Hub 1, near where you walked in today. And if you're registered for the Unlocking IPOs Roundtable Lunch, you will also go straight down the hall to Hub 3 for that. Just outside the hubs for these 2 days, by the way. We invite you to visit the Bloomberg Terminal Lounge, grab a coffee, connect with colleagues, chat with Bloomberg experts. You can look up WIRP and see what the odds are of a rate move. So please be back here at 1:45 p.m. sharp. We'll pick back up with a great afternoon of speakers, including a live podcast taping of The Deal with Alex Waxman of 6th Street. And a reminder, if you haven't done so, scan your QR code to download the event app. You can see the Invest community schedule. You can see you can schedule meetings with people in attendance and plan the rest of your day. So have a great lunch, and we'll see you all back here in an hour or so.
Everybody's playing loose. What if we were real with that you've been feeling it too. Let's admit the truth. Never gonna love another like you. What if we were real with the signs? I'm just too good for half love. Know that you've been feeling it too. Admit the truth. Never gonna love another like you. Never gonna love another like you. Never gonna love another like you. Never gonna love another like you.
Strange summer, I rolled on, didn't think of you. We lost touch with each other. Fall came and I had to move. Moving backwards, hurt comes after. Healing doesn't happen in a straight line. If I cry just a little and then laugh in the middle, if I hate you and I love you, then I change my mind. If I need just a little more time to deal with the fact that you should have treated me right, then I'm more than just a little justified. I'm more than just a little justified to touch somebody. You know I tried to make that you. And when you lied, said you didn't want me, tell me what was I supposed to do? Moving on was feeling strong, but healing doesn't happen in a straight line. If I cry just a little and then laugh in the middle, if I hate you and I love you, and then I change my mind. If I need just a little more time to deal with the fact that you should have treated me right, then I'm more than just a little justified. I'm more than just a little justified. If I die just a little, inside just a little, if I want you and I call you, then I change my mind. If I need just a little more time to deal with the fact that I should have treated you right, I'm more than just a little. If I cry just a little and then laugh in the middle, and I hate you and I love you, and then I change my mind. If I need just a little more time to deal with the fact that you should have treated me right, then I'm more than just a little justified. I'm more than just a little justified.
In your eyes, I was not baptized. Everything's alright when she calls me back. She calls me back. Lost for a long time. Two parallel lines. Everything's alright when she calls me back. She calls me back. Look at me and don't you lie. I could be your sacrifice, but don't you hold your head up high. I do not have time. I could be in no tattoo to remind me when I get bad news that I do not exist to die, but then to die while saving you. There's a bite at your edges. Do you lie awake restless? Why am I so obsessive, hanging on to every sentence? This town's the same as you left it. Your page is blank, but I read it. I'll still dilate 229931667. Oh, there was heaven in your eyes. radio was taunting me. Every song a minor key. And I don't get much sleep most nights. I'm seeing you in every dream. If only I could wake you up. If only I could fall asleep. I love you when the ocean's dry. I love you when the rivers freeze. There's a bite at your edges. To lie awake restless. Why am I so obsessive? Hanging on to every sentence. This town's the same as you left it. Your page was blank, but I read it. I'll still dial 822993167. Oh, there was heaven in your eyes. I was not baptized. Everything's alright when she calls me back. She calls me back. Lost for a long time. Two parallel lines. Everything's alright when she calls me back. She calls me back. She calls me back. Oh, the pain I should have saved, though I was too afraid of living life in your footsteps. In your heart, open your way. Oh, I was too afraid of living life in your footsteps. Living life in your footsteps. Living life in your footsteps. Still she calls me back. Still she calls me.
I don't think the weather could predict how much it rained this morning. I don't watch the forecast, but I think a hurricane is coming. It feels darker, and I don't know of any way to stop it. And I don't think we'll ever be the same. Don't know if there's anyone to blame. I just said goodbye, my love. Done nothing but cry for us. I knew the sky could get so gray. It's time to put my umbrella away. I just packed my winter coat away. I've put it in the garage, next to all the Polaroids I took. I guess you couldn't care less. You got colder, and I don't think there's anything to hope for. And I don't think it's ever gonna change. Don't know if there's anyone to blame. I just said goodbye, my love. Done nothing but try for us. I knew the sky could get so gray. It's time to put my umbrella away. I just said goodbye, my love. Done nothing but cry for us. I knew the sky could get so gray. It's time to put my umbrella away. Dancing on puddles mirroring light from up above. Raindrops showing small reflections of the way we were. Dancing on puddles mirroring light from up above. Raindrops showing small reflections of the way we were.
your time and attention today, and thank you for joining us for the lunch. Real quick show of hands, has anyone attended Bloomberg Invest before? Fantastic. I've had the opportunity, as you've heard me say earlier, attend a lot of different events from Bloomberg Tech to Bloomberg Invest, and Lisa and I have done a number of smaller regional events that look and feel a lot like this lunch, where a smaller room, we get industry leaders on the stage to discuss very impactful topics, and I really feel that these sort of discussions have been some of the best that I've seen with the different events that we've partnered with Bloomberg on. Now, with today's specific topic, I'm very excited to hear about. Having covering the Qs now for 5 years, especially over the last 3 or 4, my world and time has been allocated so much to data centers and hardware and software. Really where we're gonna see a lot of impact in the years to come, whether it's AI or just technology in general, is gonna be from the businesses that we're gonna hear from today. How are these different technologies going to be propelling their businesses forward, whether it's finance or someplace else, is really the impact, the next leg up, in my opinion, that we'll see from this overall lift that we've been seeing over the past 3 years. The last thing that I wanted to mention to you all is that Invesco's CEO, Andrew Schlossberg, will be on the main stage at 2:15, where he'll be discussing how technology and how things are changing the overall asset management landscape and specific to Invesco. So I hope you all are able to join him for that. But thank you very much for your time. Enjoy your lunch, and Lisa, I'll pass it back to you. Thank you.
Van Bearden, welcome.
Lisa Matteo.
Welcome. I am very excited because this is your first public appearance in this new role at Wells Fargo. So this is an exciting time.
Oh, it is.
It is, it is. So I want to set the table for everyone just to give you the background. So you started as a head of technology. Then you went to the CEO of consumer banking, small business banking. Now you're the co-CEO of new consumer banking and lending, but also the head of AI.
Yeah.
So all those transitions that you went together, talk us how that helped prepare you for where you are now, from role to role.
Yeah, there's a story there. First of all, thanks for having me here, Lisa. It's great to be here. If you look at each role is built on the last role or a couple of roles that you had. So if you look at my resume, you will see I've been leading large technology domains, transforming technology domains for the last 15, 20 years. And it taught me a couple of generic leadership skills. First of all, setting an aspirational strategy. Secondly, creating the followership that is needed by winning the hearts and minds of your people. And then 3 is really the biggest thing, executing a strategy. So when Charlie came with the question in 2023, do you want to lead the consumer and small business bank, I had to think about it for 48 hours, had a conversation with my wife, decided to do it for one other skill set that is really important for a consumer bank CEO, and that is the knowledge of technology, a deep knowledge of technology. Everything is at scale. We serve 55 million customers. You cannot have manual processes or brittle automated processes. Now, and then just a few months ago, we did something that was logic and a statement. 2 things. The logic, we integrated 2 lines of business that were serving the same set of customers. We had consumer lending, led by my dear friend, Kleber Santos, and co-CEO, and we had consumer and small business merging together, looking at the customer through 1 lens instead of 2 lenses. That also allowed me to free up some time to start taking on the statement type of role, which is AI and running the AI program. It says something. It says something about it's important for the company, it's business-led, and it's focused on the customer and the clients that we have.
Now you mentioned a word when you were just talking, strategy.
Yeah.
What is your strategy in this new role?
Yeah. The strategy is simple. If you look at generative AI, agentic AI, all of us here in the room will agree it's transformative technology, right? So for us, the strategy is to fundamentally transform how the bank operates. And that means making our people, especially our bankers, more productive. It means making the customer experience even better with the help of AI. And last but not least, removing manual work also with the help of AI. Now, strategy is great, but you need to have a couple of principles that we are very disciplined upon to execute that strategy. So we focus on the highest impact use cases measured by ROI. That's where we prioritize our resources and investments, but we leave a little bit of money and just enough people to also constantly explore new versions of LLMs that are coming in, new agent technologies that are getting rolled out. So you need to focus, but at the same time, you need to keep on learning. That's one. Two, AI upskilling. If there's one word that I can leave behind here, it would be upskilling. Making sure that your people, our people, are like confident in using and working with AI. And the last one is a sense of urgency. I talk faster than I normally do, and that's really because of the sense of urgency of what is happening in the market with AI. But you cannot allow that to happen at the expense of safety. So risk and risk management is a very important thing while you roll out a whole set of new technologies.
Excellent. And we're going to dig into that too in a little bit. I want to talk more about the different sections of Wells Fargo, because you have consumer banking and lending, right? You have commercial corporate investing, wealth investment management. Can you give us some specific use cases or examples where you're using AI in those different sectors?
Yeah, we have plenty of use cases. And before I answer the question, we like to think about use cases as patterns or groupings of use cases that intend to do the same. Because if you see everything as a unique use case, you build it 15 times, well, maybe you could build it once and use it across the company. So if you look at the groupings of use cases that we have, and I will give an example per grouping, the first one will be really banker productivity. We have wholesale bankers, we have the wealth management advisors, and we have the licensed and personal bankers in the branches. If you look at the use case that I want to highlight, is really what is happening with the licensed bankers that we have in the branches. Today, they are preparing for a meeting with a client or an appointment with AI-generated summaries that are so precise and near real time that it really captures what is really needed for that conversation. On top of that, we have propensity models, the likelihood that somebody is going to accept a certain offer, that are now so strong that together is leading to 25% more checking account openings, 25% more credit card openings, and also more deposit balance building. And this is this is compound revenue for the future. That's an important one. It also takes away for bankers this mundane task of gathering all the data before they meet. Now they can really focus on the conversation. The second grouping of use cases that we have is really in customer service. And we all know the use cases like in call centers and contact centers. We have them as well. We know the top 20 reasons for our customers to call us. And we started the rollout of agentic AI in the call centers. Another one is Fargo, which is our virtual assistant in the mobile app. It started on a very, it's by now almost an old natural language processing model from one of the big hyperscalers that we all know. And it did the job. We had over 1 billion interactions where our customers were asking Fargo for help. Every time we helped our customers, we avoided them for making a phone call. So they don't need to make the phone call or they don't need to go to the branch. They could help themselves. Now we're upgrading Fargo into a full LLM-generated type of virtual assistant. Then the last grouping, and then I will stop answering the question, Lisa. The last grouping is really about making sure that we remove manual work, and you go into the areas of case management, you know what I mean, where something comes into the bank, we have people looking at it, dispositioning it, next step needs to be made, then somebody needs to assess what has happened. I give you complaint management as a great example. And then you need to create a kind of acknowledgement letter. That is so much agentic AI. So we are rolling out agentic AI in this type of processes in operations, and we do that at scale.
Now, with all that said, technology is definitely changing the way people work. How is it affecting different employees? Are certain roles leaving or are certain roles advancing? How is it affecting the workplace?
Yeah, I spoke about upskilling, so I think that's a very important part of the answer. But yeah, of course, how work is done, I explained already for the bankers, their day is different. Instead of gathering all the data for the customers that they are going to see that day, they can really focus and rehearse their own conversation where needed with the branch manager. We have people in operations. If an agent now comes in, we have the first agents in QA, for instance, quality assurance and quality control. Their task is becoming to oversee the agent. Their task is to work with the agent to see, is this going in the right way? That is a different way of doing the role than you did before. Upskilling is so important. Upskilling means for us working with AI, overseeing an agent, being the overwatch, with confidence that you know how to do that. But there's something else that is important, and that's what we call employability. And we started this whole journey of keeping our people employable to be able to bring them from work to work inside the company already years ago, before AI and generative AI came. We have internal colleges in the bank, consumer college, we have an operations college, we have a credit college, where people sign up for that college, and they can lay out their own path where they want to be in 3, 4, 7 years from now. And we lay out which expertise, experience they need to build up to get to that level. And it could be a very jumpy path that we are laying out. It's all automated and generated by a smart model. 60% of the folks on the consumer college have signed up for that. And what we see, and that's for me the most important part of the impact of AI, employability is a two-way street. We as an employer need to provide these tools by which your people stay employable inside the company, so you can bring them from work to work. And if that doesn't work, we make them employable for the labor market and for other companies to bring them from work to work.
Now, you touched upon something earlier, and I want to kind of dig a little bit deeper into there. It's the investment in technology and how you see kind of ROI you had mentioned. How do you measure success with this technology?
Measure success is a couple of different ways to look at it. It's ROI first, and ROI really means investments, the run cost of agents, and I tell you there are models where you pay $75 per token, and there are models where you pay $3 per token. And if you have a little bit of a massive model going on, the cost can be really high. So it's run and investment cost. And then for the benefits, we look at revenue increase. If it's really, we can mark it out as that's truly created by this model. It's always a little bit murky with revenue increase. And of course, the cost savings. And then you have the ROI. ROI is not the only thing. You also have to measure risk, like for us, like AI incidents with material impact. If there would be an incident, you want to know, and you want to know why that happens. That's really balancing ROI. You want to make sure that your people are indeed employable. That's another one. So it's a balanced scorecard, if you want to call it like that we use to measure the success, not only on ROI, not only on risk, but also on the people component.
And then increased capacity means more customers. I mean, there's so many different ways to look at it.
Absolutely, yeah.
So what about, you mentioned risk. So this is, I mean, banking is such a heavy regulated industry. How do you handle that with data?
Yeah, the risk of AI. Yeah. There's before I go there, there's the risk of non-action. So you could say, oh, the risk on AI is way too big, we're not going to do it. I think that risk is honestly bigger than starting to work with AI in a mindful way. There's a French philosopher who once said, like, if you invent a ship, you also invented the shipwreck. So think about the words like, and that's like for any new technology, it is a great new technology when it works, but it can be breached by bad actors. It can have a cyber issue, it can have a data leak issue, it can have a resiliency issue, whatever it is. So for us, risk management, Lisa, is our bread and butter as a bank, especially where we come from with our backdrop of the history. We have risk management in our genes. It's like the bread and butter. So what we do is really looking at generative AI, agentic AI. What are the new risks because of this? Or is it a new manifestation of the same risk? How do you mitigate it? Which controls do you need to build? Automated controls. Which ones are we already have? Which ones are new? Are they effective? If they are not effective, how do we make them effective? That you hear it saying, that's our risk model. That's how we work. That's how we think. Leading with a risk mindset is fully ingrained into the company. And that's what we do with AI as much as we do with blockchain, as much as we do with any other new type of technology that comes in.
Now, risk, you mentioned risk. The company has been under regulatory actions over the past few years. You've been very, very transparent about it.
Yeah.
So when you think about that, and then now your asset class has been, asset cap has been lifted.
Yeah.
I mean, that opens up whole new possibilities. So take us through that transition and what it means for the company.
Yeah. So that transition was a day in May when we all got the news that the asset cap was lifted. And the asset cap, for people who do not know what that means our bank balance sheet couldn't grow. And it's a little bit like running with one lung instead of two lungs. We couldn't grow. We had not the oxygen to do that. The day that that asset cap was lifted, by the way, Bloomberg had the scoop. You all knew it faster than we knew. But we heard it through Bloomberg. Everybody still remembers where they were. Everybody still remembers that moment because we were for 7-8 years bugged down, working hard to remediate the whole bank from the situation that we were in and where we came out. We also knew that the moment the asset cap was lifted, the expectations would be, now you're going to grow. And Charlie Scharf, our CEO, always said it like, this is not a flip of a light switch type of growth. It's not like suddenly asset cap is lifted and now we grow like yanking crazy. That's not what it is. What you do is compound impact of all the things that we have been doing with a strong risk platform and foundation. But what we have been doing since then, and even before lifting the asset cap, quadrupling marketing in the consumer business, already growing checking accounts, already growing credit cards. We've been investing in CIB, the corporate investment bank, with hiring MDs, and really building out advisory business. We have been investing in the branch network. If you have seen them lately, they look different than how they were looking 5 years ago, 7 years ago. We're opening new branches here in New York. Like we are on a roll here in New York, Manhattan, but also bigger New York metro area. We're opening in Chicago, we're opening in Tennessee, we're opening in Texas. We're open for business in that sense. We're hiring more bankers. We create more capacity for the bank to grow, also with the help of AI. And what you hear is, I think I used the word grow or growth 10 times in one sentence, so that you know the theme and the memo. That memo went out.
It did.
Yeah.
And speaking of growth, where do you see the technology growing? I mean, what are you keeping an eye on? What do you think is the next thing that you'll be working with?
Gosh, Lisa, that's a hard question because if you would ask that 5 years ago, nobody would have said like generative AI will be completely mainstream. We even didn't know what it meant. So I think there's this technology where suddenly there's a popping moment. And AI had this popping moment in 2022 with ChatGPT and the release and the announcement of ChatGPT. It was popping. Like suddenly AI became mainstream for everybody in the street, everybody at home. You all have it on your phones. We all use it every day. There's one thing where I think this could happen as well is with quantum computing. And I've been talking about this for the last 10 years. There could be a set of researchers now, 5 people in a room, who are finding out how to make it more scalable and more stable in the outcomes of quantum. And if that happens, then we have no idea in this room what type of compute power becomes available. And then you start to think about AI and the level of increased intelligence that is happening and still happening. Then you start to look at the compute power by quantum compute. And places like the markets, we call that the markets in banks, trading, the trading areas, they all run on large quantitative models. If we have all the power and all the data, then you can go, so that changes the whole dynamics of that industry. Yeah.
So in that same line, what concerns you? What are you worried about, thinking about where technology is going?
There's always like, listen, are we still knowing what is happening? Like, are we still conscious about it? And are we still making decisions that we feel like are our decisions? There's always the bad actor. Like I said, the ship and the shipwreck. So there's always someone who tries to exploit that new technology and use it for their own benefit at your expense. And I think there's something like, if I can make one call here, is keep on using your own brain. That is like, and that's our brains, if you actually start to look at it, student syndrome. We all went to college or school. When did you start to learn for a test? It was like only when it was needed, right? Because your brain is just not liking to be active that much. Cognitive effort is an uphill thing for your brain. Now, with the coming of the phone and generative AI, our brain is suddenly saying, great, I don't need to think anymore. The only thing that we need to do is just keep on thinking through, play chess, think about, read a book, think differently, challenge yourself. That's the only thing that I would say in terms of what is changing and are we still in control of our own lives. Use your own brain, I always say.
Good
That's
advice.
a Dutch remark.
Before we wrap up, I can't have the head of AI next to me and not ask how you use it on a personal level.
Oh, there's so many different examples, and I think the most important, what I never expected that I would do is asking, in this case it was ChatGPT, for advice to have a difficult conversation with one of the boys that we have. And I never expected that it would be so correct in terms of empathy, unintended consequences. If you use these words, avoid these words. It was a holy pistol that I read, and I shared it with my wife. I said, I think we have a great script here. I never expected that would happen. I use it for anything that breaks in the house. You have the live function. So when the laundry machine was broken not so long ago, you just show the error and the way, and it gives you back like literally what you have to do, which steps you have to take.
Did you fix it?
Yeah, we fixed it. Yeah, no, it's not like a miracle because the thing really knows. They really know. The models are so intelligent because everything is loaded there. Yeah, those are two examples.
Those are two. For me, it's put a lot of debates between myself and my husband. It's figured out, and who is the winner of that debate? That would be me. Well, thank you. It's a pleasure. Thank you very much.
Thank you for having me here.
Next up, we have my colleague, Romain Bosick. He's going to bring up his panel, and they're talking about winning through innovation. Thank you.
We can actually move in the middle of this if you really want to here, but thanks to all three of you here. I mean, basically, three people from very different industries, but to a certain extent, doing very similar things, and obviously the way you're incorporating AI and other technology into your businesses. And I want to first start with the consumer-facing side of it all. And Carol, since you're sitting closest to me, we'll start with JetBlue, which I think most people in this room are familiar with the origin story, and obviously it was an airline that really sort of started from day one with this idea of in-flight entertainment and other technological tools in the cabin for the consumer to make the experience a little bit different. How has that evolved over the last 26 years? I mean, what are you doing right now?
Yeah, so thanks. It's great to be with you all today. And yeah, innovation is in our DNA. We were the first airline to offer seat-back entertainment. We were the first airline to offer free onboard Wi-Fi, and that has continued to be a big part of how we show up for our customers. Look, I think the things that have evolved over the last 25 years have been really around customers are much more mobile first. They are much more, and we have to meet them where they are. So a lot of customers today, they have no appetite for friction. I'm sure if you think about it and you think about how you shop and how you travel, each and every one of you probably just gets annoyed with all the different friction points that come in any of those experiences. So I think the place that we are most focused on using technology from a customer-facing standpoint is how do we remove as many friction points as possible throughout that journey, so that we have our legendary hospitality available for customers if they want or need it, but we don't require those friction points. So,
Are there friction points in the beauty space?
Sure, there's lots of friction points.
Mm-hmm.
And I think, I have a view because I had just come from banking before I was now at Estee Lauder, and there's a lot of similarities because it's all around the consumer experience that you want to deliver. And, whether it's understanding online what I want to buy, what kind of product, what is the efficacy of it, how do I use it, what's the regimen that makes sense, what's good on my skin tone, and so all of the things. Like, how do you bring the wealth of information in a simplified format to what consumers want in a very personalized way? So that's kind of the challenge.
Who's the more demanding customer, banking customer or the beauty customer?
Well, I think so. people in general are people, right? So I would just say,
Is that a compliment or criticism?
I think, no, it's not. It's just sort of the reality of how is it that you really are where the consumer needs to be, a bit like you were just saying, and how do you give that experience that it's like 1 or 2 clicks and I have what I want, and then most importantly, how do I kind of buy it and have it sent to me as quickly as possible? Or when I'm in a store, how do I understand like what it is, where is what I'm looking for, and how do I kind of interpret like how you would use it? I think it's a lot about like education as well.
But with regards to the friction points of just even making a selection, and I just want to just draw the distinction between an airline, I mean, anyone who's booked a flight, you spend a lot of time looking for the right price, the right seats, the time, everything else. But the same thing with beauty products. It's, you know, you're trying to find that best serum for your face, and, you know, you can spend an entire weekend just trying to figure out what's best or not. So how do you make that process, A, easier, but more importantly, to make sure they actually buy something that's an Estee Lauder product?
Well, so, I mean, I think, again, like, you know, being where the consumer is, and one example of what we had done, so buying fragrance is really difficult. So we created an AI scent advisor so that you can have a conversation with the large language model on what I like, what I think my friend or, you know, whoever you're buying a gift, you know, what they may like. And it kind of interprets that. It uses a taxonomy on your senses, on your olfactory senses, and the taxonomy that we use. And then it provides you with a choice. And we found that, you know, our best sellers in stores or online are not the ones that people are choosing, because now all of a sudden it's just relating like an experience, a memory, or something else. And then we kind of serve up, because we have all the data on exactly what the underlying scents are, to sort of satisfy a customer need. And we're seeing like a 2x uptake once people engage with that scent advisor.
But even if they're not able to smell it in person.
Yeah, because the whole idea, like, so I don't want to maybe have to go to a store and kind of smell it. So we do an amazing job with our beauty advisors in stores, but we want to be able to provide that experience online, easy, simple, and frictionless as possible.
So Locke, you don't have a scratch and sniff program.
What's that?
Paramount. This is for Locke.
No, nothing at Paramount like that.
Yeah. Well, you never know. There may be a placement.
And just to be clear, so there's no friction between you and Carol. JetBlue does carry Paramount Plus and Peacock, right? Talk a little bit, Locke, about your use of it. And I know for you, it's not just the consumer-facing side of this.
Yeah.
It's also about what you're doing internally in the company to make things more efficient.
Yeah, I mean, like, I think everyone's kind of heard Paramount in the news in various different degrees. And, like, just to take a step back with Paramount, like, we've gone through multiple mergers over the last 6 years. So I'm kind of in the middle of almost my 3rd one now.
Yeah.
So one of the things
Is that the last one?
I hope so. I feel like I've definitely got an M&A background at this point. But, you know, I think one of the things that we've noticed in, like, comparatively the first time we did this merger was, like, we were doing a traditional M&A. We were combining systems together. Like, any, you know, the first question I got during those days was, like, how do I get email to be one email across the board? Over the last year, it's been a bit of a different story bringing Skydance in. It's been more, not necessarily about systems so much, but how do we make the experience, everything completely frictionless? So, you know, we've been really looking at AI as being sort of like a one-stop shop for folks. So imagine like when you hear a lot of the folks talking about all these bots and they're building out things, but then when you're bringing a company together, we went with sort of an approach of having like one bot coming in and answering like your IT questions, your finance questions, your HR questions, and trying to make the experience for employees, I would call it frictionless. Because like a lot of our employees have gone through a lot of change. They're trying to figure out, you know, what systems are out there. And so like our real push now is to make it as seamless as possible. Like we want an employee to, from the beginning of hire all the way to leaving the company to have like just a basic, you know, you should just be able to say, I want to buy a pencil, and I should just do it. I shouldn't have to know what my ERP systems are or what my, you know, whatever related parties are. So that whole networking and agentic feature has been something we've been driving towards.
But as you're building out these products, whether it's the consumer-facing side or internally, there is this question of making sure everything is cohesive, right? You're not just bolting on AI on top of systems, or are you?
No. Like actually the biggest challenge we have is a kind of a balance between our relationship with our enterprise vendors out there. So everyone knows that every enterprise vendor has some form of AI at different degrees of education. But there's also, on the other hand, a lot of new tools out there that enable building things much faster. We're not, we're striving to be more of a media tech company, and so embracing that, the new AI tools that you can just start developing on the fly. It's actually a little bit of an art in that respect, is that 1 minute I built something and then all of a sudden my enterprise vendor built something slightly better, 2 months later. And so what we've built is like sort of I call it an agentic framework, where it's not supposed to be legacy rigid. Like, it's not supposed to be something that if I build this thing, I can never undo. Like when you go into an ERP system, I like using that as a good example, those take a long time to stand up. So the way we're building this is a framework that covers both InfoSec, it covers the ability for us when we bring on new solutions, either it's an enterprise or we build it, follows a set of standards that's easy for us to plug in. And that's the key. It's like we should be able to take in and out different solutions, and it shouldn't be like a full-on orchestration to do it. So I think I would say we're at the early phases of it, but part of what we're doing as a company is we're not just tying it as an IT or a finance thing. What we're finding is that each one of our business units, and we range from like your rights, your productions, your advertisement, all of them are kind of coming with us with different use cases, and having that sort of framework that we could repeat for all of those solutions is actually like the most important thing we're doing right now.
I would assume, Carol, for you being an airline, that you have a lot of complexity as well, and making sure that things are cohesive across the board.
We do. We have incredible. We have an incredible amount of complexity, and there are so many things in our world that are outside our control. If you look back to the last 4 months, we've had 2 government shutdowns. We've had a Venezuelan airspace closure. We've had a blizzard, a snowstorm, and you name it. And so one of the ways that we try to also use technology for the benefit of our customers and our own internal crews is we've for example, leveraged machine learning to build a digital twin that is predictive of our operation, and particularly kind of takeoff and landing times throughout the day for 48 hours in advance. And the reason we have invested so heavily in that is it actually gives our operating teams a leg up and a heads up to be able to be more proactive and anticipatory when things like this happen. Look, when you have no one hates to cancel flights more than we do, and no one hates to delay flights more than we do. Customers don't like it. We don't like it. It's expensive. It's painful. But when you have a big blizzard, like, there is no other option. And so when we're faced with events like that, we have technology that can help us to take in thousands and thousands of different pieces of data that are happening and changing real time, and to give our operators the ability to start being much more predictive about the decisions they're making. So they can actually see a decision I'm making now will create this problem tomorrow, and then make a different decision. So that's allowed us to help improve on-time performance in the customer.
So you've seen that improvement.
We have.
That's verifiable.
Yeah.
How much do you have to work, though, with, for example, the airport itself, and obviously the regulators and things like that? I mean, because like as you said, a lot of this is out of your control.
It is.
Yeah.
Look, yes, we have a lot of different entities we have to work with, whether it's airport authorities, government authorities, regulators, other airlines, partners, all of them. And yeah, I mean, we work together as collaboratively as possible. And even with other airlines, we fight fiercely and competitively every day, but we also do belong to a broader industry that is trying to generally get customers where they're going on time.
I'm curious, and this is all for all of you, as you're rolling out these tools internally, externally, I mean, what has been sort of the response that you've gotten? I mean, there are a lot of people that have been distrustful of some of this technology, whether it's internally, it's going to take my job, and even externally. If you're going to a customer, for example, Brian, there's a trust factor. How do I know that you really are picking out the best scent for me, or not just driving me to, I don't know, say the most expensive cologne or whatever?
Well, I think it depends. I mean, on some of the things that we do, I think it's very interactive. So it's more of an experience than thinking about the trust factor. I think we see the trust because when people buy the product, they like it. And really, a satisfied customer is really what's important to us. And then really kind of training models so they get better and better, over time. And I think you just improve that experience. You improve the level that you can target what somebody really wants, and you learn from all the different people around the world that are using it. So, we have a great audience of people that follow and love our brands. So that's how, really kind of taking that data. But I would say in general, the trust factor, comes when you're trying to drive efficiency with AI and start using agentic strategies for workflow. And, people more immediately think about, well, we're trying to like take my job away. And so I think kind of really showing people that we're trying to like increase throughput and we're trying to increase quality and move people to roles that are really more value add to the organization and take away the things that in a lot of cases people really disliked. And employees, to what, saying the whole idea that it's really complicated to deal with a lot of different systems and technologies just to like do the basic things like I want to see my paycheck, I need to change something. You can really make that easy. So the cultural aspect, I think, is even bigger. The trust, how you treat people's data, like you have to earn that over time.
Is it easier to do this with, I guess, your established customers, meaning the people that have already been repeats, or the new people that you're bringing in, maybe someone who hasn't actually touched a product?
Yeah, I think it's both sides of it, because as you think about like social media and influencers and how we kind of utilize and understand what's really trending and what people really want, making sure we can connect that to either the products that we have or because it's a new product we launched, like how we can bring that with like the education piece to consumers. I think that like interplay is where you build trust, and doing it from the company that manufactures the product that people know around the world. I mean, people know Estee Lauder almost everywhere in the world. We're everywhere in every country. And so, different than new brands, maybe you didn't hear of one, I think you have to build trust over time, and that takes, a lot of brand building and brand equity.
Are you using this at all, Locks, for content creation at all, or even just tracking maybe what your viewers want to see or maybe they don't want to see?
It's in the media space, AI is a very tricky area. So we had to kind of parse it in a couple of different angles. Like the stuff I was talking about earlier was definitely the enterprise productivity. As a company, we totally embraced it. It's kind of siloed off from like what you call the content piece of it. Content piece can be broken up into like two areas. One is like the actual creation of content, which is definitely a very I'm going to call it a touchy subject in the sense of between all of the unions and regulations associated to it. But around the actual content creation, there's a lot of work that happens in a studio that you would think about, like the marketing creation, the actual supply chain. So there's a whole art we call the media supply chain, where literally when a production creates content and we need to get it out to Paramount Plus, Pluto, which is our free to air, and even to our broadcast, there's a whole set of, I'm going to call it QC and regulatory type of things that we need to look at to fit that. And you can imagine, think of it this way, before AI and before machine learning, someone's watching this. You watch an episode of Yellowstone, you gotta watch the whole thing, make sure everything, the editing, all the commercial breaks, everything is there. So everything we're doing now is, I would say, in support of the content and leveraging things like AI, and a lot of the hyperscaler providers are actually investing in this type of area. So being able to implement those type of solutions before and after content's created, and even like with the marketing pieces of it, is a huge win for us in that respect. But we're very careful about the actual content creation, because that, for given reasons, there's lots of I'll say pitfalls in trying to touch with that.
You're nodding your head there.
Yeah. Really similar where I am in marketing and how we create content and use it and transcreate from there.
There's a power to all this too. There's also a cost, and I am curious as to how you're sort of measuring the potential return. I know there's been a lot of talk about ROI, but when you talk to a lot of companies, they say, look, you have to kind of look at it a little bit deeper than that. It's not necessarily just about what shows up on the balance sheets, that there is sort of a dividend that somehow gets paid back in other ways. I mean, for example, Carol, you're kind of talking about the idea of on time and reducing some of the, I guess, the friction with customers that I would think would maybe engender longer term more loyalty to the airline.
Yeah, absolutely.
Yeah.
I mean, the way we think about it is in a couple of fronts. There are, in the use of any technology that we employ, there are certainly areas where there is a hard cost savings. It's really easy to quantify. But there are also a lot of areas where the value of a better decision or the ability to have a better prediction, or the ability to get to things that we're not getting to today, the ability to provide customers more choice, All of those types of things are things that are a bit harder to quantify, but they show up especially in things like Net Promoter Score, which you can, kind of translate into real ROI. And so a lot of times, a lot of the ROI benefits that we measure are maybe second and third order, but they're still very real and very measurable.
I am curious though too. You came from the world of banking. I know you started out, Carol, in airlines, but you spent a lot of time at Pizza Hut as well. And I am curious as to whether there are any parallels between sort of maybe what you were doing in the restaurant space and what you're doing today now back at JetBlue.
So fun fact, that was the question Robin Hayes, our former CEO, asked me in my first interview at JetBlue. He said, what on earth did you learn in pizza that you think could be helpful in an airline? So I'll give, I think, a similar answer because I guess it worked out. Look, I think pizza is actually a lot more complex than you think. It is nowhere near as complex as an airline, but it is actually a lot more complex than you think. And a delivery fleet is in some ways not that different from, a fleet of delivery drivers and delivery vehicles is in some ways not that different from an airline purchase. For an airline fleet. I think the big differences between the two, pizza is an immediate, instant gratification purchase. I'm hungry now, my family's hungry now, I want food now, and if there is any friction in the process, I will just go to a competitor. Whereas airline choices are a little bit more thoughtful, obviously a higher price point, and a longer transaction with the customer. But that sort of appetite for, or lack of appetite for friction, I think is one of the things that I became passionate about and have tried to translate to JetBlue. So.
Okay, I see why Robin gave you the job. But but on that point of friction too, can we go to like sort of the end of that process? So whether, when you're actually buying the ticket, I know you have, tried some different payment models with Venmo, but I am curious also on the retail side with Estee Lauder, the idea of making sure that as somebody goes through that process, and I know particularly with e-commerce, we've seen this a lot, people abandon those carts when they get to the end for a wide variety of reasons. So how do you sort of get that across the finish line?
Yeah, so for us, I've been there less than a year, and sort of the first thing that we're doing is we're modernizing the whole consumer experience, but in a unified commerce approach, so that we understand whoever the consumer is in a store or online or wherever you may be, that we understand what you bought, what you liked, what you didn't buy. And so I think the idea that you can really quickly understand data and connect it to people, what they like, personalize it in trends, like that really transcends everything. And that's how the real ROI for us is, are we selling more and are we selling more profitably? So we can measure both factors when, if you go through, we know that somebody abandoned a cart, and then we could actually retarget them. We can actually then personalize maybe a promotion or a discount or something else, and we can learn exactly why we think they abandoned the cart. And the data, the large language models, have never been so important, and very, very similar, whether it's in banking or I was in Pepsi before, so I was in a lot of different places, and the idea of data as an asset has never been more critical, and that relates directly to how you can serve customers, how you understand them, and how you drive your top and bottom line.
And for Paramount, that has to be really valuable. Obviously having a streaming service compared to sort of the old way of tracking, eyeballs on TV through Nielsen boxes or at the movie theater through box office receipts. I assume the data you're getting from streaming has to be pretty invaluable.
Oh yeah. It's not even just the streaming and the linear ad sales research and information that we get. The other factor is just where's our content? For us, we have content, I should know the amount of years that we've been out, but we have content back from the 60s and 50s that, we have a treasure trove there. And being able to not just look at the research, but also look at what content is available to us, and as things come up, and being able to pull from that archive in a, much more in less manual ways is a huge piece for us.
Is that you toggle it based on what seasonality? We get our Christmas movies around.
It's either that, or even when a breaking news happens, we can go back to 60 Minutes and pull archives from the 70s that might relate to, if someone passes away. That's, being able to do a lot of that research, and then being able to correlate that information so we could use it for new content.
Yeah.
Especially as a franchise business, being able to take Star Trek and being able to constantly use the previous the footage and information that helps us create new content. It's just, that's a very powerful thing for us.
Yeah, because in the old days, it was basically some guy in a basement who had to go through, actual physical tapes to find
It literally was, and we still are, having big machines that can literally take those things and digitize it. So that's, but once you have it digitized, even just doing the vector embeddings into those things and being able to, easily search across the board is a huge win for both the streaming and even just deciding what we're going to create in the future.
Yeah.
Because the other part of it is actually the rights associated to all this content too.
Yeah.
The licensing and rights, and then tying that together. You can imagine like in a media space being able to, the data science side of it is very extensive in this, because being able to pull all that together and be basically even saying, can we distribute this content in England or the US is it's an art. With some of these contracts that have lasted for years.
Carol, I'm curious as to how you would use that. Kind of in the same vein, but more, I guess, more on the dynamic pricing. Obviously, airline prices adjust based on demand, based on weather, availability of planes, et cetera.
Yeah, we're not really using AI in that way. I mean, we have always, and most airlines have always looked at demand-based pricing, and so we continue to do that in the same way that we always have. But we do look at ways that we can offer customers a more personalized experience overall through their shopping on our digital channels and even in the airport.
Shopping for Estee Lauder products?
Maybe, I don't know.
I hope so.
Yeah, we can see.
Absolutely.
But you also introduced bags electronically.
We did.
So you know that it's on the plane, I guess.
Yeah, so pointing back to that friction point that I started with, we recently introduced the ability to track your bag, also the ability, if you have an air tag in your bag, to share it with us, so that if something were to happen, which is rare, but occasionally it does happen, then it helps us to retrieve that bag and find the bag sooner. And then, we've been very focused also on frictionless payment capabilities as well. So, yeah.
Yeah. And Brian, I am curious on that front. I mean, I know that in the retail space, I know dynamic pricing is kind of a dirty phrase that nobody wants to talk about. But has there ever been discussions about that? I mean, a little bit more of I guess, meeting, even if it's not necessarily changing the price, but maybe adding things on or subtracting things on.
Counting back the days since we've been locked away. It feels like something's changed, and I don't know where you've gone. Dim sun high, you cold. Time goes like a light is flashing by, turning the lid on the microphone. Each time comes around, so before you end up lying there stone cold. Please believe and remember that it only takes one to show that it's not the end. So what's the answer? People need the room to breathe and not be left there on the street. Now how can you say it don't affect me? Well, is this life night on repeat? And I don't need to feel like I'm a rolling stone, fading night, changing tones, a perfect imposition of the sunset and light, but I'm better red than dead. The colors in my head. I know we don't need to see another innocent life lost. So before you end up lying there stone cold, please believe and remember that it only takes one to show that it's not the end. So what's the answer when people need the room to breathe and not be left there on the street? Now how can you say it don't affect me? Well, There's a part of my soul that wants to let go, wants to just run away. But the rest of my soul says I should stay. I should stay. I've been living in the city too long. 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 I'm just trying to find some kind of life I dream about. We're all tired and lonely, hoping to figure this all out. There's a part of my soul wants to let go, wants to just run away. But the rest of my soul says I should stay. Another window, yeah, to a euphoria. Another window, yeah, to a euphoria. Jumping off all my life I've been pulled into all this art. All my life I've been told too many colors to put myself on screen. Yeah, all illusion, constant confusion. It all gets hidden. The truth lies below. All illusion, constant confusion. It all gets hidden. The truth lies below. Yeah. Another window, yeah, to a euphoria. Another window, yeah, to a euphoria. 5 hours I stare, plastic satisfaction. I'm caught in it, tend to get depression. Too many colors to put myself on screen. Yeah. All illusion, constant confusion. It all gets hidden. The truth lies below. All illusion, constant confusion. It all gets hidden. The truth lies below. Another window, yeah, to a euphoria. Another window, yeah, to a euphoria.
Please take your seats. The program will begin in 10 minutes.
The same person, you know me. Changing my hair, interest my feelings. I just got tired of giving. Just want some quiet in the morning. Coffee by the ocean. Crave a little time for me. Maybe I regret this, but won't forget the sick of all of the shameless sense of sameness. It's a burden, like the weight of the world on my shoulders. I can't hold it, but I'm going. Not a race, but I need to keep going. Turn me around, I'm starting over. I'm starting over. Turn me around, I'm starting over. I told you that everything tasted like nothing. Colors that faded, just left with the dumbness. That's why I'm running to something. I'm sick of all of the shameless sense of sameness. It's a burden, like the weight of the world on my shoulders. I can't hold it, but I'm growing. Not a race, but I need to keep going. Turn me around, I'm starting over. I'm starting over. Turn me around, I'm starting over. I'm starting over. Turn me around, I'm starting waking with a purpose, knowing where the hurt is, living with some clarity. Maybe I'll regret this, but won't forget the lessons, 'cause moving on comes naturally. I'm sick of all of the shameless sense of sameness. It's a burden, like the weight of the world on my shoulders. I can't hold it, but I'm growing. Not a race, but I need to keep going. Turn me around, I'm starting over. I'm starting over. Turn me around, I'm starting over. I'm starting over. Turn me around, I'm starting.
Are you stressed out? Well, maybe I am too. Two sides of that same old coin, both broke but pulling through. And you say you need me, feels like I'm getting used. You're a lost girl crying wolf, 'cause you don't have much left to lose. But I do. What do I do? I'm not gonna be around for all the meltdowns, all of the fallouts and calm downs. Girl, you need to be aware we're not gonna make it, so you gotta face it, 'cause I won't always be there. I won't always be there. I won't always be. What was that, girl? Does it piss you off? Knowing I ain't gonna chase you around when you're spinning like a
Please
top.
take your seats. The program will begin in 5 minutes.
But love just ain't enough when your grip on what's reality has fallen out of touch. Yeah, it's true. What do I do? I'm not gonna be around for all the meltdowns, all of the fallouts and calm downs. Girl, you need to be aware we're not gonna make it, so you gotta face it, 'cause I won't always face it, 'cause I won't always be there. I won't always be there. Silence with you on my chest. No blinds in the place where I live. Daybreak, open your eyes, 'cause this was only ever meant to be for one night. Still, we're changing our minds here. Be yours, be my dear. So close with you on my lips. Touch noses, feeling your breath. Push your heart and pull away. Yeah, be my summer in a winter day, love. I can't see one thing wrong between the both of us. Be mine, yeah. Anytime, anytime. Ooh, you know I've been alone for quite a while, haven't I? I thought I knew it all. Found love, but I was wrong. More times than enough. But since you came along, I'm thinking, baby, you are bringing out a different kind of me. There's no safety net that's underneath. I'm free, falling all in you. Fell from men who would how they appear. Yeah. Trapped up on a tightrope. Fast forward a couple years, yeah. Growing up in the place that we live. Make love, then we fight. Laugh, 'cause it was only meant to be for one night, baby. I guess we can't control what's just not up to us. Be mine, yeah. Anytime, anytime. Ooh, you know I've been alone for quite a while, haven't I?
Please take your seats. The program is about to begin.
But since you came along, I'm thinking, baby, you are bringing out a different kind of me. There's no safety net that's underneath. I'm free, falling all in you. Far from men who would have they appear. Trapped up on a tightrope, now we're here. We're free, falling all in you. Every time I see you, baby, I get lost. If I'm dreaming, baby, please don't wake me up.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it. Wow. Everyone has a dream, and a lot of dreams are, you know, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse.
Right.
And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. You don't start on the third floor or the lobby. You actually have to start in the basement.
Please welcome to the stage Alan Waxman, co-founder and CEO at 6th Street, for a live taping of The Deal with Bloomberg's Jason Kelly and Alex Rodriguez.
All right. All right, this is happening. You look good up there with Steve Young.
He was great.
Yeah. So, and now we have the Steve Young of investing. You're not left-handed, right?
Steve he's a much better athlete than I am.
Come on in. Get up in that mic. All right. Alan Waxman, great to see you.
Great to see you guys, too.
We've been circling around this one for a long time. It's really great to have you here. We have so much to talk about. We're going to talk about, spoiler alert, excuse me, a really interesting deal that you did around a certain franchise called the New England Patriots. Almost got there. At Super Bowl, you were there. We're going to talk about that deal and a lot of what you've done in sports. But I want to set the table a little bit and talk about Sixth Street, your firm, because I think it's hard to understand, Alex, the context of what you're doing in sports without understanding the context of the firm and even some of what's going on in the world right now. So 30 seconds, give or take. What's the Sixth Street investing ethos?
Complete flexibility. We invest across, from day one, built the firm to invest across asset classes, geographies, sectors. Where's the best relative risk reward? And we do that by having a team and a culture of people that are over themselves, no egos, no BS, no politics, no fiefdoms. We built our architecture to be an investor-first architecture, so we didn't build it to raise the bigger and biggest funds. We have a fund called TAL, which is basically the largest private capital opportunistic vehicle in the world. We raise smaller strategy funds so that we raise those funds to the size of the opportunity, and then we have extensive capabilities. And that's how we built our firm from day one. That allows us to look across ecosystems and to find the best themes and the best opportunities.
All right, before we get
35 seconds.
Okay.
So
you were timing. Good job. So
I'm already not exceeding expectations.
You're meeting, and I predict you'll be beating them by the end of the by the end of the interview. Just one more beat on Sixth Street, because I think I'd be remiss for this audience and given some of the people we've heard earlier today if I didn't ask you about direct lending and the private credit market, which obviously is sort of blocking out the sun when it comes to the investing world. You know, I read a quote from a story about you guys back in 2002 or 2022, excuse me. Quote, "It's now more cautious," meaning Sixth Street, "arguing rivals with billions of dollars from individuals are rushing to put money into deals." How do you see this direct lending opportunity right now through this lens you just described?
2 words: risk management. So when I started the direct lending business back in 2001, there were 3 direct lenders. We didn't call it direct lending, we called it hybrid lending. It went from 3 in 2001 to 15.
This was at Goldman Sachs.
The Goldman Sachs. I founded we called it hybrid lending, but it was called direct lending. There were 3 people in the world doing this. It went from 3 people, everyone got excited, went to 15, and then the GFC happened. It went to 8, and now it's gone to 1,000 or 500. And I think what people in the industry needs to relearn about this asset class, we learned this back in the early 2000s, is that because it's a capped upside business, like it's a private equity venture, you can make 2, 3, 4, 5 times your money. Here you have capped upside. So by definition, that makes this a risk management business. And when you think about the hierarchy of risk management in direct lending, there's 2 core principles. Number 1, and this is something David Viniar, the former CFO of Goldman Sachs, taught me literally when I was a young associate, is crises don't happen because of credit issues. They happen because of liquidity issues. And that's true for every crisis. So the point is, you have to match assets and liabilities. You can't have long duration assets, short-term liabilities. That's the first thing. And the second thing, because it's capped upside, documents matter. So if you have a bunch of documents that allow you to basically add back this EBITDA, fake EBITDA here, then basically you've taken what should be supposedly secured risk, and you've made it equity risk, but you have a fixed income return. That's asymmetric risk. So no matter how good you are at selecting credits, those higher, and there's other things to the hierarchy of risk management. I'm hoping as a result of what's happening and what's likely to continue to happen, that the industry sort of relearns that because you have capped upside, it's a risk management exercise.
Yeah.
And hopefully that will get relearned and make the industry better. That's what I'll say on that. But I thought this was a sports podcast.
All right.
On sport, but we can talk about. Yeah, go ahead.
Right on cue, Wax. So, from summarizing what you said, is you want credit protection with equity returns.
Well, that's different if you can get that, but that's not regular way direct lending. Obviously, in general, if you take risk units and return units of any investment, take a unit of risk that you can't lose money and you can make 3 or 4 times your money, you probably want to do a lot of that.
All right, credit is not as exciting. Let's talk about sports.
Okay.
All right? I don't want to take you into a rabbit hole. So Wax, you were one of the early movers in sports, and you saw this early. You made that early acquisition, getting into the San Antonio Spurs right after COVID. But as a co-owner today, I have my Mount Rushmore of owners. And two that sit right on top of that list are Robert and Jonathan Kraft. I am fascinated by this deal. How did it start? Do you call Robert? Does Jonathan call you? Walk us through it.
First of all, I spoke to Robert and Jonathan before this, and they speak so highly of Alex. So you've got some big fans there.
Thank you.
My name didn't come up, just for the record, but go on.
So, by the way, Jason's super talented.
Yeah, thank you. I really appreciate it.
I talked to a lot of people before this. So
Okay,
they say
good.
See, now am I exceeding expectations now?
You absolutely are.
All right, so look, this all starts, so we went through just context. The NFL didn't allow private equity or private capital, because we don't really think of ourselves as a private equity firm, but they didn't allow institutional investors. So the NFL ran this big process, some might say it was a proctology exam, and you go through a process where they're trying to select, 2, 3, 4 people that have sort of a golden key to invest in the NFL. It's a massive process, and going through that process with the NFL, you understand why they're the league that they are. But what's interesting, and this sort of gets down to relationships and how you do business, I didn't know Robert and Jonathan Kraft before. Obviously watching the New England Patriots dominate over the last, 20 years, it's exceptional. So just as a sports fan. But coming out of that process, the CFO, I don't think I've ever told this story publicly, but the CFO of the NFL, Joe Sinclair, this is after we got approved, basically sent me an email. He said, hey, and he was kind of the front lines of their due diligence on us and others. And he said, hey, and I think you should, have you ever met Robert and Jonathan Kraft? I think you culturally would get along with them. You should meet them. And they weren't, looking to do, minority equity investment. So he connected us, we got together, and I'm summarizing this, but literally instantaneously, it almost felt like family, where we had alignment on team values, team culture, and clarity of purpose, which obviously you see the results of what the New England Patriots have done. But what you don't see is all the little things, those micro things they did in terms of running the organization. And we just clicked right away. And that's, by the way, consistent. When you look at all the other sports teams we've invested in, they're all global champions. Real Madrid, Barcelona, San Francisco Giants, San Antonio Spurs, Boston Celtics. Like there's a theme here. But the one common denominator between all of them is alignment on culture, values, and clarity of purpose. And that was really just set in motion. And they are so talented. What they do, people don't understand everything. They're great people.
I have a quick follow-up on that, Jason, for you, Wax. So once you get through all the hugging and family and alignment and pricing, do they say 9? Do you say 6? Does it go back and forth? Or is that more, here's what we're looking for? You agree?
The way that we do business and the way that I think the Crafts do business, both Robert and Jonathan, is this is a long-term relationship. And the last thing you want to do in getting a partner is a back and forth. It's you kind of know what's fair, and you're just trying to solve for fairness. And it was a very short conversation, and we agreed on it, and we got in business together. But you can just tell, by the way, it's not just sports, it's any company we invest in. You can get a sense when you're in the meeting, you're watching the way they treat their employees, the way they treat junior people. You talk to different people in the company or the teams. Are they all saying the same things? Are they saying 7 different things? And you can tell by just meeting everyone what that culture is, what the values are, and obviously do they have clarity of purpose.
And so let's talk about investing in the NFL, because you rightly pointed out this was a long process. The NFL was really the last of the major North American leagues and almost any league in the world to really embrace institutional capital. You've invested across sports. We're going to talk about some of those investments down the line. But what was it about this particular deal financially? And as you figured out how to underwrite this and did the diligence, what was it about this franchise and this sport that made it a compelling investment? As a minority shareholder, no rights. I mean, this is, you're in it, but they're running it.
Look, first of all, all these teams and leagues, and quite frankly, any investment, it's nuanced. So look, the first thing is like, what's the durability of the league? What's the leadership of the league? They're A+. Like, all you have to do is spend time with Roger
Goodell.
Yeah, I mean, Roger Goodell. I mean, and the people below him, the owner, it's a world-class organization. Then you get into sort of the market, the Boston sports market. We're also the Boston Celtics. Like, it's a great sports market. It's a great fan base. And look, I think with all
You are in New York, just as a reminder.
New York's a great.
Red Sox are next.
By the way, we're partners with the New York Yankees, and they're great fan base too. It's not exclusive. Everyone's got their own cultures, but look, I think at the end of the day, like for us, like the league itself, the durability of the league, the international expansion opportunities, the fact that just all these brands historically, if you go back 20 years ago, these brands were local brands. And by the way, just to say what probably I think one of the best sports executive, Rick Welch, says is that you can never forget that. These are still local brands. You have to get the local right. But once you have the local right, the global opportunity for all these brands, like take Wemby, like we're investing in the San Antonio Spurs. I went last year when they were playing in Paris. It was literally like an NBA Finals game. Did you go to that? Did you guys
No, I didn't go.
Okay, it was literally a NBA Finals atmosphere. So you've just turned on an entire country, and that's happening all over the place. And the NFL, those opportunities, the international opportunities are the same. So look, for us, it was pretty easy. But again, this wasn't a competitive process. It was a handshake. It was a set of relationships. And that's how almost all of our deals have happened in the sports ecosystem.
And just to put a button on the Patriots, 3%, is that?
Around there.
Yeah, right around there. Yep. And how do you think, just to close out the NFL discussion here, how do you think private equity, private capital has performed so far? What has it been about what you thought it would be in terms of the uptake from the teams, the uptake from the funds? Like, where is it now? Where does it go next?
I think it's happened about kind of what we'd expect.
Because it's been fairly minimal.
Yeah, I think about what we would expect. I think the challenge is, and this is why I think there's an important delineation between private equity and private capital.
Yeah.
Because a lot of private equity capital, the liability or the fund structures, you have to sell the asset in 5 to 7 years. That is a terrible idea for investing in a sports team, whether it's a control or minority. So our vehicle, we have very patient capital, which is why I think that really matters. Because I think and the reality is there are not that many people out there that have at scale those longer dated liability structures. A lot of the private equity funds they don't have that structure. So it's like mixing apples and oranges. So it's not a good combination. But I think that is one of the most important things is you have to have really patient, long-term capital to be able to invest in this asset class. And that's been as much of a governor as it is, a lot of these guys owning these teams, they don't have to sell. Like, they don't have to do anything. And some of them just want good partners. So it's kind of happened what I expect. I would expect over time, if valuations continue to increase, it's just going to continue to grow. But, and this is really, I think, the next wave of sports, is there needs to be substantial infrastructure and real estate adjacency investment to justify these valuations. Otherwise, these valuations are going to turn out to be, in a lot of cases, not all cases, probably too high.
Yeah.
I got one more on the NFL, just because it's such a juggernaut. Do you want to go first?
No.
Okay.
I want.
I love when you guys flow.
Yeah.
I love when you guys
We're like a
flow
married
like
couple.
this. Okay.
Anyways, Wax, when you think about the NFL is such a juggernaut, and when you look at just P&L and you dig down into just the thesis of an investment, right? Is it, when you look at an NFL team, is it the market? Is it scarcity, appreciation, cash flow? What are the things that excite you in 6th Street about deploying capital in football?
I think it's all those things. It's scarcity. Obviously, different markets matter. As I said, look, ownership, culture, values, clarity of purpose, that matters. But again, it doesn't take a long time. If you look at every youth in the world, everyone's picking up their phone all the time. AI is just going to continue to consume people's time. there's a reason why people, you look at live sports, there's a reason why everyone still tunes into live sports and no one watches Seinfeld or, everything's by appointment. And that's just going to continue over time. And I think the other thing is that the sort of exporting of sports, particularly global brands into other markets, is going to continue to increase. And I think that's an opportunity for the NFL.
Yeah. All right, you want to talk some hoop?
Sure.
All right. So it's interesting to think about your.
Can I ask you guys a question?
Sure.
What do you guys?
Yeah, Jason will take any questions.
Flip that question around. How would you guys? You guys talk to a lot of smart people. How would you guys answer that?
Underwriting the NFL?
Yeah.
I mean, I'll answer because you prodded me into it. It's really hard to do. I mean, I think the point you made about the international opportunity, I think, is one that was underappreciated for a long time with the NFL. And I think even the NFL didn't quite fully appreciate what the market was. And I think as it's invested more and more, I did a piece about Shad Khan of the Jaguars and Fulham FC a few years ago, and understanding through his eyes, he was obviously a pioneer with the London-based games. I think that international piece, I mean, I know you've spent a lot of time with Roger Goodell and others. I mean, that seems to be the real growth market in terms of both fans and really the technology is such, and I think and we'll talk about this, I think, in the NBA section too, if you can truly globalize American football, I mean, good Lord.
Here's what I can tell you with fact. There's excess demand for sports teams internationally and sports in cities that want to bring NFL games to their markets.
Yeah.
We just hosted, so we're partners with Real Madrid. We hosted one of the NFL games. It was, again, a playoff atmosphere. Vibes are great. This is just the beginning. Now, obviously, there's a player health component
right
that you have to be mindful of, which I think the NFL
just the travel and all that.
Yeah, you have to be mindful of it. So I think there's some constraints there. But again, they're just at the tip of just at the beginning of sort of that curve. But like the NFL, everything they do, they're doing it methodically.
Yeah.
The demand's much. There's demand for 20, 30 games, but they're being, as always, methodical and smart because they're trying to do it the right way.
I mean, they're going to play in Australia.
Yes.
Yeah.
Yes.
Go ahead.
So not to dodge your question. So it's kind of the things that I talked about that I really like about the NFL is the market is very important. The scarcity. Now think about if you're in real estate and there's only 32 beachfront properties and you own one of them. So I would think about that. The combination of appreciation and cash flow, it's very rare in sports. And to have that like a moat that you can actually underwrite it and it's like A paper as A paper can get, because obviously the national TV deal is going to get probably richer here. And then I would say I would over-index in leadership. And I think Roger Goodell is best in class, as good as they get as far as commissioner. And then when you have a guy like Robert Kraft and Jonathan, that makes it. Because at the end of the day, forget what the numbers say, you still have to be in partners with families, like a marriage. And that's how I would look at it.
100%. And I'd say across the NFL, there's some great owners across the NFL. So, look, that league and other leagues, I know we'll talk about the NBA.
Yeah.
They've got a lot of runway ahead of it, and just the beginning of a lot of some of these trends that are.
And then, Jace, we're going to talk about baseball at some point, right?
Yeah, exactly. All right, let's talk about the NBA.
I'll be asking you about baseball.
yeah. All right, we're gonna hold on baseball. All right. Okay, it's not baseball season yet.
You guys love the vibe. These guys have a great. Good.
I'm told I'm the only person who can talk to you like this, so I don't know if that's true. But the NBA is interesting, and you have such a fascinating lens here, Wax, because you went into the Spurs 6 years ago. Five and change. And then you go into the Celtics, a number of years later. The valuation differential alone is massive. How did the opportunity evolve? How did it change as you've sort of seen the NBA 5-6 years ago and the NBA today from a business perspective?
From an institutional investment standpoint? Well, first of all, we were one of the first. I think we were the first or the second institutional investor in the NBA where, the San Antonio Spurs, we just literally – they changed the rules and we cold called the San Antonio Spurs. So it was.
You literally just picked up the phone and like R.C. Buford, what's up, bro?
To be fair, as my colleague Austin Bowers picked up the phone, and that's what we do. Like we just picked up the phone. I grew up in Austin, so we had a view, an Austin, San Antonio view, but that was different.
All these people are like, "Ooh, cold calling. Okay, I'm going to do that." Go ahead.
Don't be afraid. Just be really a real person and just ask good questions. You'll be fine. Sorry, that was unsolicited. Whoever was talking in the audience, but so look, I think back then, I mean, that was the middle of COVID, so very different environment. I mean, these revenue had gone to a zero for a lot of these teams, or significantly reduced. So very different environment. I would say it's mature. It's maturing. There's more people that are obviously getting into it. So I'd say that the competitive landscape is different. So that's different. But on the other hand,
competitive landscape from an investor perspective.
Oh, no, there's just more cap, which is a good thing. There's the gentrification of the asset class. Like we were always interested in investing in sports. Themes are only as good if it's investable. Maybe in public markets you can express a theme, but in private markets you could have the best theme in the world. But if it's not investable, then it's a waste of time. And COVID made it investable, so that really opened it up and started to gentrify. Today, it's very different. First of all, the media deal, if we're at the beginning stages, and Alex, you know this really well, we're at the beginning of a new media deal. So there's massive re-rating. So that's different, but there's also a lot more capital. But I'd also say, and probably shouldn't get into too much of the NBA Europe on this because we probably don't have time to go into it in enough detail. But again, the international opportunity in the NBA, it's massive. You look at the demographics, you look at the number of NBA players that are from different countries. And again, it takes one player on one team from one country to open up that country and open up that country in terms of possible engagement of new fans. And that is another, again, it's very different. It was one of our core underwriting, but obviously where we invested was a different time. So valuations are way up from what we invested, but I think that's, again, the international opportunity is massive.
And do you see that? I mean, what's interesting is you think about that timeline, Alex. That's similar mapping to your journey in the NBA. Yours was a long journey with some twists and turns along the way, I think it's fair to say. I mean, was that similar to you? Is that what you guys saw in 20?
Yeah, we came in around the same time, right after COVID, which was a very scary time. I remember my mom saying, "What are you doing? Like, you have the Disney bubble, these stadiums you're going to go crazy. Like, you shouldn't do this." I said, "Mom, I think I'm okay." She made me think a little bit. But what's exciting about the NBA as we saw it, like if you think about 20 years ago, probably less than 5% of the league was global, right? It was all domestic players. As you look at where we are today in 2026, about 35% of the league is from outside of the U.S. As a matter of fact, the last 8 MVPs have been non-Americans, right? And Wemby's going to be very much in that list. And we have a kid in Anthony Edwards who is a born American, went to University of Georgia, and was our #1 pick. And then when you think about the global footprint that Wax is talking about and the opportunity, we're the second most popular sport in Europe, is a $45 billion a year business, and we only own 1% basketball. You have 400 million people playing basketball in China, 300 million people playing basketball in India. So I think we're really in the early innings of where we're going to go as the NBA. So it's very exciting.
All right, so it's interesting as we think back over let's just make it about us for a second. As we think back over the course of this show's history, one of our earliest guests was Brandi Chastain, one of your co-owners in Bay FC. And what was so interesting for us who followed this so closely as a business, the business of sports and deals, your investment in Bay FC, an expansion team at the time, was radical and new because you were the first institutional fund that was allowed to become a control owner of a major U.S. sports team. Tell us a little bit about that deal from we sort of heard the Brandi perspective, sort of coming in as a player, but this is new territory at that time for a fund.
Never have we made an investment where people thought we were crazy, but from our standpoint, it's one of the most asymmetric investments we've ever made. So just for context, the last expansion fee before we bought Bay FC was, I think, $3 or $4 million. And we paid $53 million, I don't know, 2 or 3 years later. So people thought we were crazy. But what we saw, and again, for us, we're always trying to not only think about what the world looks like today, but what the world's going to be, and try to do that in a pretty methodical way in terms of like how we go through our investment process. We just started breaking up. First, so the way this, just for context, is What got us on the NWSL initially is my, at the time, 9-year-old daughter. She was on her iPad, and she was watching an NWSL game, and I was like, huh, that's kind of interesting. That's just because I grew up in Texas, and there weren't a lot of girls' sports. Like there was in Texas when I grew up, there was kickball and softball. There was no other sports at the time, so that was interesting. So look, through prodding, through a number of people around the ecosystem, like, you should take a look at this. So, and I'm summarizing, there's a lot my wife was involved, so she was prodding me because she thought this was a great investment opportunity. She's much smarter than I am, by the way, applied mathematics major. But we started studying it, and we looked at the market, and at the time, like a lot of the sponsorship revenue was in sort of the impact bucket. It wasn't in the CMO bucket, so the chief marketing officer versus the impact bucket. And that was just a major opportunity for us because we knew people were watching. And it's actually the only time in my entire investment career where I actually printed our investment thesis. I put it out there publicly. It's the first time and only time we've ever done that, because I thought it was so asymmetric. And
you can find it on LinkedIn. I mean, it was a very popular LinkedIn post.
And I'm not a big social media, I don't even have social media, but we put it out there because we thought just for people to understand. And sure enough, now everyone's talking about it, and we're still at the early stages. But again, it's not going to be linear, the growth, but it's been a good investment for us.
Well, and to be clear, I mean, if you think about where the valuations have gone, where the expansion fees have gone, literally a year ago, we were sitting on the equivalent of this stage. I think we were actually downstairs with Melody Hobson. She paid substantially more for the Denver expansion franchise, I think 4 times more than you did to have the right to build in Denver. And obviously Willow Bay, who's been a guest on the show as well, she bought Angel City at a valuation of 250. So clearly it's going up.
It goes to anything. Ultimately, investing is about supply and demand. Like, it could be the best theme in the world, but if there's excess supply of capital, by the way, this might rhyme with private credit, excess supply of capital and low demand, that's not going to work out well. The thing, going back to what you said, Alex, is these are scarce assets. So there's valuable pieces of real estate, and as you start to sell expansion teams, there's less and less valuable real estate. And what I can tell you, and I'm going on the record here, is that what Melody and Willow, who are both 2 incredibly talented people, they're going to look very smart in about 3 or 4 years in what they paid, and you'll be having the same conversation to them, Melody and Willow, and you're going to be saying people paid 4 times more.
Right.
That's my prediction. I'm going on the record on that.
Oh, I like when you go on the record.
Yeah.
Now we got it.
I guess we're live TV, so so there you go.
I'm following up a little bit on what Jason said, which I'm fascinated by this. Like Jason said, you're the first private institution, call it private equity institution of money, that's a control partner.
I think we're the only one.
The only one.
In the U.S.
My question is, on the big 3,
yep.
MLB, NBA, NFL, 92 teams, 30, and NFL has 32. Do you think in our lifetime, the 3 of us, there will ever be institutional capital that takes full control of one of those 92 teams?
Our lifetime, how long are we going to live?
Let's just say 50.
Okay.
I know your workout regimen, you're going to live forever.
Yeah.
So that's fair to say.
Next time we got to do this over a workout. But I got to be careful here, but I'm going to say within those 3 leagues, it will happen in our lifetime for the simple reason that if valuations continue to go up, which in order for that to happen, there needs to be hundreds of billions of dollars of infrastructure and real estate investment to make that happen. Just the size of these valuations is going to get to a point where there's only going to be a finite number of individuals. So again, there's no certainties, but probabilistically, if you sort of play that through, I think the leagues will look at it. Will it happen in our lifetime? I think anything can happen in our lifetime. So I'm going to say, especially we're going to live a long time, hopefully, knock on wood or something. But no, I think it'll happen in our lifetime. But just if any of the commissioners of those 3 leagues are looking for it, I don't think it'll be probably while I'm probably a long time from now. That's what I would say.
You'll be mostly surfing and not investing at that
I'm hoping
point.
I'm just surfing and not that. Yeah, exactly.
Costa Rica.
Yeah.
There you go. All right, so we're going to wrap up in just a minute here, but a couple times you've mentioned this idea of real estate and infrastructure, and I know that that's something that's on your mind, Alex, in terms of as you think about the Timberwolves and the Lynx and what's going on in Minneapolis.
Can I put him in the spot?
Please.
All right, I'm going to put Wax in the spot. All right, so Wax, my partner Mark Laurie and I are looking to build a new arena in Minneapolis sometime. You made a great acquisition of Legends, partners with the Yankees and the Cowboys. If you were to pitch to me, why should you earn our business? Give it to us in less than a minute.
Are we going to do a deal right here on the deal?
Deals on the deal.
How many
deals
deals
on the deal.
have been done?
My favorite thing. It's my favorite thing.
Deals
Deals
have
on
been
the
done
deal.
on the deal.
Nothing this big.
Best in class execution, knowledge to drive the optimal outcome for whatever you want to accomplish, and they're the best in the world at it. They have the most experience at it, and we can bring capital next to it to couple with their services and our capital. So we can deliver you a full 360 solution where you don't have to go speak to anyone. Do you want to talk terms or?
No, not yet. Not on national.
This is the part where I ask you like 100 questions.
But remind us, we do have 2 minutes to do this. So, Legends is a really interesting window into the sports world, and I think for the investors in the room, which is everyone in this room, understanding that part of the sports ecosystem, I think, is fascinating. Help us understand exactly what Legends is and what it represents.
I want to just give a little context. In 2009, it was created. It was created by Jerry Jones and George Steinbrenner. And the reason why is they were both building new stadiums, kind of funky scheduling at the time. Of course, I was playing. We won the World Championship in 2009. So it was the first year.
You really worked that in very seamlessly.
Well, it's been a long time for us. So anyways, that's when it started. Your mic.
Yeah. So what it does, anything you could possibly need, from planning to design of the stadium or the arena to the best premium. If you go to Yankee Stadium, if anyone's been to Yankee Stadium here, you go to the quality of the food. A lot of the food at a lot of these sports venues, it's like you would never have your kids eat it. It's just not high quality. The experience is not there. Go there. High quality food, both premium and regular. You're going to have to sell sponsorships, so we can help you sell sponsorships. We have the CEO of Legends, this guy named Dan Levy. We didn't hire someone from the industry. We hired someone who reported to Zuckerberg at Meta. When you think about sort of the analytics and AI opportunities, so we can provide advice and guidance on that. But literally anything you could possibly do, we do it as one. So you're not dealing with 27 different people. You can deal with one party, and we're willing to put our money next to you to align interest. And that's something, the combination of all those services, which again, you can take all of them or take some of them, but also for us to put our money where our mouth is. I think that is what makes it unique, because ultimately in business, as you guys know, it's about relationships and it's about aligning interest. And that's what we try to do in our approach on Legends.
All right, you each have 30 seconds to tell me how we're going to fix baseball. Go, Alex.
Oh, boy. Well, here, 30 seconds. It's a lot of pressure. So I would say I'm a contrarian. So I think the best time that I've seen in the last 15 years to invest in baseball is today, because the amount of uncertainty. Uncertainty around the CBA. Are they going to strike or not? I love that for an investor. The bet you're going to make is going to get better, not worse, because right now it's pretty, tight. And then the other one is that Rob Manfred is going to really integrate all the regional rights into one and try to copy what Roger Goodell's done with the NFL. Because the World Series showed us that if you have the right product, you have the right teams, you have the right stars, the right strategy, and good baseball. We had 53 million people watch the World Series Game 7 when you include the U.S. market, Japan, and Canada. And it was one of the best I've ever seen.
30 seconds. Principle, this is by the true for every sport, is stop making it a zero-sum game and talk about how to grow the pie together.
Yeah.
And that applies to any CBA negotiation, like getting past all that and how do you grow the pie together. But I'll throw it out there. I'm probably going to get some slack for this, but I'm going to throw out a straw man on just real quick, okay? So first of all, you got to get the minimum standards up, minimum salary across the league. I think you got to do that. I think you got to do something on the homegrown. Like when these athletes, not good for a city, it's not good for a fan base when you have a superstar player and then as soon as they get good, they leave. That doesn't create fandom. And the last thing, and this is going to be a little controversial, but I think that each team, I think you should have a salary cap, but each team should have 1 or 2 designated players that can pay whatever they want. So if you want to pay someone $1 billion, they're worth show you a time, worth $1 billion, you can pay them. So you get 1, 2, 3, something that doesn't upset the competitive balance, but allows teams for these superstars to make what they earn. And you put all that together, and then you get people like on the TV deal and media rights aligning interests. So they're trying to grow the pie together because, again, there's an international investment opportunity in baseball, and they've done a good job. But there's a lot more fruit out there. So I think getting away from the zero-sum game and trying to align interests, that would be my controversial, which I'll have 20.
And I'll jump on one because we're running out of time really quickly. I would say that from a union perspective, being a member of that union for almost 25 years, I think you want a union that, 70%, 80% of the revenue doesn't go to 10% of the players, but have a more democratic where everybody gets to eat a little bit.
Totally. I think last thing I'd say.
Yeah.
And this we'll close it off. Communication matters. And I think when we were talking on stage, you had talked about getting constituencies together and just talking, because I think a lot of times people talk around, they dig positions, but if people think about pie growing, and by the way, I think this applies to business building. I think too many people focus on percentages and not focus on pie growing. I think you guys get people together, we'll solve it, because no one wants to see a strike.
All right, it's all happening. Baseball's back, and unfortunately, we don't have time. We ran out of time, bro.
Well, that's a cliffhanger next time.
All right, we're going to do a rapid fire backstage, and we'll post that online. It's going to be a little bonus. It's going to be a little extra. Alan Waxman, this is really fun. Thank you so much. Thank you, everyone.
Thanks.
Welcome to Bloomberg This Weekend. I'm David Durrett.
I'm Lisa Mateo.
And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Please welcome to the stage Andrew Schlossberg, President and CEO at Invesco, and Connor Teskey, CEO at Brookfield Asset Management, for a conversation with Bloomberg's Katie Greifeld.
All right. Hello, everyone. Thank you for joining us. Connor, Andrew, it's great to see you. So we're talking about customization when it comes to wealth management, and we're going to get to that. But we, of course, have to start with what's going on with private markets right now, and specifically what's going on with private credit and direct lending. So this is a question for both of you, and I'll start with you, Connor. What state of the credit cycle do you think that we're in right now?
I think it's important to put the current market in context because credit, private credit, and direct lending almost get used synonymously in today's environment. And we generally are of the view that credit markets are in good shape. Bank balance sheets are terrific, corporate balance sheets are strong, capital markets are liquid. Then you move to private credit, and we would suggest that most components of the private credit market are also in good shape. Real asset lending, asset-backed lending seems robust. Demand is outweighing supply. Credit spreads are strong. Covenant quality stays high. Then you get to direct lending. And there are undoubtedly some concerns about direct lending today. A lot of capital came in very quickly. Spreads tightened. Maybe some concerns about corporate credit quality. But it's important to recognize that is only a very small subsegment of broader credit markets.
It's a fair point. There's a lot of babies, a lot of bathwater right now being thrown around altogether. But Andrew, I would love to hear your perspective on that. When you think about where we are in the cycle, especially when you look into your portfolio, some of the fund flows that you're seeing, where do you think we stand in the credit cycle?
Yeah, I think Connor gave a good description of it. I think we have a lot of new investors into the market as well. A lot of individual investors, wealth investors, increasingly we'll see over time retirement plan investors. So I think some of these are just sort of natural points in cycle. Frankly, I think we need a little bit of a stress test scenario will help us kind of work through who the strong players are, but also that the way that it's getting delivered is time tested and can work. I think this is in some ways healthy.
Maybe to piggyback on Andrew's point, one of the things that we talk about is in today's environment, sometimes two concepts, one being corporate credit quality and two being the liquidity of the structures in which those credit investments are being held. They're kind of being conflated together. I'm sure in some cases both are appropriate, but not always. And I think when we talk about concerns around maybe software credit, that goes to credit quality. When we talk about liquidity in some of these credit vehicles, that doesn't necessarily mean the underlying credit quality in those vehicles is bad.
So there's a lot to dig into there. Let's start with the conversation around liquidity, because I come mostly from the world of ETFs, which is as liquid as you can get, but it is interesting to watch, the retail investor, the individual investor. I mean, retail is a broad church, but come into specifically BDCs and some of, the vehicles along those lines. I mean, you think about the liquidity mismatch, if you want to call it that, between maybe an investor who's more used to very liquid vehicles and what's actually being offered in some of these fund structures. Do you think that there is a structural mismatch or a misunderstanding there?
Yeah, I don't think so. I mean, I think a lot of that market's advised, and advisors, are thinking about asset allocation, risk management, education. It's also important to remember this is a market where private markets at large, where it's 0, 1, 2, 3% of an individual's portfolio, talking about taking them to 15% of an individual's portfolio. So liquidity is an important factor, but these are long-term investments in a natural sense. So again, I think there's some newness to it, but I don't think there's a mismatch at all.
And there's no doubt that these vehicles offer something incredibly beneficial to the market. Yeah. They allow investors that maybe perhaps historically have had the traditional bond or stock option, they can get exposure to something that diversifies their portfolio. They can get exposure to some key investment themes that maybe exist more in the private markets than the public markets. And these vehicles inherently work. And if they're structured appropriately and they're managed appropriately, and both the managers and the investors understand the parameters of these vehicles, they can be very beneficial. But we've seen in our business, you need to manage that liquidity appropriately, and when doing so, it works really well.
And, you made an interesting point that, Connor, when it comes to sort of the underlying quality of some of these portfolios, that necessarily isn't the question here. It's more just liquidity expectations. But whether or not, the actual portfolios are in trouble, I'm curious from both of you, whether this experience that we're seeing, all the concerns that are out there in the private credit landscape right now, whether that might dent retail demand going forward when you just take a look at sort of the volume on some of these headlines?
I don't think so. It may be just to frame it. We think of the individual market being the wealth market, the retail market, the insurance policy and annuity holder market, and the 401k and the retiree market. And that market globally is actually twice as big as the institutional market, and it is only de minimisly invested in alternatives and private markets today versus institutional portfolios that you can take your number maybe mid-teens. So it has an incredibly long way to run. It will be incremental over years and decades to come. We don't see that trend being derailed by anything in the short term.
Yeah, I mean, in the long run, completely agree. In the short run, will there be hesitations? Of course, but I think this is a very long journey. And to the comment before, it's such a small market today. and it getting tested through points of stress. I mean, you cover ETFs widely. There was always discussion of fixed income ETFs were going to, be the end of the world, and they've been through many market cycles and crises. So I think it's a long term. We're going to be fine. In the short run, it could be a little bumpy.
Well, I wonder, how it's impacting how you're thinking through, Andrew, your partnership that Invesco has with Barings, because you think about October, you set sail on your first interval funds. Barings now co-managing that portfolio. I know that you had, or at least when the partnership was announced nearly a year ago, the plan was to roll out more products that were more geared towards that mass affluent investor. With some of the hiccups that we're seeing in the market right now, some of the concerns that we're seeing, are you being a little bit more thoughtful, or maybe delaying some of the plans to roll out those products?
Yeah, no delays at all. And we've been in the market, in the institutional market for decades. We've been in this part of the market with real estate assets and credit and equity in these interval fund structures for several years. The most recent thing we're doing is a diversified credit fund where we're co-managing it with Barings. And I think that diversified nature is pretty critical for that wealth audience that really does need to look across the entire spectrum of credit. And for those investors that don't have the opportunity or maybe the size to diversify on their own, this gives you an avenue to do that in a dynamic way. So in some ways, I think actually some of the dislocation right now should benefit that strategy. And we're looking to do more with Barings. We're looking to do more with our other partner, LGT, in this space, and then also in the retirement space.
And most of the conversation that we're having so far has focused, of course, on private credit. That is firmly in the market's crosshairs in terms of the focus right now. But, you think about private markets in general. Obviously, it is such an enormous bucket. So, Connor, I'm curious what you're seeing when it comes to private credit, how that stacks up sort of across different asset classes that fall under that private sphere.
What we're seeing in terms of private markets is continued growth. And if we could say it this way, the alternatives market has grown to where it has got over the last 20 years. And that's been largely an institutional market, and focus just institutions creating and then increasing their allocation to privates and alternatives. If you focused only on the institution, that market size is going to double over the next 10 years. Then you have this new additional growth lever, if you will, which is the individual market. And what I would say is the vast majority of private credit investing today is still done for institutions. And what we really focus on is ensuring that everything we've done in terms of investment discipline and approach for institutional investors, we take the exact same approach when we do something for the individual channel. And the tailwinds and the needs for capital within the private sector are only continuing to grow, and therefore there's going to be lots of demand and lots of support for both those verticals to grow over the next decade and beyond.
Interesting, yeah.
I was going to say, I think when Connor and I are both talking about institutional, it's natural to think defined benefit, but as you kind of pivot here to defined contribution, maybe even more important than the wealth space for individual investors is how defined contribution unfolds for private market assets.
And if I could even piggyback up on that, we sometimes turn this discussion into individual versus institutional. Right. It's important to recognize that essentially all investing around the world is on behalf of individuals. Yeah. When we invest on behalf of a pension fund or a sovereign wealth fund, it's individuals behind that institution that are in fact the end stakeholder. And therefore, this is really just about an intermediary in terms of who you execute with, as opposed to actually changing who the end economic exposure belongs to.
It's a nice reminder that, people populate institutions. That's right. Institutions are serving ultimately people at the end of the day. But to the point, Connor, you made the point that, when it comes to sort of translating what you're doing for institutions into individuals, there's not too much change there. And Andrew, I wonder how you think about that. As you push more into, the mass affluent, the more individual market versus institutions, what does that translation look like for Invesco?
So it's pretty natural, actually, because being in the private market space for as many years, 30 years, in fact, and being focused on private real estate and alternative credit, and also being a massive partner to wealth managers in the top 10 here in the U.S. and in many major markets around the world, bringing that together and knowing what the needs are of those end investors and the advisors, how to structure product to certain unique needs, how to do client service, how to make the friction in the system more seamless. And I think a massive part of it is how to deliver education. And in the moment we're in right now, reemphasizes and underlines I think the importance of that education piece, not just at the product level or the asset class level, but at the utility level as well.
I couldn't agree more with two things you said there. In a lot of cases, in almost all cases, we're not changing what we invest or how we invest it. We're simply packaging it and structuring it differently for a different end investor and for a different distribution channel. But it's the same investing and the same type of exposure. And then Andrew's point on education is a very important one. We've spoken about, a little hiccup or disruption that maybe the markets are going through right now. I think this is just going to make everyone sharper around communication and education of how these products are structured, what liquid or semi-liquid or perpetual actually means, and what that means for both the investor and the manager.
It would be kind of fun if you guys did disagree, but it's probably nice that you guys.
You never know.
We might find something.
That's where we have 15 minutes left. We'll find something.
We'll try.
Yeah. I do want to talk a little bit more about points of access because I can't help myself. I cover ETFs for a living here. Invesco, obviously, a powerhouse when it comes to ETFs. We've talked a little bit about, liquidity expectations. Do you ever see a world where, ETFs do hold private assets? There's a few fringe cases out there, but it's really a very nascent market.
Yeah, I think the coupling of private and public assets is going to take place in portfolios and package portfolios. We're seeing it today, and as that progresses, and I think as that the market gets more oriented and maybe as the vehicles get better, there will be more opportunities. I think right now there is so much to do in bringing private markets to individual investors. I think the ETF is an interesting vehicle, but I don't think it's the number one priority, certainly not for Invesco. And I think for the market right now, liquidity is critical. We know it's critical, but these are also long-term investment vehicles as well. And we really want to put them in vehicles and packages and product delivery mechanisms that can meet a lot of people's needs. And I think the ETF is a small use case right now.
Mm-hmm. And Connor, I'm just curious to hear your thoughts.
Well, the only thing that Andrew's
here's where we're going to disagree.
Response almost triggered me too is it's not all going one way, and I think that's important to highlight. I'll tell you, just within our business, we have listed public entities that really invest in Brookfield's underlying private funds, and it's a unique way for investors to get exposure to what's in the exact same assets and investments as those LPs that invest in those committed capital public vehicles, but it's for those investors who want that in a stock with daily liquidity and daily mark-to-market. So it is a two-way street, both putting privates into ETFs or other structures. Similarly, we're also trying to find a way to put it into public securities to access that market, and that's been very successful as well.
Yeah.
I mean, ETFs, we've been in the ETF business for over 20 years, and one thing that is absolutely true about the industry and about Invesco is innovation takes place. And so it's been 10 years plus that we brought our loan ETF, which was the first of its kind to the market, and it's got some dynamics in it that create liquidity, and that's traded through many, many market cycles. I don't underestimate the ETF industry using innovation to create more ways. So I'm excited about it. I just don't think it's priority one.
Yeah, it is really interesting. I mean, some of the conversations that we're having around private assets in ETFs, some of it has a very strong parallel to some of the conversations around fixed income ETFs, loan ETFs, to your point there. But we'll put ETFs aside for a moment because you both seized upon education. And this is a topic that came up during our prep call as well. Some people, when they hear education, their eyes glaze over. And, it can come across as something that you scroll quickly past. And I wonder, how you actually reach, the individual that we're talking about, the people that sort of populate your investors here in a way that is actually meaningful.
I think we'll go back to this point that the alternatives or the private sector was built on the institutional market. And in that market, we would have a client team that would go speak to the individual LPs on a recurring basis, provide them updates, incredibly detailed explanations about the different products and solutions we'd offer. We are doing the exact same thing for the individual investor. We have a dedicated team, so it's not a shared resource. It's a dedicated team that's growing very rapidly around the world. And it goes beyond just having people that are out there educating and selling your products. If I can think about it this way, it's not simply about getting your product on the shelf. It's getting the product on the shelf and then also explaining the product and why it might work, but equally why it might not work for someone and perhaps they should focus elsewhere. So dedicated teams growing around the world, focused on not just selling, but educating more broadly.
I mean, ditto. Having dedicated people, having deep resources. The one thing I'd add is to do it at scale and at mass, and I'm sure Connor's firm's doing the same thing, you have to look at different platforms and mechanisms. You can do it one-to-one as best you can, but you have to do it broader and at scale. I think the education is naturally always going to the product, but I think the education around the asset classes at large, how they operate, how to put them in portfolios, and how to help advisors who are very sophisticated in their own way take it forward and explain it in a language that's going to make sense to end individual investors too.
Sometimes we get a question, I'm not sure if you do as well, about consolidation in the financial services market. And one of the key drivers of that consolidation is the client service requirements and the regulation requirements in this industry continue to go up and up and up. And it really lends itself to larger institutions that can invest the time and the people and the resources to delivering and meeting that bar that is getting higher every day and only going to do so continuously into the future.
Yeah, I'm never surprised, actually. Every time when we go out and we spend time talking to wealth platforms and advisors, once you get past the product part and once you get past the asset class part, one of the biggest challenges for individual investors is there's a lot of friction. And so time to get things completed, ability to put it alongside your other investments. And this isn't, this is GPLP funds, but also in interval strategies. So I think the more we can take that all those chains out and make it a much simpler process is really a benefit to individual investors, and it'll keep costs down too.
Well, Connor brought up consolidation, and I already mentioned the partnership that Invesco has with Barings, and I feel like partnerships are sort of similar or a similar conversation to some of the consolidation conversations. But Andrew, I'm curious, why Invesco went the partnership route when it comes to deepening the commitment to private markets versus doing it in-house at Invesco.
Sure. Partnerships in the ethos of the firm. I mean, we have partnerships in joint ventures in India and in China, in Canada now. Across the way we built our $1 trillion ETF complex was a lot of partnerships. So it's kind of in the DNA, and it's culturally something we're very comfortable with. Secondarily, we really wanted to stick to our knitting in real assets and in alternative credit. And so looking for partners that could either give us extensions to things that we don't have, like private equity or secondaries or other parts of credit that we don't play in, upper market or special situations, was a better and a better outcome for clients, we thought, to be able to get to market thoughtfully and quickly with experts in things that we don't do, and then to utilize our distribution relationships and our client relationships. So it started with we're comfortable with partnerships. It went to finding ones that we're really culturally aligned with, that think long-term like we do, and then finding some spots where we just acknowledge that we may not be the best out there, and we can partner with others to get a complete solution.
What is your appetite for M&A? Clearly comfortable with partnerships, but would you ever take it all the way and outright buy someone?
Yeah, I mean, there's, we've talked publicly about it, where there's opportunities to add extensions to what I was describing. But for the meantime, and maybe forever, the partnership route and our, we have a $130 billion private markets asset base today, so we're not starting from nothing. So we'll continue to look at it, but we're pretty comfortable with the organic and partnership route at the moment.
And I'll ask you the same question. I mean, when it comes to how Brookfield Asset Management is sort of approaching the rest of the industry, are you, considering partnerships? Does M&A look more attractive to you?
We've done both. And we've certainly used M&A to build out our alternatives platform, in particular our credit platform in recent years through the acquisition of Oaktree and Castle Lake and other of what we call partner managers. I think the partnership approach makes a lot of sense in certain situations because we should be very clear. There's going to continue to be growth across the spectrum. Public markets are going to grow, private markets are going to grow, and there's going to be incredible expertise and leaders in both of those. And partnerships allow you to take the best of both. Whether it's a partnership or an M&A, that's just a capital allocation decision. I think working together is a strategic decision that it seems like we're on the same page on. One's just a capital allocation decision.
Mm-hmm. And back to whether it's an institution or a wealth platform or individual investors, they want to work with less people. I mean, they want to work with fewer people that can first be high quality, but second can look beyond any individual situation.
I'm delighted to say we have an audience question, and you are able to ask questions. I'm delighted to say that this one also makes a lot of sense, so let me ask it. Do you think that individuals have a hard time truly understanding semi-liquid assets, perhaps better off making them fully liquid or keeping them liquid longer-term structures? A lot to chew on there. Who wants to take it first?
I think absolutely individuals are extremely capable of understanding a semi-liquid structure. I think managers of these structures need to be very thoughtful in how they build them over time. Not to go on too long here, but the reality is it's a perpetual structure. There's been institutional perpetual structures for a long time. It just happens to be in the wealth or retail market, most of the structures are perpetual or semi-liquid. And what we've seen is if these businesses are grown incrementally such that sometimes you maybe need to restrain inflows such that you aren't taking a bunch of cash, you aren't having to invest unnaturally because of an inflow you weren't well equipped to manage. If you restrain the inflows to the deployment opportunity in the market and you manage the liquidity, I think you're fine. And I don't think it's on the investor. I think it's on the manager.
Mm-hmm. And Andrew, I mean, we've tread a lot of this ground, but
I mean, the only thing I'd say is I think individuals are very sophisticated, and most of the investors in these funds are advised as well. And I think liquidity is always important, and typically you want it when there's a stress point. And so I think keeping people focused on their asset allocation and not fully on their emotions it's not exclusive to private credit or liquidity or private markets. It's a general investment principle.
Yeah, and it was about 20 minutes ago, I think, where you said, maybe a stress test is healthy here. It's going to be interesting to see how it all shakes out. But I do want to talk a little bit about deployment opportunities, particularly when it comes to AI infrastructure. I know that is a particular interest of Brookfield at this point. There's also a lot of money chasing the space, and I'm curious how you're sort of competing in that environment.
I would say AI infrastructure, investing in both the digital infrastructure and the energy production that supports AI, is one of, if not the largest investment theme at Brookfield today. And it's important to recognize that we are building the critical assets that provide the compute to either hyperscalers, the largest, best corporates around the world with the best corporate credit ratings, or to sovereigns. In both those cases, you have an exceptional counterparty on the other side, some of the highest corporate credit counterparties in the world. And we are only building when we get a long-term contract, and we are not taking a risk on the monetization or the performance of that compute, but rather simply on the corporate credit quality of that counterpart. And we are seeing, due to the demands in this space from those counterparties, we're seeing very attractive risk-adjusted returns. And the demand is I don't mean to sensationalize, but the demand is incredibly robust, and it only continues to accelerate. So we view this as one of the largest investment themes both today and in the future as well.
And Andrew, I wonder, when you think about the demand in general that we're seeing from, the individual investor for private assets, how much of that relates to, the build out of AI that we're seeing?
I mean, sure. And Connor, from an infrastructure perspective, which we're not in, clearly has all the great insights there. I think we've seen it across public investments, private investments. You've seen it in all forms of real assets, not just infrastructure. You've seen it obviously across the credit side. I think one thing I'll say in the public markets in particular, this narrowness that we had seen over the last several years starting to kind of break out in the last year to get more diverse, and we're certainly seeing it in the last couple of months and weeks here, I think is a healthy thing. But the AI build out and the demand is positive for the economy all around.
All right, we are exactly at 0 seconds. So thank you both, Connor and Andrew.
Thank you. Yeah, thanks.
Thank you, guys.
Please welcome to the stage Nicholas Venditti, Head of Municipal Fixed Income at Allspring Global Investments.
All right. Good afternoon, everyone. This is very exciting. I'm sure you're very excited about the Muni segment of this presentation. I did not name the presentation The Magic of Muni. Someone in our marketing department did. They came up to me just now and said, you got to make Munis magical. And I panicked. And so I ran straight to the makeup artist backstage and I said, make me look magical. And this abject terror spread over her face. And she said, I don't know if I have enough time, and I certainly don't have enough makeup. So thanks, Stacy, for what you have. This is the best you can do. But I'm going to try and convince you that Munis are more magical than the private credit you just heard about. I know, tall order, right? I'm going to try and convince you that Munis are more attractive than Alex Rodriguez. I texted my wife and I said, oh my God, I'm standing next to Alex Rodriguez, and she sent me like a thumping heart emoji back. So my self-esteem has been damaged twice, both by Stacy, the makeup artist, and my wife in a very short period of time. So we're gonna have to really, really recover from that. Why are Munis magical? Munis are maybe the best investment option available to you all right now, especially if you are in the upper echelons of the tax bracket. And given the fancy suits you are all wearing, I am assuming you are all high taxpayers. Munis are awesome for a couple of reasons. One, they're awesome on the short end. They're awesome on the short end because ultra short Munis are out yielding your money market by 75 basis points right now. If you own a money market, if you have extra cash sitting in your money market, you should leave my presentation right now and go make a trade. It is the easiest, no-brainer trade to make in all of the financial markets. Go buy ultra short Muni. I work at Allspring. We have one. Throwing that out there. That's easy, right? That's not that sexy. What is sexy? We talked about private credit. Private credit is certainly interesting. I mean, just the name itself gets people excited. Why does private credit not hold a candle to Munis? I'll tell you why. Munis are better credits. Much, much better credits. In fact, a very, very common statistic that we like to throw out is that BBB rated Munis default less frequently than AAA rated corporates. That's boring. All right, what does that mean practically? Well, that means that it is less likely that the city of Chicago will default on its debt than Apple Computer. Than Apple. Apple is more likely to default on its debt than the city of Chicago. That seems crazy. People say unfriendly things about Chicago all the time. Chicago is awesome. There's about 100 years of data to support that assertion. Munis are better credits. They're lots better credits than the things that sit in private credit. More importantly than that, right now, today, high yield Munis out-yield almost every private credit fund out there on an after-tax basis. They are generating more yield with less risk, and if you want your money back, we can give it to you. I told you they are magical, right? The magic is here. More importantly than that, I heard the two gentlemen before me talk about diversification. Munis provide better diversification than almost anything, right? And when you guys think about diversification, you think, well, stocks and bonds, they move in different ways, but they provide better diversification than that. How? How, you ask? I live in Milwaukee, Wisconsin. It turns out that the water and sewer system in Milwaukee, Wisconsin has nothing at all to do with Iran. A school district in Southern California is not impacted by Israel in the Middle East, but most corporate credits are either directly or indirectly. Munis are better. They are safer, they yield more, and they are less volatile in an incredibly volatile world, and that is magical. I am going to tell you, just in the interest of intellectual honesty, that there are a couple of things you need to be aware of in the muni market, right? You need professional management because occasionally bad things happen. Again, I have 12 seconds left. If you think munis are as magical as I do and you want professional management, all spring. I appreciate you guys giving me the time. Have a great rest of your day.
Your clients are unique. We work hand in hand with you to tailor each portfolio's goals and tax preferences. Remy's portfolio construction engine, backed by our fundamental research team, simplifies transitions and tax management to deliver a portfolio personalized for each client. Remy lets you reimagine how you achieve success that's meaningful to each and every client. Tailor-made portfolios, far-reaching possibilities, smart outcomes. That's Remy.
Please welcome to the stage Samara Cohen, Senior Managing Director and Global Head of Market Development at BlackRock, and Lynn Martin, President at the New York Stock Exchange Group, for a conversation with Bloomberg's Reto Grigori.
Good afternoon. Thank you for coming. It's always a hard act to follow magic of munis, but we'll try here. Obviously today we're talking about making public markets appealing again. It's a great day to talk about that. They didn't look very appealing this morning when I checked the Dow down more than 1,000 points. It looks a little better this afternoon. But I would like to start with you, Lynn, and ask you, so how worried are you that the current sell-off is at least a complexity or a complexifier to what's looked like a pretty promising year for IPOs?
I think you can take great solace, though, in the last couple of days that, to your point, woke up or the market opened up down 1,100 points, and now it's come back. It speaks to the resiliency and robustness of the market and the capital markets in general. So overall, I'm not overly concerned at this point, although I'm sure there are some companies, depending on various sectors, that are going to look at what's going on in the markets over the last few weeks and potentially think twice about going at this exact moment. But other sectors are well positioned to go. So,
who do you think will continue to go and who's going to hold off?
Well, I think you've seen this year so far, I think you've seen some sectors, consumer staples, industrials, energy, do quite well against a backdrop of some other sectors that have been a little more challenged. I think tech, though, is going to continue to be robust in the medium to long term.
Samara, what do you think the current market environment? I mean, Jamie Dimon has already started a small zoo with cockroaches and a skunk the other day for inflation. Do you agree with him?
So, look, I think the most important point I want to echo is what Lynn started with, and maybe challenge the premise of the title of our conversation here around making public markets appealing again, because There is volatility in markets, which is expected, particularly as we are going through a period of time with a lot of uncertainty, geopolitical uncertainty, monetary uncertainty, inflation uncertainty, and then the acute events of this weekend. But there's also disorderly trading. And what we have actually seen in the volatility of the last few days is a really orderly market. And over the weekend, people were waiting for the market to open to transmit information to them around how news and events were being consumed and translating into outcomes for companies and for countries. And so the importance and the utility of public markets, especially during volatile times, I think is very much on display right now.
I mean, obviously BlackRock is both in public and private markets. I mean, is it the right way to look at markets, public versus private, or do we see more of a continuum these days? How would you describe
I think investors see risk in whole portfolios, and I think that translates into a continuum and to an ongoing desire for capabilities to assess risk beyond the wrapper of how that risk is delivered. Now, access to public markets, the kind of wrapper that public listing provides companies, is easier for investors. Easier, it's more transparent. So that's meaningful, and that's why public markets are really have been the primary vehicle for wealth creation and retirement savings. But as investors really look to diversify their portfolios, seek new sources of alpha, and I also think really importantly, more thoughtfully incorporate liquidity where they need liquidity and where they don't need liquidity into their portfolio construction. Extending this, and I think continuum is the right word, is the way investors, particularly retirement savers, are looking at, retirement savers, I would say, who don't have allocations to private markets, and that's more specifically in defined contribution 401k type plans. Defined benefit plans have allocated to private markets for years for that reason, because it is the appropriate solve for the long-term time horizon.
You agree with the continuum, or?
Absolutely. A robust public market needs a robust private market, and a robust private market needs a robust public market. I think the fact that companies are staying private longer is a good thing. It's a good thing because when they do emerge as public companies, they've got a refined strategy, they're much more disciplined, they have a practice, they have done a variety of earnings calls in anticipation of that moment. And most of the time, in more recent history, they're either profitable or have a good path to profitability. But all of that needs to be incubated in the private market. So I think the fact that companies are staying private longer is ultimately a good thing.
Some critics say that if companies stay private for longer, obviously you have massive wealth creation for the owners, but once you go public, there may be less of an upside. Is that a concern?
Not necessarily. That's not necessarily true. I mean, you've seen some companies that have gone public in the recent history that have done extraordinarily well in the public markets. Take a company like Circle, who BlackRock was an early investor in, incubated in a private capacity and a strategic capacity, and there's been a tremendous amount of wealth creation for those people who have been shareholders since they've been a public company. Same thing happened with Reddit. So it's not true to say that companies only go through a hyper growth, a hyper valuation appreciation in a private market.
How hard is it to pull off $1 trillion IPO, which may happen this year?
Sorry, what was
How hard is it to pull off $1 trillion IPO?
It depends on a variety of factors. I don't know. I don't know what it will look like, how they will come to market. So I guess we'll all find out.
Obviously.
But importantly, there's a lot of considerations that go into when you float a company that is large. Leave $1 trillion valuation to the side. You look at Alibaba when they went public. They weren't a small company that went public. So it's got to be a consideration around how much do you float of the company on day one? Do you have a large float, small float? What percent? What type of price do you take at the IPO? How much do you leave on the table? Who do you have as anchor strategic investors? So there will be some complexities that go alongside with the large IPOs that have been rumored to go public.
Now, obviously, the number of publicly traded companies is down from the peak in 20 or 30 years ago, which is not great if you're an exchange because obviously but are there any implications for VC exits, for private equity, if we don't get more companies to say, yes, we're going public?
Well, from an exchange standpoint, our job is to enable buyer and seller to match in the most efficient fashion possible. And if I look at the amount of shares that are traded on public exchanges, even in the last year, they've gone up about 40%, the volume. So I would argue that our U.S. capital markets are more liquid than ever. There's considerations for the entirety of the ecosystem without the public exits for companies that have stayed private for longer, but I continue to be of the opinion that it's good for companies to stay private a little bit longer than they had. You look at 2020 and 2021, that was the other end of the bell curve where companies rushed out to take advantage of very high valuations, very high multiples, and in many cases, those companies are worth significantly less than on their IPO.
And if I could just add, I think this obviously this narrative around the number of IPOs is important and has traction, but I think it's a little bit of a limiting lens to look at the growth and utility of the public markets in today's global capital markets ecosystem. And by that I mean trading volumes, not just notional volumes, but trading volumes of shares are up significantly. It won't surprise you to know that I look really closely at ETFs and ETF investing, and to the point yesterday on how people use public markets during high velocity moments to quickly manage risk and reallocate. ETFs were like 40% of the tape yesterday. This morning they were almost at one point 47% of the tape. Lynn and I share a love for fixed income markets. We were super pumped to be backstage and get to hear the Muni story. But importantly, our public markets have actually become really important delivery vehicles for less accessible asset classes like fixed income broadly, municipal bonds, commodities, and of course crypto.
Now, you've already mentioned SEC Chairman Paul Atkins and his Make IPOs Great Again in your interview on TV just a moment ago. There are many proposals out there, scrapping quarterly earnings. You like quarterly earnings, you mentioned, narrow company risk factor disclosures, etc. Which one of these is really going to move the needle?
I don't know that I actually said I like quarterly earnings. I said that you need to look at a variety of considerations around quarterly earnings, including what is meant by quarterly reporting and whether there are other frameworks to say. But I'm a huge fan of the transparency that is generated through the financial disclosures that occur. There are a variety of areas that need to be looked at in order to make the market more welcoming for companies. So it's not just about, and Chair Atkins' speech was not just about moving from quarterly to semi-annual earnings. There were a variety of other areas that he touched upon, including shareholder governance and shareholder reform, what it takes to bring about an action or a voting matter in an annual general meeting. The role of proxy advisors is an area that's being looked at intensely by DC, and whether that's quantitative or they're qualitative factors. What is the litigation profile, litigation risk associated with a company? So it's a bit of a multi-threaded Gordian knot to untangle to really look at a mechanism to make companies more excited about going public earlier.
What's the main one? If you had to pick one of all the proposals, what would you pick?
I think around the areas around the shareholder reform, what it takes, I think what the state of Texas, what Governor Abbott's done in the state of Texas around the minimum dollar amount that is required to be held in an account before you bring an action against a company. I think that's a great mechanism. I think some of the litigation risk should really be looked at as well. That is a company's risk factors, for example. And then I would say probably streamlining some of the disclosures that a company makes, making it a bit more simple to understand as opposed to the voluminous text that comes out today.
Samara, your perspective?
Look, I think Lynn knows, more than most people in the world what it looks like and the incremental considerations a company has to consider to go public. I guess for me, I question, bringing the investor perspective, and we both agree that this is more of a continuum. Wouldn't it be ideal if there was a way to better calibrate the steps towards becoming public and the incremental expense and cost assumed without it being such a tremendous kind of binary decision? And there's actually a lot of work, I think, progressing now in that space, kind of in between public and private markets with respect to progressing particularly data standards and transparency, which is, I think, the goal of creating these markets that are so useful because they're accessible and transparent. That requires work and that requires disclosure. So how you can solve for that at a lower burden so you can create this continuum without these potentially big spikes in cost that a company assumes. And frankly, I do wonder, I think there's been some good work done on this, particularly by groups like the World Federation of Exchanges. I think very few people actually, and probably a lot of policymakers don't understand the incremental costs that cumulative types of regulation at this point are requiring of companies. So I think solves for that, especially given the technology tools that are available to us today, are probably the path forward.
As an exchange, what can you do to make it more attractive to be a publicly traded company?
Talk to our customers. We spend a lot of time with our listed companies, listening to their concerns, particularly the offices of the CFO, head of IR, listening to their pain points, general counsels as well, and then act as an advocacy group for those companies to really focus on structured reform to allow a company to tell their story in the most efficient way possible and reward them for the good disclosures that they are making in the market.
Is there any sort of financial innovation that you could drive to get more companies to list? Tokenization has come up.
Well, we did announce our tokenization initiative earlier this year. Our tokenization initiative is a platform that's going to be fully on-chain. We already built the technology, we've already done a variety of proof of concepts. It allows for instantaneous settlement, 24/7 trading. It importantly allows for the rights associated with a share to move into that electronic form, but is going to be a platform that runs in parallel to our more traditional exchanges. Our more traditional exchanges are moving to 23/5 later this year to again allow the responsible transfer of risk, the responsible matching of a buyer and seller during the elongated trading session as opposed to what happens today.
What are the risks of 24/7 or 24/5 trading? Samara, do you have a view?
Well, first of all, the benefits are obviously going to be broader windows of access and price formation, and we've been talking about price formation. And the other thing, I mean, that I've learned through years of seeing lots of volatile equity markets is that it's hard to restart markets once they have stopped trading. So there again is a measurable benefit to markets and a lot of the big dislocations in history that we experience sometimes are on a market open. So I think there is a lot of positive benefits that we can take from theoretically 24/7, in practice 23/5. The big questions are going to be, number one, does the infrastructure and the guardrails that worked so well during, regular market hours and in the early sessions too, evolve alongside the expanded trading windows? I would give huge credit, with the announcements that have been made over the course of the year around 23/5 trading. A lot of the industry participants, reporting venues, clearing services, have been working closely together to create the operational alignment so that the infrastructure supports the technology. But that's number one. And then number two, I think the really big question is going to be, do we actually see incremental liquidity coming into the market versus the same amount of liquidity being spread over a broader window? The latter would not be accretive to markets, but I think the collective bet that the industry is making is that this is a way to bring more participation and liquidity into the markets.
You agree?
Absolutely, particularly as the U.S. markets continue to be the envy of the world, seeing the investment dollars that are put into the U.S. names, in particular during the Asian trading session, on the non-regulated exchanges. I think this is the exchange framework moving towards 23/5 brings the reliability and resiliency to prevent a reoccurrence of what happened in August 2024, where the Nikkei drops 12.5% and a variety of trades become invalidated. It was really what led us towards moving forward with, at the time, 22/5, but to match the clearing cycle, 23/5 now.
And you think the guardrails are there to avoid that there's no volume or the same volume but spread out?
Yeah, absolutely. I think the guardrails are there. If you look at the U.S. equity markets and all of the volatility that those markets have withstood over the course of time, be it the limit up, limit down plans, a variety of other circuit breaker, the interconnectedness of the market. The market framework, the market infrastructure has been built, refined, and honed through a variety of crises. So why would you not implement that framework to make trading more reliable, safer, and more resilient during an elongated trading day?
Are you worried about other markets or other countries trying to emulate what we have here? I mean, 30 years ago in Germany, there was a Neue Markt that didn't go particularly well. Are there others where you think, oh my God, this is really bad and we should try and get more people into America?
You are seeing a tremendous amount of capital flow to the U.S. If I look at even the listing we had this morning, is a UK company that moved their listing to be U.S. primary, a company called Sunbelt. Earlier in the year, we welcomed AstraZeneca, which moved their primary over as well. So it is, the U.S. markets continue to be the envy of the world, particularly as the U.S. dollar continues to cement itself as a reserve currency.
We've talked a lot about regulation of public markets. People put a lot of money into private markets. Do you think there has to be more robust regulation for non-public markets to make public markets more attractive?
Do I think there needs to be
more regulation for private markets, prediction markets, etc., so you don't have casino over here and publicly regulated markets over here?
Well, I think the prediction markets do have regulation. The CFTC has asserted itself as the regulator for the prediction market, so that regulatory framework is continuing to evolve. In general, I think anything that adds transparency to markets is a good thing.
Any thoughts on? Public versus
I
private?
think that the conversation that we've had, a lot of it is industry practice. Sometimes that industry practice gets initiated through regulation, but increasingly data standards, and importantly, I think if we stipulate that in the future more investors are going to seek to access the private markets, then a standardization of information and disclosures is going to play a very important role, because one of the characteristics of private markets is that data and information is more bespoke. So as you seek to broaden the audience, and I do think a lot of this is an industry prerogative, coming up with something, an infrastructure that works across the ecosystem. A data infrastructure is, whether that comes via industry practice or through regulation, is going to be critical in modernizing the market.
Looking ahead 10 years from now, it's hard to predict, of course, but what's the financial ecosystem going to look like, public, private? Your prediction, Lynn?
I think you'll always see a robust private market. It's where that next great entrepreneur has his or her idea funded, either in the venture community and then the private equity community, to allow the company to find its footing, get its first users, hone that next great innovation. So I think you'll see that. I think you'll continue to see a very robust public market. I think you'll continue to see the more regulated wrappers, for lack of a better description, add transparency to the more opaque markets. And if I look at like the ETF market, for example, it's been the greatest innovation in modern financial markets, given the amount of structure, clarity around regulation it adds to some more opaque asset classes.
Samara, your prediction?
So, I'm going to give you an aspiration instead of a prediction. I think the goal is that in 10 years, there are more investors globally who are participating in positive economic growth through the capital markets. And I think that will happen through progress that is made in public markets, through modernization in private markets, through the utility of new technologies. We talked only briefly about tokenization, but I think tokenization will play an important role. And one prediction I will give you is that in 10 years, an investor will have a portfolio and not necessarily know what the wrapper is. They will know their risks, they will know their outcomes, and they will be able to refine and adjust according to those.
Your worst case scenario? What could go wrong?
So my worst case scenario is always the flip side of tremendous periods of innovation, which we're in right now, which is why, like I have probably mentioned data and data standards, at least 5 times over the course of this conversation. Lynn made this incredibly important point that the tokenization model that the New York Stock Exchange has put forth, if you own that token, you actually have the rights you would have as an equity shareholder. That's actually not the case of a lot of things that are out there in the market right now around the world that are called tokenized equities. And so I think bad investor experiences where investors aren't equipped with the information to understand, given the huge choice of things that they have, that will lose people's trust in markets. And ultimately markets require trust for my aspirational statement, which is more participation in them, to happen.
A last word from you, Lynn?
My worst case scenario is people forget that the market over the medium to long term grows. And they forget the fact that markets go up and down, and tend to focus, people sometimes will focus on the immediate term and think it's a panic moment, which it's generally not. Even if over the last year, the Dow has gone from 36,000 to over 50,000. Markets grow over the medium to long term.
that's a great point to end on. Thank you very much. The clock is telling us we're out of time. Thank you for listening, and thank you for coming.
Please welcome to the stage John W. Rogers Jr., founder, chairman, and co-CEO at Ariel Investments, for a conversation with Bloomberg's Nora Melinda.
Hello, everyone. Thank you so much for joining us today. I was just chatting with John outside. We were talking about so much uncertainty here in this market, and that's where I'd like to begin our conversation. John, thank you so much for speaking with me. It feels like we're in a market where headlines are driving sentiment hour to hour to hour. We also have geopolitics, trade policy, AI disruption in focus, so many things to focus on in this moment. And it's not just headlines. They don't just trade on headlines in terms of the market, but they also trade on capital flows and long-term assumptions. We were chatting about how diverse your board is at Ariel Investments, and I'm curious what it looks like if we were in the boardroom right now in this moment. What types of conversations are you all having?
That's an interesting question. We just had our Ariel Investments board meeting just yesterday here in New York City. And we have a wide range of directors. You talk about diversity. We have Martin Kramers, who's the dean of Notre Dame's business school and helped create the term active share. And we have the former senior advisor to President Obama, Valerie Jarrett, former Secretary of Education, Arnie Duncan. We have Heather Tooks, who is an extraordinary professor at Yale University, very involved in the investment world. And so bringing all these perspectives together, we think makes us a stronger firm and a better firm. And you can bet last night at the dinner we were talking about this challenges the country's facing today. And basically, the worries and fears that we all have that Iran can find a way to fight back and come back to try to harm us and hurt us in really meaningful ways and impactful ways. And that's something that is truly, I think, worrisome for our society today, that they are, thinking about that and worrying about that and worrying all of us that, here in New York, where you had what happened with the extraordinary, heartbreaking World Trade Center tragedy, will they try to find some other way to come back and hit us back in a similarly hard and painful way?
Mm-hmm. Well, no surprise that the conflict between Israel, Iran, the U.S. being involved is really dominating discussions. But I'm curious, is it actually changing how you allocate capital?
Well, for us, we think this creates opportunity. We're long-term investors. Our logo is a tortoise. It still is, reminding people that patience wins. And our capitalist democracy is the best system ever invented. Warren Buffett always reminds us of that every year at the annual meeting. So we'll get through these challenges. We'll come back better and stronger. He always talks about the best time to be born in America is today. So I'm really taking advantage of this opportunity with all the volatility to buy some of our favorite stocks that we think are selling at much better prices today than they were a week ago.
And so what are some of those sectors and names that come to mind?
I think a favorite sector wouldn't be surprising is the financial services sector. We have some wonderful businesses like Jones Lang LaSalle, JLL. Real estate brokerage is a really important business in the world. And they've been hit basically based upon the fears of the economy, but also the fears around, will AI disrupt the commercial brokerage insurance business, which we don't, real estate brokerage business, I'm sorry. We don't think that will be long-term impactful. You always are going to need a great real estate broker. If you're a CEO thinking about moving your company or moving 100 people from one office to another office, one campus to another campus, those are complicated, complex transactions. You're going to need the kind of talented people that are at a place like JLL. Other companies would be, you think about all the deals that are happening today. Every day, companies are spinning off companies. People are buying companies. We see what's happening with Paramount and Warner Brothers. You see that the regulators are allowing transactions like that to happen again. So a company like Lazard, that's one of the major investment banking brands in the world, they're going to have a great year as investment bankers helping these transactions occur. And they also have a great international and global investment management business that we think will benefit from people investing in bargain stocks around the world. And then finally, a favorite is Carlyle. We think that private equity is not doomed forever. We've seen all the companies have been collapsing this last week. You watch on TV, you see Ares and KKR and everybody getting cheaper and cheaper. But we think Carlyle is really well positioned. They don't have the same exposure to the software companies, and also they're not. They're really where they're focused. They're really in a great spot. They've got a great brand. They've been very cautious and conservative. They haven't been involved in where the debt markets have sort of been under siege. They're less exposed there. The private credit market is not a big deal for Carlyle. So we think David Rubenstein and the founders created a great brand there, and there's real opportunity. And we think literally it's only a little over 10 times earnings, really a cheap stock.
Well, are there any areas specifically in the credit market where you do feel a bit concerned?
I think you want to be concerned about these hot markets. This does remind me of when the internet bubble was booming at the turn of the century, and everyone wanted to buy the same .com companies. We think that's happening with these AI companies. Everyone is so excited about it, and the data centers are all the rage. Everybody wants to own a data center. Every real estate person I know, many public companies are investing in that way. So that would be a sector that I would be really concerned about, things that are really tied to AI and companies that are sort of, jumping into new industries for the first time because they think that's where the economics are going to be really positive. So I'd be very cautious of anything AI connected, especially companies that are really not truly world-class at it.
So, John, just about 2 years ago, today almost, we had a conversation, myself and a few other Bloomberg colleagues, and you said that the market was ripe for a correction, and you also said that Mag 7 stocks, the rally was overdone there, and it feels as though today we're sitting here in 2026, and it seems as though people are concerned about artificial intelligence again. So I'm curious, you spoke a little bit about where you stand today, but are there any names that are appealing to you, or any sort of stocks in particular, I should say, in the sector more broadly that you do think have more room to run? Or is it all of the bet on artificial intelligence is a bit too extreme?
I think what happens when these types of booms happen, there's so many companies that everyone gets excited about. There's going to be a few that'll be the long-term winners, but it's very, very difficult to see that. In this country's history, there was many automakers before things focused on Chrysler, General Motors, and Ford. Saw the same thing in the airline industry. Saw the same thing during the internet industry. So we think this is the same way today. You're trying to pick which are going to be the ultimate winners is exceedingly difficult.
Well, let's zoom out a little bit because we talked about the fact that the macro environment is a little bit crazy right now, to say the least. What's the biggest macro variable that you think that investors are currently mispricing?
I think they're probably mispricing what's happening with the tariffs. We know the Supreme Court. I think that ultimately the courts are going to decide that because the tariffs were illegal, that companies are going to have to be paid back the tariffs that they've already paid. And I think that flood of money coming into the corporate coffers of major American businesses and smaller businesses throughout the United States will be a real tailwind that people really haven't factored in. And everyone thinks that there's going to be ways that the administration will be able to get around that and stop that from happening. I think that's what's really mispriced. It's going to be very hard and difficult to do once the Supreme Court said these tariffs were illegal.
So I also want to talk about the idea of patience in value investing. You echoed that. You brought that up a little bit earlier. We know that a lot of people say that value investing has quote unquote become a dying art. Some people are saying that, especially when we think about the market being dominated by artificial intelligence, passive flows, momentum as well. How important is patience in value investing, especially when markets may misprice assets for extended periods of time?
Well, patience is really critical as a value investor. You have to wait until you can buy a great business at a bargain price. And then you have to be patient as often a company maybe it's going through a temporary crisis. They're having some difficulties that they're having to get through. And you have to be able to look out, again, over the horizon and see what that company will look like when the sun comes out again and the storms drift away. And I think that that's where, the great value investors are the ones that are able to invest with that 3 to 5 year horizon, not get so fixated on what's happening each quarter, whether a company missed or didn't miss, but looking to see if that long-term strategy is still in place. Is there a true moat around the company? Does the company have a balance sheet to weather the storms? And a management team that's laser focused on hiring the best people and treating the customers fairly and appropriately. And also deeply, management teams that care about their shareholders. If you keep your eye on that long-term prize and not get swept up in the short-term noise, that's how value investing really works.
So let's talk about value traps then. What's a classic value trap to you this year? And what are some telltale signs that a stock is cheap for a reason versus just being genuinely mispriced?
Well, that's really, really, really difficult. It's, and behavioral finance teaches us how hard it is to sometimes just being human beings to avoid a value trap. It's really, really, really difficult. But I think what you have to try to do is really what we've tried to do at Ariel is have a devil's advocate on every industry that we follow and every company that we follow that can come in and challenge the thesis that we have for that company. And that makes it, it makes it easier for someone to challenge what the analyst is thinking and what of us seasoned portfolio managers are thinking when you have someone assigned to be that devil's advocate. I think the other thing you want to keep asking is the moat still there? And companies all the time try to tell you this is just a temporary problem. They're going to be able to resolve it. And human nature, you're sort of rooting for the company to get back on track. But if you look out over the horizon, you see that the moat isn't going to be able to withstand competitive pressures, or the industry is not going to be able to grow the way you had hoped it would be over the long run. Those are the companies to try to avoid and for us and stay away from. And there's sectors like that. One of the things I think what's happening, the way Americans no longer are drinking alcohol the way they used to. So, for us, it's be very difficult for us to buy a cheap, cheap beer company or a cheap spirits company. But there's many examples like that where industries completely transformed and it'll be very difficult for them to get back on track and grow again.
Well, also we're dealing with this higher for longer rate environment, people concerned about the outlook for interest rates. Are you seeing a different universe of companies that you would say are showing up as cheap today versus maybe 5 years ago?
I think that what I really think are the cheap, a lot of the industrial companies that manufacture products that people often need from the auto industry. I think that's a sector that's been sort of out of place for quite a long time. They've never really had their day in the sun to really have a really strong comeback. I think a lot of the housing related companies, a favorite stock of ours is a company like Mohawk that makes carpeting. Just a very mundane, very important, solid business. It competes with Warren Buffett's Shaw Industries and their carpet businesses. But we think that'll be something in the long run will work. So those are sectors that I think the industrials, the housing-related companies, you can find bargains, or they really haven't had a chance to really truly shine in today's economy.
What about on the opposite end? I know we talked about some sectors that you're a bit cautious on. You mentioned artificial intelligence. Is there anything else that's out there alarming to you?
Well, I think that the alarming things are, we talked about, the hot tech stocks that everyone is owning because they're such a big portion of the S&P 500's results. And I find that when everyone feels the need to own the same names because everyone else owns them, and because they become large portions of the index, people have stopped looking at the fundamentals. They're not buying the company based upon its growth rate, management, its capital allocation decisions. They're buying it based upon what index it is. That's always a sign to us that we are getting toward the top in those sectors, in those industries, and those companies. So I think we're seeing that in many places, but primarily, as we talked about earlier, the tech stocks, the AI stocks, these large booming businesses that have just sprung up overnight, they haven't proven whether the moats are going to be strong or not. So I just be very, very cautious and careful.
I mean, do you think that at all the reaction that we did see in terms of the sell-off of a lot of AI-related names or sectors that we think could potentially become obsolete due to artificial intelligence, is that a knee-jerk reaction, do you think? I mean, because we did see this one period where people would say, you're crazy not to have Magnificent Seven stocks in your portfolio or just tech exposure in some way, shape, or form. But now you're seeing investors saying, hey, maybe not so much.
Well, what we've tried to do at Ariel is make sure that we are just not listening to ourselves, but try to get as much academic expertise. We're blessed in Chicago to be at have the University of Chicago there, and I'm a trustee there, and we've been able to get access to a couple of great professors to help us consult and guide us on where the most likely disruption is going to occur. and where you have to worry the most, and then where maybe it could be a tailwind to help your company or industries that you're following, how they will do in this new environment. So it is really, it's surprising how powerful it is and where you don't always know where it's going to show up. So one of our best stocks the last year has been the Sphere out in Las Vegas. And, you can go and see the Eagles, the Backstreet Boys, and of course they've got Wizard of Oz, and it's just been phenomenally successful. But it's because they were able to use AI very effectively and efficiently to make the Wizard of Oz work within that new arena with the best sound in the world and the best video in the world. They wouldn't have been able to do that 5 years ago. And as AI becomes more and more powerful, they'll be able to take the IP and be able to make magical things happen, and in a way that'll be very cost effective and create experiences for consumers that no one could have imagined in the past.
Mm-hmm. How are you thinking about the rate environment and what that could mean for investment opportunities more broadly? We've been sitting in this situation where rates are been high for a sustained amount of time. You mentioned that, of course, the thesis of value investing, and specifically with your firm, you all are long-term investors. But how do you think about the future? How do you price that in, especially in this environment that we're dealing with?
Well, I do think that we talked about some of the positive things out there. Regulatory environment is positive for M&A and transactions. You think about interest rates. I think they have to go lower. We all know this. It's all front page news. We see it on television every day. We know that the new Fed chairman is going to want to make the president happy and keep interest rates low. And so I think that'll be a major tailwind as we go throughout the year once you have that transition. We think, again, the tariffs will be getting paid back. All these things are going to be helpful to create an environment that will be ultimately good for the markets, even if we do have some bumpy times along the way. But to your question, the bottom line is I would bet the rates will be lower 6 months from now than they are today.
Mm-hmm. So for somebody that's trying to navigate this environment, where should they anchor their strategy? We've got so many different moving parts and focus right now. It can be easy to feel like you're turning from side to side. We had a data shortage with a government shutdown. You spoke about tariffs, artificial intelligence disruption potentially. How do you anchor your strategy in this moment?
Well, I think for us, it's just going back and finding great companies that are we think are undervalued and underpriced. The one thing I haven't talked about, I think experiences are going to be more and more important. With AI, people are going to be working less hours. People are going to be looking for exciting things to do with their extra free time. So it could be going to the Sphere to go and see shows. It could be getting on a cruise line and going to visit the world. And so companies like Carnival, Royal Caribbean, Norwegian are really well positioned in the cruise space. A small company like One Spa that does all the spa services on the vast majority of ships, they'll benefit from people wanting to use their time more effectively and have more fun. We own a lot of stock in Madison Square Garden Entertainment that owns the Garden here in New York City. And, people are going to be going not only to see the Knicks and the Rangers play, but they'll see the residencies. Harry Styles has taken over from Billy Joel. And lots of fun, exciting things happen. People have more time for it and are willing to pay up for those experiences. So we're looking at companies that will benefit from that transition.
Mm-hmm. Has the balance between value and growth meaningfully shifted in your portfolio at all, to any degree?
We continue to be just strong value investors. Our portfolio is very cheap relative to the markets, and there are a lot of wonderful companies, selling at less than 10 times earnings that you can buy that have substantial growth anticipated, great cash flows, well positioned, and they're really cheap. And they're partly cheap because everyone had given up on small value. Mm-hmm. So the quality of the research just isn't what it used to be. And if you do the homework, you can find some real hidden gems there that will, we think, have great returns going forward. So I'd be sticking to value and feeling that that's where the opportunity is. Do the creative homework now and it'll really pay off over the long run.
What's something that, I can imagine there's a lot of things, but what's something that keeps you up at night when you're thinking about how to best strategize?
What I talked about earlier, I just do worry that the unsettling time in the Middle East and how that could just really come back to haunt us here, and in ways that we can't imagine, because we're doing things in a way that's different than maybe we have in the past. and not understanding the ramifications as a country like Iran. Iran feels the power is incentivized strongly to fight back and terrorize the rest of the world, and especially the Middle East, and to try to destroy America to the best of their abilities. That's what I kind of worry about, that worldwide tensions that we have right now, and what terrorists can do to our country. That's what really worries me.
Well, thank you so much for your time. That's John Rogers, CEO of Ariel Investments. I appreciate a riveting conversation.
Well, thank you.
Well, that does it for our first day of Bloomberg Invest. We have lots more coming your way through the evening and tomorrow. Before you rush off, a few announcements that we have here. I want to first thank our title sponsor, Invesco QQQ. Our knowledge sponsor, Marsh. Our supporting sponsors, Allspring Global Investments, Deutsche Bank Wealth Management, Harborview Equity Partners, Moody's, and Salesforce. The conversations continue downstairs with a networking reception for the next hour. We also have cocktails and tastings from Soto Romo, so make sure you don't miss that. Head downstairs to find out more about this amazing wild harvested ultra premium product. If you're registered for the AI Leadership Roundtable, proudly sponsored by Salesforce, please head to Hub 3 for that at 4:30 p.m. Also, please stick around. We have a live taping of our hit podcast, Odd Lots, starting at 5 p.m. Lloyd Blankfein, their special guest. He's out with his book, Streetwise, today. And the first 100 folks in attendance will get a free copy of his book. It's a great way to cap off the evening, so stick around for that. Tomorrow, doors will open at 8 a.m., so come for coffee, networking, and breakfast. If you're registered for the Stealth Concentration Risk Roundtable, sponsored by Marsh, that will take place in Hub 3 starting at 8:15 a.m. Tomorrow, also outside the hubs, we invite you to visit the Bloomberg Terminal Lounge. Grab a coffee, connect with colleagues, and chat with Bloomberg experts. We'll pick back up at 8:30 a.m. with programming on our innovation stage, some great names in the AI, energy, and infrastructure space speaking there. On that stage and across the whole day tomorrow, we'll be taking an increased focus on the private markets. On this stage at 9:45 a.m., we have the CEO of Temasek, HPS CEO Scott Kapnick, and KKR CEO Scott Natal. If you will want to be here for those conversations, so make sure you don't miss it. I'll see you downstairs from some networking now. Have a safe and pleasant evening. Thank you again.
Wait a minute, 'cause I've been caught in the wildfire of a super second, a super deep breath in the garden. garden of your long lost love. Next to you, I've been caught in the wildfire of no second guesses, no settling with only for a weekend. Next to you, 'cause I've been caught in the wildfire of no second guesses. I have a little trouble with the deep end. for so long. And those coffee eyes are building me up and then turning me down. Filling my cup and then drying me out. Babe, I'm addicted to your energized coffee eyes. Even your secrets wanna make me high. Guess I'm a day without you in my mind. Telling myself I wanna be just like locked when all I want is you. I'll keep to myself what I want to say in case you don't feel the same.
Please take your seats. The program will begin in 10 minutes. Please take your seats. The program will begin in 5 minutes.
Keep it all in the moment before
Please take your seats. The program is about to begin.
ruin the mood. If you don't feel the way I do, we don't have to talk about it. We can just
Please welcome to the stage Lloyd Blankfein, former CEO of Goldman Sachs and author of Streetwise, for a live recording of Odd Lots with Bloomberg's Tracy Alloway and Joe Weisenthal.